Good morning. Good morning again. It is my pleasure to welcome you to the second International Chamber of Commerce, Kenya, Banking Commission Conference. We are slightly late. We're running a bit late to the program, but I know we shall be able to catch up. My name is Fred Nyasaka. I'll be the MC for the day, and I am a member of the Banking Commission. Again, I want to welcome all of you. We have participants in this room, but we also have participants joining globally. ICC is a global organization, so we will expect people who will be logging in from all over the world. So once again, I want to say welcome as we start. I just want to mention a few housekeeping issues. First of all, if you walk out of this room, you turn right, and then left at the end, you turn left, past the wooden door. On your immediate right, you'll find the important rooms. So the gents and the ladies shall be in that room. Throughout this session, I also would like to request that we keep our phones on silent, isn't it? Yeah, we keep our phones on silent, and then when the sessions are going on, we minimize movements in the room. At this point, I'll invite us to stand up so that we can have the national anthem. Thank you very much. We may have our seats. At this point in time, I'll invite our secretariat. Let me introduce them. We have Shine. Shine is with the ICC. We have Pascalina. Welcome. I'd like to invite you to an interactive engagement through Mentimeter, and the questions shall be displayed on the screen. Go ahead. Okay, I'm told that we defer this to the next session. At this point, I'd like to invite our chair, Chair of ICC Kenya, Engineer Patrick Obath, to make the opening address. But before he comes up, I'd like to introduce him. Shine, maybe you can put his profile on the screen. We seem to be having technical hitches, but it's always good to have a backup. So I'll use my backup to introduce Engineer. It's there. So Patrick is an experienced chairman of the board of directors with a demonstrated history of working in the oil and energy industry. He's a certified executive leadership coach and a sought-after mentor. He has served and is still serving in both roles as chairman and director on the boards of large, medium, and small-size private sector corporations, including financial institutions. He has also served and is still serving in both roles in development-related organizations, business member organizations, and NGOs, including trade-enhancing organizations. He served in these roles since he retired from normal employment in 2010. When employed, he worked for Shell and Shell-affiliated organizations for 35 years, spending the last 10 years in regional and country positions in the C-suite. He has also worked in many parts of the world and also have intimate knowledge of the African continent, having had responsibilities in 14 diverse countries. He is skilled in crisis management, sustainability, ESG, and business planning. A strong entrepreneurial professional with leadership skills from several global management schools and a fellow of the Aspen Institute's Global Leadership Network. Patrick, you've not added that you're a past district governor. He's a Rotarian, he's a dedicated Rotarian. Patrick, welcome to the, Let's welcome with a round of applause.
Thank you very much. I hate standing behind podiums, so whoever had put the camera on the podium has to move it. So thank you very much, all of you who are attending this conference today, and welcome to you. Welcome to all of you, wherever you are, present in this room or online, and whichever part of the world you're in. This is the second ICC banking conference under the theme of convergence of banking and innovation, a new era of fintech and growth. This theme is inspired by the dynamic technological advancements that have been influencing every aspect of the economy of this world. The finance and banking sector has not been left untouched by these changes, leading to increased financial inclusion, enhanced efficiency, cost reduction, increased opportunities, but also some challenges such as the rise of cybercrime. And as I was sort of refreshing my mind this morning, I realized that I couldn't connect my internet banking to M-Pesa, precisely because of that. And obviously we've been under a DDoS situation for the last few days in different digital services in the country. So cybercrime is a reality, either theft or just nuisance, like I'm told DDoS is. However, we recognize the immense value that technology can have in providing access to finance for SMEs through supply chain financing, trade finance, and empowering the underprivileged at the bottom of the pyramid with much needed financial inclusion. The ICC has been at the forefront of promoting and enhancing digitization and technology adoption in the finance and banking sector. And this has been a role, especially having the Banking Commission as part of the ICC in recognizing that this needs to happen. Recently, the ICC launched the Uniform Rules for Digital Trade Transactions, URDTT, version 1. This is the start of actually making sure that there is a complete harmony within that area. Now, these rules are designed for a fully digital environment, to be neutral with regard to technology and messaging standards, and to extend into the corporate space, including commercial transactions and the growing community of non-bank providers of financial services. As the Kenya National Committee of the ICC, we are leading the region by ensuring that professionals are well informed and trained in understanding these rules. And I'm sure during the course of the next couple of days, you will be able to get the opportunity to understand how this can be done through the Banking Commission and ICC Kenya. The roots of fintech can be traced back to the 1950s with the invention of the first credit card. Who can remember that one? Quite a few of us are not born by that time either. But it's a card that is not very well known in these parts of the world, but well known in other places. Diners Club. It was in Kenya at some point and then left. I don't know whether it is still back. Yeah, Diners and Express were the two sort of big cards at that time. And in 1967 is when really the issue of technology in the financial services started, with the first ATM installed by Barclays Bank. And this was really the beginning of now digital technology. As a country, we have become leaders in this space with world-renowned fintech products, and I think M-Pesa comes to the fore, PesaLink and others, which offer digital lending platforms, remittance services, and online payment solutions. And I think if you look at Kenya and look at just the basket of opportunities and solutions, Kenya is really leading in terms of integration of the different fintech solutions rather than leading in one and making it large. I think that is the key thing that we have in Kenya. And that is good because fintech plays a crucial role in supporting growth and poverty alleviation by strengthening financial development, inclusion, and efficiency, and enabling a thriving digital economy. The impact of fintech is evident worldwide, with the rise of mobile money, bank apps, financial services provided by big tech firms and neobanks, and the emergence of crypto assets, central bank digital currencies, you name it. Everybody is coming to play in that area. Embracing fintech adoption can further improve financial development, promote core policy objectives such as stability, integration, inclusion, efficiency, innovation, and competition, and lay a strong foundation for a digital economy. However, much as it creates a lot of opportunities, it also presents challenges. To navigate the convergence of banking and innovation successfully, we must learn from international case studies, examining how leading banks have harnessed technology to provide seamless customer experiences, look at how they facilitate cross-border transactions, and serve underserved communities. But for this to happen, balanced policy approaches are essential, primarily to mitigate risks related to financial stability and integrity, consumer and investment protection, fair competition, and data privacy, whilst fostering fintech innovations. And I'll talk here and sort of talk here about the reason why M-Pesa has been a very successful innovation in Kenya. Traditionally in the world, whenever anybody innovates, the regulators come in and want to put policies first, and they tell you, wait, let us put a policy, then you can innovate. Unfortunately, innovations done that way tend not to be innovations. They're just extensions of existing areas because policy, in my view, tends to restrict rather than create an innovation space. Unfortunately, with M-Pesa, when it was being, when the innovation of M-Pesa was happening, the then central bank governor and the minister who was in charge of ICT at the time both got together and agreed that they were not going to try and regulate the development of M-Pesa. And hence, it was able to find its space, and then eventually regulations around the digital space in terms of financial activities then began to happen. And right now, I think that space is slowly creeping in. As we look at the global examples, we must remember those kind of items that have happened in Kenya. And also exploring local case studies can uncover unique challenges and opportunities faced by our banking sector, such as obviously the groundbreaking mobile payment solutions, AI-driven credit assessments, and a thriving fintech ecosystem. My brother in the US told me that he applied for a loan and he didn't speak to anybody, and 4 hours later, his loan to buy a car was approved. Now that is where you get AI, and also just the digital space can make things happen a lot faster, and then to allow the economy to operate at a breakneck speed. So as we celebrate past achievements, let us remain forward-looking, collaborating, and sharing knowledge to foster an environment that encourages growth and resilience, driving financial inclusion and propelling our nation and the world towards a more prosperous future. I am glad to see that you have a lot of distinguished speakers, partners, and participants joining us today, and I wish to thank you all for making today possible. Your expertise and presence will fuel the spirit of this conference, help us shape the future of banking and innovation, not only in Kenya, but also across the industries and communities worldwide. As you're aware or may not be, this banking commission that has organized this conference is part of a larger banking commission at the International Chamber of Commerce. And that links not only this country to that platform, which then also opens up the rest of the world in terms of developments in the banking space. So let us seize the opportunity that is presented by today to engage in meaningful conversations, forge valuable connections, and emerge with actionable strategies that hopefully will fuel the next phase of banking and innovation. So with that, let me officially declare this conference open. Let us engage, share ideas, and network to make the most of this one day that we have together. Thank you very much. And it was on the birthday of the ICC that we had the first World Council meeting in Kenya. So thank you very much. Our Secretary General has just walked in, Pascalina, who was there. So thank you very much to our directors.
Another round of applause for our chairman. Thank you very much, Engineer, for setting the stage for us as we look forward to engaging in the different panels and the discussions that we'll have. At this point, I'd like to introduce the chairman of the Banking Commission. The chairman of the Banking Commission is Kenneth Miriti. Ken has over 18 years experience in the banking industry and has worked for both local and international financial institutions. He's a principal consultant at Kiel Consulting. Like I've said, he's the chairman of the ICC Kenya Banking Commission, and is an international trade consultant specializing in imports and exports. He's a financial services expert. He's an associate of the Chartered Institute of Bankers, and he's a member, Chartered Institute of Arbitrators. Please join me in welcoming our chairman, Kenneth Miriti.
Thank you, Frederick. Good morning, participants, chairman, and the board. The members of the ICC Kenya Banking Commission, I would like to introduce them. Kindly stand up, the members of the ICC Kenya Banking Commission. Those who are present today, we have Mary Mulili, who is our vice chair. We have Frederick, who's also MC, but he's also a member of the ICC Banking Commission. And we have Kennedy, who's also representing the Kenya Bankers Association. Thank you. I think we have another two online, but those are who are present. Today, the theme of the second ICC Kenya Banking Commission conference is the convergence of banking and innovation, a new era of fintech and growth. The ICC Kenya Banking Commission is one of the 4 commissions that have been formed under the umbrella of ICC Kenya, as our chairman has mentioned. There are another, I think, 8 commissions that will be formed in due course. ICC is a pioneer in providing guidance for companies to perform responsibly, offering a wide range of tools and resources to help businesses tailor their approaches. ICC makes it easier for businesses to trade internationally, and everything we do on behalf of the business drives a more peaceful, sustainable, and prosperous future for all. Banks and other financial institutions help companies engage in world trade, mitigating risks so that goods and services can flow across the globe in a smooth, secure, efficient manner, which is especially fundamental for SMEs. ICC produces universally accepted rules and guidelines to help business access the financial needs to import and export valuable goods and services on their own. These include documentary credits, documentary collections, forfeiting, demand guarantees, bank payment obligations, interbank settlements, and dispute resolution that help ensure access to finance and level the playing field. Banks play an indispensable role in making trade work for all. It is especially essential for business to enable them take risks in expanding to international markets. Banks need common rules and guidelines for clarity to avoid confusion that comes with varying national and regional rules. ICC allows the world to speak the same regulatory language without burdening banks with red tape that could keep them from financing valuable trade opportunities. Having the same guidelines levels the playing field for companies and encourages inclusive trade by making opportunities accessible to bank customers to integrate foreign markets and the global value chains. In addition, ICC Banking also develops guidelines for fields such as forfeiting, demand guarantees, supply chain finance, which are all ways that banks work with companies to mitigate the risks involved in international trade. Robust regulation is crucial for banks, but it is equally essential for rules do not hamper the bank's ability to help business get financing. As our chair has spoken about, innovation being impeded by policy and regulation. Towards this end, ICC publishes an annual global survey on trade finance, which provides an in-depth analysis on trends and the impact of policies that helps determine where the rules could further improve. And this is a key role that ICC Kenya wants to play, so that the rules that are made globally have an input from the local banking sector and are applicable to us. We need a voice at that platform. Financial crimes activities, including money laundering, the financing of terrorism, financial fraud, and other financial crimes, severely undermine the integrity and stability of financial institutions and systems. It discourages investment into productive sectors and distorts international capital flows. It impedes the capacity of banks at country level to conduct normal business activities. In these aspects, ICC has made the fight against money laundering and terrorism financing a major priority, leveraging our position as the leading global rules writer for international trade finance to develop guidance for banks and the industry. We also lead industry dialogue with national and international regulators on all topics related to financing, financial crime, and the risk issues. Meanwhile, digital transformation is rapidly changing how people live. We've spoken about the M-Pesa. Emerging trends have significant influence in reshaping the business landscape, opening uncharted potential that can unlock new opportunities. ICC leverages its vast network and business expertise to inform policy developments and promote best practices in digital banking transformation to ensure stable functioning as well as sustainable and inclusive growth. Finally, When commercial disputes arise, you can rely on ICC for high-quality dispute prevention and resolution services that are affordable, predictable, and efficient. ICC offers a wide choice of administered procedures through the International ICC Court of Arbitration that include arbitration as an alternative to litigation for resolving domestic and international disputes. What's more, the ICC is globally accessible, and the arbitration services are neutral to anyone from banks, companies, individuals, states, and state-owned entities. And you'll be hearing more about that in, I think, the third panel today. As ICC Kenya Banking Commission, we have also partnered with the ICC Academy. ICC Academy, you'll also hearing about that later today. The ICC Academy has partnered with ICC Kenya, and I'll be pleased to announce that we have a partnership whereby the Kenyans who undertake courses offered by the ICC Academy will enjoy a 33% discount. ICC Academy has a suite of 12 certified globally recognized courses and about 49 e-modules, touching on various areas from trade finance, arbitration, risk, money laundering, policy, and so on and so forth. So I would encourage the local banking sector to tap into this partnership, which is a valuable tool for capacity building and building the competence of the local banking industry. In addition, we've also explored a 20% discount for ICC Kenya members on ICC Academy literature. That's the books and publications that are regularly produced by the ICC Academy. So on that, we've also explored a 20% discount for ICC Kenya members. Ladies and gentlemen, I welcome you all to this year's ICC Banking Commission Conference, and we look forward to partnering with all industry players for a better tomorrow. Thank you.
Another round of applause for our chair. Thank you very much, Chair. I think what Chair was basically saying that the mission of ICC is to make business work for everyone, every day, everywhere, by promoting open international trade and investment systems that foster peace, prosperity, and opportunity for all. Yeah. What I want to say is that we could not have made it, or such events can only be a success if you partner. At this point in time, I really want to appreciate our partners advancedly. Advancedly, please stand. We appreciate you. The CEO is here with us. Thank you so much for your support in terms of ensuring that we have had a successful event. At this point, I'll invite the representative, I believe the CEO, just to say a few words before now we go into the discussions of the day. Welcome.
Hello, everyone. All right. So I'm a bit of a shy guy. Pardon me, I'll stand behind the podium unlike Engineer Patrick. All protocols duly observed. Thank you for being here today. Associations and partnerships like Advancedly has with the ICC Kenya, like this retreats, our oneness across the length and breadth of Africa and our shared commitment to the collective progress of Africa. And I'd also like to thank, the organizers of this event for putting this together. In alignment with the theme of the day, the convergence of banking and innovation, a new era for fintech and growth, I'd actually like to share a few thoughts of mine. For centuries, the banks have been the backbone for financial services across the world, providing stability, reliability, and access to financial services. In Africa, the extensive networks, the regulatory experience have been instrumental in driving economic growth across the continent. However, over the last few decades, technology has advanced, and has democratized the ecosystem and allowing fintechs to emerge as disruptors to the finance industry. Fintechs are seizing opportunities and innovating to close the gap that banks as pioneers have become too large to fill. And in view of this, many seem to be of the opinion that there's some sort of competition between fintechs and banks. The reality is, however, much different. This is not a competition, this is more of a convergence. For fintechs, the operational strengths and regulatory experience of traditional banks serve as a guide for growth and a lesson in resilience. The banks are also recognizing the potential of fintechs to be a catalyst for progress. Fintechs have fresh ideas, they are agile, and they have the ability to rapidly prototype and test new ideas, new concepts. They are emboldened by legacy systems and more attuned to the changing needs of the modern day customers. And in light of this, banks are restructuring and expanding their product ecosystem and product suites to include more fintech products, while the fintechs are scaling to match the tenacity of the traditional banks. And at the core of this convergence is really a shared goal. It's beyond balance sheets, it's beyond bottom lines, it's beyond product specifications. We are really reclaiming our economies in Africa and innovating to bring financial inclusion and prosperity to Africa. Our collective mission is to empower people, businesses, and communities irrespective of the geographical location and socioeconomic status. The mission, though pursued through different angles and different lenses, binds us together in our commitment for the greater good of advancing humanity. The convergence of banks and fintechs is not just about two entities, two industries, two sectors coming together. It's a synergy of strengths, sharing of ideas, and a mutual pursuit for the collective progress of Africa. As we delve into this new era, it is important that we do not lose sight of the reason that we exist, our customers, the people who patronize us, the people who we serve. And as we work towards this goal, our unique business goals and collective objectives, it is crucial that humanity remains top of mind. Humanity in financing, humanity in insurance, humanity in everything that we do, that should remain top of mind, because without that, without the people we serve, then there's really no impact. We must bring humanity into finance by being responsible financiers, intuitive solution providers, and we must become organizations that innovate, not just to rake in revenues and profits and very big balance sheets, but to bring financial freedom and prosperity to the people of Africa, regardless of where they might be across the globe. This is the mindset that drives us at Advancely, and I speak for my colleagues over there as well. We understand that for society to progress, businesses and people, entrepreneurs must progress. And we are dedicated to becoming who we must become in order to bring and be the driving force for this progress. At Advancely, we like to say that we are building the rail tracks for a more robust and modern financial system to Africa and emerging markets, while we reject the notion that is often touted that Africa is a country. We recognize that we are similar people with similar challenges, similar dreams, similar goals, and we must collaborate across borders to find lasting solutions to these problems. And this is why conversations like the ones that will happen today are of extreme importance. By embracing partnerships that span borders, industries, sectors, we at Advancely are poised to contribute to Africa's economic transformation, to drive financial inclusion and growth, and create a thriving ecosystem that benefits people, entrepreneurs, businesses throughout the continent. And I'm really hoping that together, today we can ignite the spirit of collaboration in the ecosystem and foster prosperity for all. I am looking forward to the engaging discussions and conversations we'll have today. And I'm really hoping that after this session, insurance companies, banks, financial institutions, fintech companies, insurtech companies will collaborate and see each other as partners for the collective progress of Africa and Africans. Thank you very much.
Thank you very much. I'm sure if the two of us were to stand in front of you and you'll be asked who is the CEO, you will say I'll be the CEO because of the way I'm dressed, isn't it? The world is indeed changing. The world is changing because of innovation. Yes. So for a moment I thought I was listening to a Pan-Africanist because of the issues that you brought to fore. Some of the key things I've noted is that it's really more of convenience rather than competition. We are redefining our African economies. We must bring humanity into finance by being responsible financiers. Finally, We must ignite the spirit of collaboration. Thank you so much, our partners, Advancely. And at this point in time, I think we are now all, we'll invite our first panel. Yeah, maybe put the moderator profile on the screen. Yes, I'd like to introduce our first panel, and the panel chair is Robert Waruiru, is here with us. Robert is a partner at Ichiban Tax and Business Advisory LLP. Robert has over 19 years tax experience, including international experience in advising local and multinational corporations on tax and regulatory matters, including transfer pricing, having worked at KPMG LLP, Chicago office. Robert is an advocate of the High Court of Kenya, a member of the Institute of Certified Public Accountants of Kenya, ISPAC, and a member of the Law Society of Kenya. Robert is also a fellow of the Institute of Certified Public Accountants of Kenya, FCPAK, and currently serves as the chairman of ISPAC's Public Finance Committee that engages policymakers on tax policy and administration. Robert's industry experience covers multiple sectors, including financial services, manufacturing, agriculture, transport and logistics, not-for-profit organizations, and the public sector. As an advocate of the High Court of Kenya, Robert has been widely involved in tax disputes and controversy resolution, as well as participating in drafting debate of various tax laws in Kenya. Let me invite Robert to the stage to take charge of the first panel. Welcome, Robert.
Thank you. Thank you very much, Fred, and good morning, ladies and gentlemen. Good morning to our delegates who are attending online. Welcome to this panel. Allow me to invite my panelists for the discussion so that we can get this show on the road. I will just call them up one by one, and please come up. Let's start with Pauline Masharia. Let's give her a round of applause, ladies and gentlemen. Thank you. Right, then we have the tall man in the room, Julian Lotana. Ladies and gentlemen, a round of applause. Thank you very much, ladies and gentlemen. Let me just, I think I'll sit at the back, at the end here so that I'm able to see the screen, because we also have two panelists joining us online, and that is, let's start with Dr. Ademola Odeyemi. Demola, please confirm that you can hear us. Demola? Okay.
Demola's on mute.
I can hear you clearly.
Oh, thank you, thank you.
Good morning, everybody. Good morning.
Good morning, thank you, Demola. And then we have David Henna. Yeah. David, confirm you can hear us?
Hello, yes, I can. I hope you can hear me.
Excellent, we can hear you loud and clear. Thank you very much, gentlemen, and thank you very much.
Excellent.
All right, so right, thank you very much, ladies and gentlemen, for joining us, and allow me to Okay, thank you. Thank you very much. So allow me to start with, I don't know, we have some feedback. All right, thank you. Thank you very much for that. So allow me to start with a quick introduction of our panelists, and I will invite my panelists to, in 1 minute, just briefly tell us who they are and their background before we get started. So let me start with the lady on the panel, Pauline.
Good morning, colleagues. My name is Pauline Macharia, and how should I start? This is always a tricky one. My name is Pauline Macharia. I have been in the corporate sector for the last 28 years. And within that corporate sector, I've served in the airline industry, the telecom industry. I've also served in medical and risk mitigation organizations, and the latest one being in the banking sector. My expertise is around delivering end-to-end solutions to customers and making sure that organizations are enhancing the customer centricity within the organization. Now, when you're driving an organization, there are 3 things we need to consider. There's the leadership experience, the customer experience, and of course the employee experience. So I bring that together to drive the culture in the organization so that we're delivering the exceptional experience that is required. I'm very happy to be here, and I'm looking forward to a good engagement going forward.
Thank you. Thank you very much, Pauline. Let's go on to Lotana. Julian?
Hi, everyone. My name is Lotana Julian. Currently serve as CEO and co-founder of Advancedly. I've had quite some experience across credit control, investments, management, financial reporting, finance, across the full breadth of finance, strategy, business operations, across insurance, financial services and asset management, e-commerce, and that's it. I am happy to be here. I'm hoping that we can engage in very meaningful discourse. I will try, I promise to make no promises, try to answer the questions to the best of my ability. Please ask me questions I have answers to. Thank you.
Thank you very much, Lotana. And let's now move on to our online panelists. Let's start with Demola. Demola, over to you.
Good morning once again, ladies and gentlemen, and members attending this very interesting seminar. My name once again is Demola Odeyemi. I have been in the financial services industry for like three decades now. I started my career as a lecturer in university, from where I moved on to an accounting firm, now defunct Arthur Andersen, which is now KPMG Nigeria. Then I moved into banking from there. I've been in banking since for almost 3 decades. Like I said, my last role before I started my current was in Guaranty Trust Bank, now GTCO, where I had responsibility for expanding the bank's franchise across Africa and Europe. But currently, I'm the managing director of a new bank called Optimus Bank, which was licensed just last year by the Central Bank of Nigeria. I'm very excited to be here, and I believe we're going to enjoy ourselves and learn from each other today. Thank you so much.
Thank you very much, Demola. And last, certainly not least, David Henna. David, over to you.
Yeah, thanks, Robert. And thanks again to ICC for the opportunity to present to you today. It's good to see ICC Kenya going from strength to strength. So I started work in 1972, before computers were invented. I spent 20-odd years in the banking industry at Barclays. For the last 24 years, I've been in what has now become known as the FinTech industry. I was 10 years at a company called Mises, which is now known as Finastra. I spent 8 years driving supply chain strategy at Swift. If you want to blame someone for the bank payment obligation, that is me. For the last 4 years, I've been working for a company called Intellect, running their trade and supply chain finance business. I've held various industry positions. I was co-chair of the World Trade Board for 2 years. And I've also been responsible for introducing some ICC rules, including the URBPO. And as Patrick mentioned a little bit earlier, also the URDTT. I was co-chair of the working group that introduced that a couple of years back. So in a nutshell, that's me. Thank you.
Thank you very much, David. And ladies and gentlemen, if you noticed, as we went up, the experience, continued increasing 50 years. So thank you very much for that, David. Let's start with David. David, when people talk about supply chain disruption, the thinking and what comes to mind is physical goods, which generally require movement. Perhaps you can just start us off with your perspective about how recent developments around supply chain have disrupted the fintech space and digital supply chain.
Yeah, thanks, Robert. Well, when we speak about recent developments or recent events, I suppose the one thing that immediately springs to mind is the pandemic. And I don't think the pandemic necessarily gave birth to anything new in terms of the trends impacting the market. But what it did do was accelerate things and increase the focus on some of those trends that were there even before. I suppose I'll talk about three things. One would be digitalization. Another would be sustainability, and the third would actually be supply chain finance itself. So, we've been talking about paperless trade for as long as I can remember, and certainly during the pandemic, not only did we have instances of goods arriving in the wrong place at the wrong time, but also documents arriving in the wrong place at the wrong time, largely because people were not necessarily at their normal place of work.
Everything set up. And everything is all set up. I think what we can do is let's just see for now. Then maybe we can modify it every 26 hours.
Sorry, someone else is speaking?
Is something
Is someone else speaking?
Go ahead, David. Let's mute everybody else so that David can speak.
Yeah. Okay. I'm not sure how much of that you caught, but I was saying that during the pandemic, we not only had instances of goods arriving in the wrong place at the wrong time, but also instances of documents arriving in the wrong place at the wrong time. And since trade itself and trade finance is a business that relies on the possession of documents, up until now physical documents, that obviously was a bit of a problem. And it resulted in a number of customs authorities relaxing the rules during the pandemic so that documentation could, at least temporarily, be accepted in paperless form. So we proved during the pandemic that was technically possible. And now we're coming out the other side of the pandemic, to some extent at least, not fully, but we are coming out the other side. And I think the drive towards digital has become irresistible as a result of that. So in terms of digital trade finance, the technology has been there for some time, but what's been missing is the legal framework. Technology has never been the constraint. It's the absence of rules and the absence of a legal framework. So as I mentioned a couple of years back, I was the co-chair of the ICC working group that drafted the URDTT, Uniform Rules for Digital Trade Transactions. And that's a set of rules that supports wholly digital transactions end-to-end and complements both the UCP. I think even more significant, just last week in the UK, as you may have heard, the UK Parliament actually passed the Electronic Trade Documents Act. Now, given that a majority of world trade is conducted under English law, and given that I think there's some 54 former Commonwealth countries around the world that practice English law, it's safe to say that the passing of this bill is a watershed moment, not just for trade in the UK, but for global trade. And it is, in essence, a very simple bill. I think it barely runs to 7 pages, but crucially what it does it recognizes the notion of possession of an electronic or fully digitized instrument. So it affords the same status in law to an electronic document as it does to a paper document. So I think that is a watershed moment for global trade. The second thing I would mention is sustainability. I think there was also a debate pre-pandemic about sustainability. That debate has intensified again, and I think post-pandemic there is a desire to build back better. So there is an intense debate now around ESG, and particularly with the environments. I mean, supply chains globally are responsible for 80% of carbon emissions. So I think there are many financiers as well as trading companies around the world who are revisiting their supply chain practices with a view to adopting and enforcing ESG standards. And I'm not just referring to the E part of that, the S and the G as well. And finally, supply chain finance, again, there's been a sort of migration away from traditional trade finance that's been going on for the last 20 years. In the wake of the financial crisis of 2008, I think everybody anticipated that there would be a sort of flight to safety, that people would revert back to using that as a credit. And in practice, that is not what happened. Actually, if you look at the stats post 2008, there was a spike in demand for supply chain finance, specifically payables finance, where big buyers wanted to take action to protect their critical suppliers. And actually what we're seeing now post-pandemic is a similar spike in demand, specifically for payables finance. So I think that is something that is going to continue going forward. Thank you.
Thank you. Thank you very much for that, David, and thank you for those insights. Let's turn over to Pauline now. David has given us sort of a background, and earlier on we had in the morning around the evolution of the sector. I didn't even know that the first ATM was set up in 1967. That was some learning for me. But tell us, from your perspective and as a banker, banking and finance have traditionally been slow responders to tech. What has changed?
Thank you for that question. Going back, that statement definitely was more accurate in the past. But in recent years, we're seeing that banking and finance industry has been making significant changes, especially towards the last, let's say, 5 years. The customer has changed a lot, and the customer is more demanding. The customer knows what they want. So when you're engaging with a customer, they're the ones who are actually telling us what they want. So with that, banks have had to now step up and really try and see how they can change that narrative. You find that in the past, recently you have all these technologies coming up where we have digital banking, fintech startups partnering with banks to see what kind of solutions they will offer. We have the mobile payments. That has become, we can't function without it in Kenya. We don't know about Nigeria, what's happening in Nigeria, but here it becomes quite challenging when we don't have our M-Pesa working. There's also the element of data analytics. For leaders, which leader in this room makes decisions without any data, right? So it's helping, it's enabling us in data decision making. Also, we have the AI and chatbots. Artificial intelligence is the conversation, it's the buzzword. So we need to understand that. There's also the element of open banking and having open APIs. How? Because you find that that is not the core business for the banking institutions. That's why you need the fintechs. That's their core business, partnering together to bring solutions to the customers who are offering that. Now, when you look at some of the traditional model, what was happening in the traditional model space? We had physical branches, we had a lot of paper-based transactions, and banks, we love our paper. Filling out forms for this, filling out form for that when you're visiting the branch, or even when you have, there's an element of where customers are used to the relationship management, but that narrative changed during COVID. Because you couldn't go to the branches anymore. So now you have to start thinking differently. How do you reach this customer? Then there was the limited hours of operation. I remember back in the day, banks used to close at 1. Now today, you have extended hours depending on where you're located. So those are some of the things that we have seen changing quite a bit. And also there's limited product offerings. With a customer today, I like to say, what is the differentiator, bank on bank, with all the 40 plus banks that we have out there? So you find that there's an element of, say, looking at the conversation with the customer and saying, okay, what personalized service can we offer? As much as you're doing now relationship management, it's gone to a step further. It's where the customer is having a relationship with the device. The device is actually talking to the customer in terms of what is their anticipated next move. So you can see that this customer has a lot of deposit. When you look at this, what we call predictive analysis, it gets to that and it says, okay, the next best offer is a mortgage for X. So that's where we're going a lot in this. And also the other element is around security and regulations. A lot of the time you find that our regulator, Big Brother, they're there to protect the customer. We have to work within those policies. And I remember the chair mentioned that earlier on. We cannot negate the policy, but at the same time, let's walk in step with the customer. And then you find that there's this whole generation Z, Gen Z, coming up in Gen A. And I believe Odela will speak about that. They are demanding to have things instantly. Some like to call them microwave generation because they want everything instantly. So how do you do that? Is offering that digital bank. They don't want to go to the banking halls anymore. They want to be able to do everything at their fingertips. And of course, we have the rise of fintechs. And of course, the finance team, what do they want? They want cost efficiency. So what are the challenges that we've had to deal with in the banking sector? I talked about the data analytics and personalization, but there's also the element of enhanced security and fraud detection. That is an industry by itself that's coming up. There's a cultural shift and also the competitive pressure that's ongoing. As a result of all these factors that I've mentioned, you find that there's quite a significant impact in Africa. And it's really addressing the financial inclusion, looking at all those parameters and see what is it that we can do differently. I talked about the youthful population. There's such a youthful population in Africa and tech savvy. Average age, we're looking between 25 and 35. They're the ones who are really telling us what to do. And with that, there's opportunities to come up with new solutions that really in this sector that we're talking about. So that has forced banks to start thinking outside the box and partnering with the tech companies that are there. Thank you.
Thank you very much for that, Pauline. And I think that gives us a good segue to get into, to go to Lotana. Pauline talked about startups, the opportunities that exist. From your perspective, as somebody who is in the fintech space, what's been your experience and what are your views around the demands by investors, especially given the return for investment, the short cash runways and so on and so forth? What's your perspective around that?
Yeah, thanks a lot. I think that at the end of the day, if we think about it in itself, regardless of what you're doing, you are a business that is set out to maximize shareholders' value. Regardless of if you're in SureTech, if you're a FinTech, or whatever it is you are, at the end of the day, at the core of it is a business. And we all know that fundamentally a business is set up to ensure that shareholders' value is maximized, but at the same time balancing that with impact in itself. Now, as we get into what we have now come to know as the VC winter in itself in the tech space. I mean, this has happened over the last 18 months. We've seen, venture capital funding in, globally and even in the region dry up and perhaps would even continue for the next 18 months in itself. It is now time for, and I think I sort of like spoke to that earlier when I was giving my address. It is time for the tech companies, the fintech companies, to then look and learn from, the more traditional financial institutions that exist, and then dig in deep and, taking lessons for resilience, right? What does that mean? It means now being creative as to what does it look like when you think about new funding sources. I mean, Pauline mentioned, avenues for folks to access capital in the Web3 world through crypto and the rest of it. But beyond that is also for businesses to really dig deep and innovate and bring up products that serve customer needs. And at the end of the day, commercialize it. And as we think about it in itself, it's also streaming down operations to be lean and mean in itself. An operation which means that you can maximize and sweat out return on capital employed for every naira invested, or kobo or shilling or pound or dollar invested in running the business in itself, right? And when we think about that in itself and we adhere to the fundamental principles of capital efficiency and commercial viability, we'll then find that the issues, and of course, thinking about that as well in the context of profitability, high growth, high revenue, but also profitability. You don't want a situation where you're spending $500 million to get $50 million. The unit economics is skewed negatively when you think about it in that way. But then when you think about the fact that, hey, these are investors who have put in hard capital, we have put in work and put in sweat into this, then we need to make some returns to show for that. So I think now we need to flip the lens and then focus on impact, innovation, and then solid commercials, and unit economics in itself. Thank you.
Thank you very much, Latana. Allow me to now bring in David and Demola. Let's start with David. We've heard about the fintech response, at least from an African perspective, and we just wanted to find out from your perspective, given that fintech has really been associated with the emerging markets, Africa and Asia, how is the West responding to the digital trade finance and supply chain disruptions? David. Let's try and unmute David. Okay, we'll come back to David. Perhaps Demola, you can give us your perspectives around the response in Africa. Demola?
Hi.
Okay.
Sorry, I
okay.
think they...
Okay, David, go ahead.
Yeah, I was not able to unmute myself, so I was waiting for someone to unmute me. I hope you can hear me now.
Yes, go ahead, David.
Okay, so I began the response to the previous question by saying that the trends coming out of the pandemic were not necessarily new. And I'll begin by answering this question also by saying that fintechs are not new. I think the term fintech itself is relatively new. But if we think of fintechs as being companies that are involved in the creation of financial technology, that's what fintech means, right? Financial technology. Those companies have been around for more than 50 years. I mentioned in the introduction, I used to work for a company called Mysis, now Finastra. That's a 50-year-old company, a $2 billion company. And I now work for Intellect, which is a 30-year-old company and a $1 billion company. So, someone said to me the other day, David, you've been in fintech since before there was fintech, which is true because I think the term fintech itself has sort of evolved into our vocabulary, largely as a result of the emergence of a plethora of fintech startups. And we tend to associate this word fintech with startups that have kind of grown and grown over the past 10, 15 years or so. And today, we speak of a trade ecosystem, right? Which to some extent does rely upon collaboration between the banks and those technology companies. And I think one of the previous speakers alluded to that it's not a competitive environment, it's a collaborative environment. And certainly the industry that I work in, it's unlikely that a bank will obtain a complete solution from any one service provider. It's likely to be a collaboration. So, for example, the architecture I've designed at Intellect uses open APIs that Pauline referenced earlier to exchange data with a whole host of fintech partners who collectively contribute to my ecosystem. I have a partner called Money2Go that has a system that detects duplicate invoices as a means of preventing fraud. I have a partner called Coriolis that does data analytics related to ESG compliance. I have partners that can support the distribution of risk. I work with SDocs to support paperless trade. I work with Inigio to support digital trade instruments. I have another partner that has a solution to manage the RFQ process and to channel MT798s. FinTech development confined market. It's not. I see it as very much a global phenomenon, and given a collaborative world, we need to work together with the tech community to deliver value-added solutions that will drive innovation forward. And certainly, when we design solutions, we sell software to banks essentially. So we're trying to service the needs of the bank. But when we design those solutions, we always design them with the end user in mind. So, we service the needs of the bank and the bank services the needs of the corporate. So we try to design solutions that are composable, that are extensible, that are flexible, always with the needs of the end user in mind. Thank you.
Thank you very much, David. Demola, any additional insights into that?
Okay. Thank you so much, Robert. What I would like to say, if you look at what has happened in Africa over the last 20, 30 years, or even more, is the fact that, the cost of doing business, the stress of doing business has been quite high. And what you would note is that necessity is always the mother of invention. Like I always say, fintech has been there in the West at a very low level, but because of the need that Africans had to scale up and to get things done quickly, to reach out to more people, which banks, by their traditional nature, were not able to rise up immediately next to the emergence of series of startups in the tech area. If you look at countries like Nigeria, that is quite dispersed and quite large, with a lot more population in the extremes of the country, there's no way a commercial bank, would go and set up an infrastructure in that area because it would never cover the cost. So it led to the development of these fintechs, boutiques that have come up and become significant players in the industry. So for us, from the way I look at things, necessity made it important, made it imperative for these fintechs to come up. Now, when you look at it from the West, well, to a lot of them in the West, in the Western world, I believe I was having an interaction with a couple of people in the US a while back. They were shocked about what was achieved in Africa, particularly in this area, what M-Pesa had been able to do and what some selected companies have been able to achieve in this area. So right now, most of them are actually playing catch up with us in Africa. They are playing catch up. They're trying to find out how did they do it? How are they able to move at this pace within a very short period of time? But I think the most important thing for us in Africa, particularly in the area of trade, is to do a lot more with ourselves, which is why I love the idea of AFTA when it came up. We need to do a lot more with ourselves. We need to actually more or less indigenize and localize some of these things that we've done. Most countries are borrowing and learning from Kenya. Most countries are learning from what has happened in Nigeria. But I think we need to expand that knowledge base and create a room for us to trade within ourselves, to collaborate within ourselves. to do things that will continue to give us an opportunity to penetrate more into the interiors of Africa. And I tell you, if we do this well, we'll rise up as a financial giant that is expected of Africa to be. Like I said, many new ideas, many new innovations are coming up around today. Sometimes when you talk to your colleagues in Europe, how did you do it? How did you get there? They're quite surprised. But I think there's still a lot more to be done. Maybe because we are coming from a very low level of development in this area in the past, which we believe working together, collaborating, like David had said, will help us to achieve that objective. But there's still a lot more to be done, which we believe will enhance trade within us. Look at most of the trade platforms that we have today. It's between Africa and the West and the East, and China and co. We need to develop platforms, which is what the people in the fintech area should look at, that will facilitate easy trade between Nigeria and Kenya, Nigeria and Ghana, Nigeria, all the countries in Africa. You want to send money today from Nigeria to Kenya, he has to first of all go to Citibank in New York before he comes back to Nairobi. How does that work? We need to develop infrastructure. We need to develop systems that will facilitate us doing business, which is one of the things Africa is talking about. But I believe we're going to get there. The pace of growth, the pace of advancement that we have seen in the last years have been quite encouraging. But I believe there's still a lot more to be done. Eventually, we'll become the envy of the West, I believe. David, don't mind me, but I believe we're going to be the West very soon. Thanks.
Welcome.
Thank you, Demola. Indeed. Now, just staying with Demola, so we're talking about banking, but fintech, when you talk about fintech and insurtech, what kind of opportunities do you see around that, especially when you talk about deepening insurance penetration in Africa? Demola?
Okay. Yeah, thank you so much. If you look at insurance penetration in Africa, is the least of all the continents in the world. Most Africans still don't believe in insurance, particularly at the retail side. Insurance today is more prominent at the corporate end. Most individuals, most people don't have, until we started doing health insurance in Africa, most people don't even have any insurance at all. With insurtechs coming in now, basically piggybacking on the success that we have achieved in the financial services, the banking area, in the payments area, I believe a lot could be done. I was reading a case study about a year ago of a couple of guys in the UK, the Marshmallow Brothers, who came up with a car insurance and became very dominant within a very short period of time. The basic level of looking at what has happened in the financial services industry, where you look at micro pensions, micro insurance, still something that a lot has to be done. Change has to happen, a lot more education has to happen. I recall one of the things that continent, Australia to be specific, is investment educating people who know that are put to them from taking insurance to cover their life, their asset, their company. That's in Africa. Again, we are slow, but said what happened in the area of fintech, the pace of growth became quite fast. I believe the moment on the population and given everything that we've seen in Africa, we're going to catch up eventually. But the fintechs have to play a lot of role. The large insurance, I said earlier, cannot go to the area and sell these products, educate the guys, that the people in this area, because of the dispersal nature of the population, and get them to come onto it. Like I said, the potential, just as we see in banking, is quite huge also in the area of insurance. And we believe that it is these small insurance companies that have been put in technology that will be able to do that at the cost that will still be profitable to them. Thanks.
Thanks, Demola. We apologize for the interruption in terms of the internet, but Lotana, you wanted to add something to that?
Yeah, thanks a lot for that. I think that, to be honest, one of the things we need to do in itself is to harmonize these things. I find that there is so much fragmentation, right? When you think about, hey, you need to bank people, you need to provide financial services, and at the end of the day, you have to tell people to come take up insurance for different things. And sometimes in doing that, to effectively serve people is to do two things. One is to educate them on the importance of these things, and also embed it. And I think this is where embedded finance comes in. Embed it in a way that it is seamless for them to gain access to these things. Now you think about, the normal mom and pop shops, the dukas, the small, businesses or merchants who are probably, off taking from large, distributors and trying to, to sell, but they don't have the understanding or don't really have the consciousness to understand that, hey, really, you're just one disaster away from losing everything you've worked for. But in embedding that and pricing that into the product in a way that, again, and that's why we speak about humanity and how we think about things, in a way that is customer-friendly and customer-centric in itself, means that we can deepen insurance penetration across the continent in itself. So I think really it's two things: embedding it in a way that is seamless for people to gain access to, and at the same time educating them over and over again. And I think it is now up to the big corporations, the big banks, the big insurance companies, and the big fintech companies really to actually create a part of their budget that really speaks to education for the people who really need these things. Because at the end of the day, without being able to provide these services to people, no matter how much innovative, there's no adoption or uptake, then it's really useless. Thanks.
Say something on that. You know, when you look at insurance and the scale of the people and the potential that you can tap into that, that's where the opportunity is, if there was collaboration. Collaboration not just within a bank and an insurance company, but the ecosystem around it. So for example, it's very annoying for a customer that they have to go and provide their KYC, or they have, if there was a way within the framework that allows you to for the customer to keep upgrading to the next service. So if you open an account, you're considering, let me get into insurance. Making it easy for the customer and creating a seamless operation, that is that's going to be the game changer. As much as we are educating, we're educating the population on the necessity, there's this other part of making sure that it is integrated. I find that's where the opportunity lies, because the numbers are huge and there's an opportunity to make impact, like Latana said. Thank you.
Right, thank you very much, Pauline, for that. And ladies and gentlemen, if you've got any questions, please raise your hand and we'll get a microphone over to you. For our delegates online, if you've got any questions, please type it onto the chat and we'll come to that. Pauline, let's stay with you. You talked about, you and Latana talked about seamless integration. Is there a cause for concern from a regulatory perspective, especially when you think about the foray between telcos and the banking sector and fintechs?
Most definitely, and that's why we have to think differently. We've always stayed in, I call it the silo mentality: banking, insurance, fintech. Now, why not call it financial services like it is and provide that possibility to channel that journey? You'll find that when fintech are developing something, they have developed that persona of what this customer wants and what they expect. Likewise, the same thing is happening in the bank. Same thing is happening in the insurance, but it's the same customer. So why are we subjecting the customer to that extra during this journey? Now, and that's why I'm saying thinking differently, we look at it from an ecosystem point of view. What can we deliver together? We have, within the banking sector, you find sometimes they have the archaic systems. When it comes to the fintech, they're agile. They create. It's almost like they create on the spot. I know that's not true, but it would appear that way in comparison to the bank, because the bank will take quite a long time because they don't have the expertise. So where is that collaboration and synergy that needs to happen? That's the way I'd look at it. Yeah.
Yeah, I think I agree to a very good extent with Pauline, right? And I think, to be honest, as we speak about, the convergence of and the synergy of ideas, strengths, and everything, right? I think if we think about it from growing the ecosystem, from growing Africa collectively, everyone plays to their strengths, right? And again, it's one where no one is looking to say, hey, this guy's archaic, I'd rather do it, right? If someone can, if the telcos can, provide the data that means that we can seamlessly integrate into banks for better KYC or credit scoring, and then insurance can really be embedded on top of that. Why don't we create an ecosystem where everyone can come together and deliver value? at the end of the day, really, and this is why I spoke to it again in my address, is the core mission in itself is to uplift Africa and Africans regardless of where they are. It's not a race of, fintech against telcos and stuff. If we can all collaborate to deliver value, actual value, in a way that is closed loop, integrated, right, and seamless, then I think the sky's the limit for everyone.
Right, thank you very much for that, Lotana. Any question from I see no question, or we have one question there. With these issues of hacking, how safe are we with the electronic payments and our electronic signatures? Is it possible for someone who has hacked to obtain this data and impersonate anyone? And I think that question is coming in. If you look at today's Business Daily, there's a huge issue. Actually, the headline is around cybersecurity and cyber attacks, and the distributed denial of service. Pauline, is there a cause for concern there?
Most certainly. And why is that? When you look at how banking has evolved, fintechs have evolved, the hackers are not sleeping. They're awake, getting smarter and smarter. What does that mean? Within the regulatory space and also within the innovative, the technology, this is where now they need to be 10 steps ahead of the hackers. So it will always be this tug of war, because every time you create something, there's somebody who wants to destroy by being the hacker. When you look at these hackers, they're actually expertise. There's some institutions today, they hire hackers so that they can be the one preventing the hacking happening in the institution. So those are some of the things. How do we think differently? These hackers, what is it that they keep penetrating? We might solve the problem today, especially that it was announced with e-citizen. Yes, we'll solve it today. But tomorrow there'll be somebody smarter. Those are the people now, we need to tap into those if we can, because they know, and there's something that we can learn from them in terms of making sure that it's something that we are constantly developing. Look at back in when mobile started operating in this country. It was so expensive to buy that mobile phone. Back in the day, it used to be 250,000. Now you can get a kabamba, for 2,000 shillings. Things have evolved. So in the cybercrime world, it is also evolving. So we must be constantly conscious of that as we're developing the technology.
Thank you very much for that, Pauline. I want to bring in very quickly Lotana and Ademola, just to hear your perspectives. And perhaps you can start with Ademola as a banker, and then we go to Lotana from industry perspective. Ademola?
Robert, when I started my career in the industry years ago, there was nothing like cybersecurity. The greatest risk that bank faced then was credit risk. If you look at most banks that collapsed in Africa in those days, was because insider-related credits, bad loans, non-performing loans. In actual fact, prudential guidelines then that were issued by banks then was on classifying loans. Today, the issue is no longer bad loans. The issue is cybersecurity. In actual fact, some jurisdictions are now making cybersecurity knowledge a mandatory skill for people to be admitted onto the board of financial institutions, particularly in Canada. They're saying now that somebody with knowledge in cybersecurity area must be on the board. So there is a change, basically responding to what Pauline has described as the emerging trend in the market. Today, as a bank or as a financial institution, if you don't make sufficient investments in protecting yourself against these cyber crimes and recruiting and training people to adequately man that area, you're going to be out of business very soon. Because with just one single event, you can lose your entire balance sheet. Whereas in the case of loans and advances in those days, you can't lose your entire balance, you only lose that loan, and you can provide and pursue that loan and get coverage. You have security that you can sell. But in the area of cybersecurity, there's nothing to sell. The money is gone. And the way it happens, it gets filtered away so quickly that you lose the entire trade. You will not even be able to trace the money. Now, what does that portend to us in the industry? It means that banks or financial institutions generally would have to invest significantly in acquiring the relevant infrastructure to protect their systems, protect their data, protect their infrastructure, protect their customer, protect everything in the ecosystem. Because with only one single event, the bank the institution can be under the water. That's one. Two, it also means that there must be constant and regular training. You can't say you can never be there. Just like Pauline had mentioned, it's a moving target. So you have to constantly invest, constantly innovate, constantly catch up on what is going. And finally, you must continue to constantly share information with other players in the industry. You cannot exist in isolation. You must continue to learn from what has happened to A, to B, to C, so I can strengthen your system. So really, while the question is very apt, and that's what most people are thinking about right now, operators must actually think extensively. Like I said, regulators are also catching up. Central banks are beginning to make it an issue. In actual fact, in most jurisdictions, you have to have a committee now for cybersecurity committee. I remember about 3 or 4 years ago, CBK came up with a circular on cybersecurity for banks. So most institutions or most countries are coming up with similar things now, and it's quite critical. So to the customers, I think we'll continue to try to protect you. We'll continue to try to educate you, because most of these instances also, customers they also fall prey. Some of them will supply their passwords, supply their token, do certain things, click on certain things you don't have clicked on. I think needs for education, both internally and externally, to the customers, to the operators, and everybody. We all need to be educated and heighten, our binoculars to ensure that we see things properly and we analyze things properly before we just run into this problem. But it's a real problem that we need to work on. Thanks.
Thank you, Demola. Latana, very briefly, as we look at any other questions that might have come up.
Yeah, thanks. And I think I agree with Pauline and Demola to a very good extent, right? And I think beyond just, ticking regulatory boxes just to satisfy the conditions for your license and stuff, there is a very solid need for us to become responsible institutions, right? Which means that we need to, again, massive investment in cyber security, infrastructure security, as well as data security, because with all of the things we speak about, we hold so much data, which means it's our duty to ensure that we safeguard the data and not let the data fall into the wrong hands or be used for negative things. I think that's it. And beyond that as well is also the responsibility of institutions to actually invest in the collective growth, development, and education of Africa and Africans, to ensure that, one, the people, the customers, are always abreast and understand the fact that, there are these attacks that can happen to you and the value that you hold in this ecosystem. And then secondly, ensuring that we continue to invest as much as possible collaboratively with educational institutions, so that there's enough talent for us to pull from when we need to resource our cybersecurity teams, our data protection teams, and all of that type of stuff. Thanks.
Excellent. Thank you very much, ladies and gentlemen. In view of time, I will request to bring this to a close, and perhaps we can hear closing remarks very briefly in half a minute. David, your final thoughts?
Collaboration. And I think that's the way forward. It's collaboration across the piece between all of the stakeholders, and that is the way that we will take this business forward. Thank you.
Thank you very much, David. Demola, there was a question about what your journey has been around establishing Optimus Bank. Perhaps you can give us your closing remarks as you address that very briefly. Demola?
Okay, thank you so much. It's not always very easy to set up institutions in Africa. Lots and lots of challenges, lots and lots of roadblocks here and there. But again, one thing I've learned in my career is that with focus, with determination, with resilience, you get what you want to do done. Like I mentioned earlier, I spent about 22 years in Ghana Trust Bank, setting up all the subsidiaries across Africa and Europe. That experience was also quite handy for me when I left GT Bank to start Optimus Bank. It was tough, like I said, but again, we determined, and again, having the right people around me, I think I'm quite blessed. I have very good people who I've either worked with in the past or I've trained in the past, who have sacrificed whatever they're doing to come and join me, and it's been quite interesting. So really tough, but it's fine. It's only when it's tough that real men or real people come up. So that's what I've seen. On my final note on this discussion, I think what I would like to say is that there's a lot of room for us in Africa. Africa remains a fertile ground that there are a lot of things will happen. What we need is to work together, collaborate and think through and actually sit back and see what we need to do. We are too dependent on the West and the East. We need to sit down and look at things internally and see what we can create. Like I mentioned earlier, we need to do a lot more with ourselves. We need to do a lot more within Africa. If you look at the population of Africa and the potential in Africa, it's quite great. The trade that can take place within the countries in Africa is massive. The opportunities is massive. The food shortage that we have in Africa can actually be addressed if we work together and collaborate. Some sections, some regions in Africa have what it takes, some don't have. We need to collaborate and work together to see how we can address some of this. And that's why I want to thank ICC Kenya for organizing this. We need to work together. All the ICCs across the country need to work together to enhance trade. We are not politicians, we are business people. Let's see how we can educate the politicians on how to do things right and do things well to support the growth of the African economy. Thank you so much, and I wish you all the very best.
Thank you very much. Demola, we shall definitely try and educate the politicians. Let's go to Lotana. Lotana, your closing remarks?
Yeah, I think really it's back to the spirit of the conversation, which is to foster collaboration across the ecosystem, ensuring that where we can collaborate, let's collaborate. Again, the mission is one, beyond balance sheets, beyond profits, beyond revenue, which is really important, is the commitment to further and push the African race forward. So providing innovative solutions that takes Africans from 0 to 100 is really the core responsibility of everyone. So as much as possible, let's collaborate, let's engage with each other, and then let's find ways to really move the agenda, the African agenda forward. Thank you.
Thank you very much, Lotana. Pauline.
I pose a question to the audience. Who are we creating for? Innovation is the unrelenting drive to break the status quo and develop a new where few have dared to go. That's our opportunity. Now, for us to achieve that, we talked about the need for training, recruiting, and capacity building. It's a moving target. So as technology, as innovation is coming, we equally must invest in training the ones who are coming and coming into the workplace to attend to this new technology we have put in these institutions. That has to be hand in hand, that we have thought that through when you're putting together these innovation strategies. Thank you.
Thank you very much, Pauline. Ladies and gentlemen, let's give our panelists a round of applause. Thank you very much, Pauline Masharia, Director, Customer Experience, State Bank of Mauritius. Thank you very much, Lotana Julian, CEO, Advancedly. Thank you very much, Ademola, CEO of Optimus Bank. And thank you very much, David Henna, Head of Trade and Supply Chain Finance at Intellect Global Transaction Banking. Thank you very much, ladies and gentlemen, for your time. It's been a great conversation. I think we are going to embed solutions and collaborate. Thank you very much. Back to you, Fred.
Let us appreciate our panel as they go down to their seats. Appreciate our moderator, Robert, for a wonderful job done. Thank you. Thank you very much. At this point in time, I'd like to appreciate our online team. We have around 50 people who are joining online. I think there are 50 people who are joining online. We want to welcome you more sincerely to this seminar that we are having today. I think we are doing well on time. It's just about 10:30. At this point in time, we are going to take a break, 30 minutes break. We will converge here at exactly 11 a.m., where we shall have 2 panel sessions. So I want to thank you, and I look forward to seeing you after the break. Thank you very much. I think, Robert, what we will do for the first panel, there are certain questions which were not answered. I think maybe you can work with the panel just to ensure that we have responses to those questions. Thank you very much. Yeah, thank you. So we meet at exactly 11 a.m. as we continue with the seminar. And welcome again. Thank you. It seems you don't want to leave. Can we continue? Thank you.
important tool for poverty alleviation in helping people grow because it gives people access to things the ordinary could not afford by boosting their purchasing power.
One of the major challenges that businesses across Africa face today is the lack of access to funding.
There's a huge gap in the consumer credit market. A lot of people who need credit to optimize their lives can't access it because even though they are theoretically credit-worthy, they can't provide concrete credit ratings that prove they are trustworthy.
Opportunities are plentiful, but there is the issue of having the funding to rise up to those opportunities and deliver excellent.
When you look at a lot of advanced societies today, you realize that the availability of credits is what has powered a lot of their progress and success.
At Advancely, we pride ourselves in providing support to our progress partners by providing them with debt funding to grow, scale.
Pay Later provides instant access to credit by enabling people to buy now, pay later.
CREPAL provides credits to help people meet important obligations when they need to.
Marketforce was founded in 2019 to digitize retail trade for emerging markets by enabling consumer brands to grow their distribution network across Africa.
When you're looking to solve a problem in the market, especially when you're just starting out, financial partnerships are crucial to unlocking potential. Financial partnerships, like what we have with Advancely, provides us with the fuel we need to make large strides forward.
Finding a finance partner that backs you with debt capital you need to fuel your business model is great. However, being in business with one that has been completely invested in our growth journey has been truly inspiring.
Advancely understands like what it is like to operate an African market with all of its peculiarities.
With Advancely, we are supported with tangible and intangible things that give us the confidence to chase our goals with precision.
Beyond finance partners, we are progress partners, working to build a world where access to money is not a barrier to progress.
It has been incredibly important to have a partner like Advancely, who understands what it takes to operate across African markets, shares our ambition for growth, and can keep pace with our evolving needs.
You are so grateful to have been given the opportunity to try. That's what a lot of entrepreneurs need to succeed. The opportunity to try and people who will take a chance on them and give them that opportunity. We've been fortunate on our journey to find people who have taken a chance on us, like our finance partners at Advancely.
Tool for poverty alleviation in helping people grow because it gives people access to things the ordinary. Credit is an extremely important tool for poverty alleviation in helping people grow because it gives people access to things the ordinary could not afford by boosting their purchasing power.
One of the major challenges that businesses across Africa face today is the lack of access to funding.
There's a huge gap in the consumer credit market. A lot of people who need credit to optimize their lives can't access it because even though they are theoretically credit-worthy, they can't provide concrete credit ratings that prove they are trustworthy.
Opportunities are plentiful, but there is the issue of having the funding to rise up to those opportunities and deliver excellently.
When you look at a lot of advanced societies today, you realize that the availability of credits is what has powered a lot of their progress and success.
At Advancely, we pride ourselves in providing support to our progress partners by providing them with debt funding to grow, scale.
Pay Later provides instant access to credit by enabling people to buy now, pay later.
CREPAL provides credits to help people meet important obligations when they need to.
Marketforce was founded in 2019 to digitize retail trade for emerging markets by enabling consumer brands to grow their distribution network across Africa.
When you're looking to solve a problem in the market, especially when you're just starting out, financial partnerships are crucial to unlocking potential. Financial partnerships, like what we have with Advancely, provides us with the fuel we need to make large strides forward.
Finding a finance partner that backs you with debt capital you need to fuel your business model is great. However, being in business with one that has been completely invested in our growth journey has been truly inspiring.
Advancedly understands what it's like to operate in the African market with all of its peculiarities.
With Advancedly, we are supported with tangible and intangible things that give us the confidence to chase our goals with precision.
Beyond finance partners, we are progress partners, working to build a world where access to money is not a barrier to progress.
It has been incredibly important to have a partner like Advancedly, who understands what it takes to operate across African markets, shares our ambition for growth, and can keep pace with our evolving needs.
We were so grateful to have been given the opportunity to try. That's what a lot of entrepreneurs need to succeed. The opportunity to try and people who will take a chance on them and give them that opportunity. We've been fortunate on our journey to find partners who have taken a chance on us, like our finance partners at Advancedly.
Credit is an extremely important tool for poverty alleviation in helping people grow because it gives people access to things the ordinary could not afford by boosting their purchasing power.
One of the major challenges that businesses across Africa face today is the lack of access to funding.
There's a huge gap in the consumer credit market. A lot of people who need credit to optimize their lives can't access it because even though they are theoretically creditworthy, they can't provide concrete credit ratings that prove they are trustworthy.
Opportunities are plentiful, but there is the issue of having the funding to rise up to those opportunities and deliver excellently.
When you look at a lot of advanced societies today, you realize that the availability of credits is what has powered a lot of their progress and success.
At Advancedly, we pride ourselves in providing support to our progress partners by providing them with debt funding to grow and scale.
Lipa Later provides instant access to credit by enabling people to buy now, pay later.
CredPal provides credits to help people meet important obligations when they need to.
MarketForce was founded in 2019 to digitize retail trade for emerging markets by enabling consumer brands to grow their distribution network across Africa.
When you're looking to solve a problem in the market, especially when you're just starting out, financial partnerships are crucial to unlocking potential. Financial partnerships, like what we have with Advancedly, provides us.
Credit is an extremely important tool for poverty alleviation in helping people grow because it gives people access to things the ordinary could not afford by boosting their purchasing power.
One of the major challenges that businesses across Africa face today is the lack of access to funding.
There's a huge gap in the consumer credit market. A lot of people who need credit to optimize their lives can't access it because even though they are theoretically creditworthy, they can't provide concrete credit ratings that prove they are trustworthy.
Opportunities are plentiful, but there is the issue of having the funding to rise up to those opportunities and deliver excellently.
When you look at a lot of advanced societies today, you realize that the availability of credits is what has powered a lot of their progress and success.
At Advancedly, we pride ourselves in providing support to our progress partners by providing them with debt funding to grow and scale.
Lipa Later provides instant access to credit by enabling people to buy now, pay later.
CredPal provides credits to help people meet important obligations when they need to.
MarketForce was founded in 2019 to digitize retail trade for emerging markets by enabling consumer brands to grow their distribution network across Africa.
When you're looking to solve a problem in the market, especially when you're just starting out, financial partnerships are crucial to unlocking potential. Financial partnerships, like what we have with Advancedly, provides us with the fuel we need to make large strides forward.
Finding a finance partner that backs you with debt capital you need to fuel your business model is great. However, being in business with one that has been completely invested in our growth journey has been truly inspiring.
Advancedly understands what it's like to operate in the African market with all of its peculiarities.
With Advancedly, we are supported with tangible and intangible things that give us the confidence to chase our goals with precision.
Beyond finance partners, we are progress partners, working to build a world where access to money is not a barrier to progress.
It has been incredibly important to have a partner like Advancedly, who understands what it takes to operate across African markets, shares our ambition for growth, and can keep pace with our evolving needs.
We were so grateful to have been given the opportunity to try. That's what a lot of entrepreneurs need to succeed. The opportunity to try and people who will take a chance on them and give them that opportunity. We've been fortunate on our journey to find partners who have taken a chance on us, like our finance partners at Advancely.
Credit is an extremely important tool for poverty alleviation in helping people grow because it gives people access to things the ordinary could not afford by boosting their purchasing power.
One of the major challenges that businesses across Africa face today is the lack of access to funding.
There's a huge gap in the consumer credit market. A lot of people who need credit to optimize their lives can't access it because even though they are theoretically creditworthy, they can't provide concrete credit ratings that prove they are trustworthy.
Opportunities are plentiful, but there is the issue of having the funding to rise up to those opportunities and deliver excellently.
When you look at a lot of advanced societies today, you realize that the availability of credits is what has powered a lot of their progress and success.
At Advancely, we pride ourselves in providing support to our progress partners by providing them with debt funding to grow and scale.
Lipa Later provides instant access to credit by enabling people to buy now, pay later.
CredPal provides credits to help people meet important obligations when they need to.
MarketForce was founded in 2019 to digitize retail trade for emerging markets by enabling consumer brands to grow their distribution network across Africa.
When you're looking to solve a problem in the market, especially when you're just starting out, financial partnerships are crucial to unlocking potential. Financial partnerships, like what we have with Advancely, provides us with the fuel we need to make large strides forward.
Finding a finance partner that backs you with debt capital you need to fuel your business model is great. However, being in business with one that has been completely invested in our growth journey has been truly inspiring.
Advancely understands what it's like to operate in the African market with all of its peculiarities.
With Advancely, we are supported with tangible and intangible things that give us the confidence to chase our goals with precision.
Beyond finance partners, we are progress partners, working to build a world where access to money is not a barrier to progress.
It has been incredibly important to have a partner like Advancely, who understands what it takes to operate across African markets, shares our ambition for growth, and can keep pace with our evolving needs.
We were so grateful to have been given the opportunity to try. That's what a lot of entrepreneurs need to succeed. The opportunity to try and people who will take a chance on them and give them that opportunity. We've been fortunate on our journey to find partners who have taken a chance on us, like our finance partners at Advancely.
Credit is an extremely important tool for poverty alleviation in helping people grow because it gives people access to things the ordinary could not afford by boosting their purchasing power.
One of the major challenges that businesses across Africa face today is the lack of access to funding.
There's a huge gap in the consumer credit market. A lot of people who need credit to optimize their lives can't access it because even though they are theoretically creditworthy, they can't provide concrete credit ratings that prove they are trustworthy.
Opportunities are plentiful, but there is the issue of having the funding to rise up to those opportunities and deliver excellently.
When you look at a lot of advanced societies today, you realize that the availability of credits is what has powered a lot of their progress and success.
At Advancely, we pride ourselves in providing support to our progress partners by providing them with debt funding to grow and scale.
Lipa Later provides instant access to credit by enabling people to buy now, pay later.
CredPal provides credits to help people meet important obligations when they need to.
MarketForce was founded in 2019 to digitize retail trade for emerging markets by enabling consumer brands to grow their distribution network across Africa.
When you're looking to solve a problem in the market, especially when you're just starting out, financial partnerships are crucial to unlocking potential. Financial partnerships, like what we have with Advancely, provides us with the fuel we need to make large strides forward.
Finding a finance partner that backs you with debt capital you need to fuel your business model is great. However, being in business with one that has been completely invested in our growth journey has been truly inspiring.
Advancedly understands what it's like to operate in the African market with all of its peculiarities.
With Advancedly, we are supported with tangible and intangible things that give us the confidence to chase our goals with precision.
Beyond finance partners, we are progress partners, working to build a world where access to money is not a barrier to progress.
It has been incredibly important to have a partner like Advancedly, who understands what it takes to operate across African markets, shares our ambition for growth, and can keep pace with our evolving needs.
We were so grateful to have been given the opportunity to try. That's what a lot of entrepreneurs need to succeed. The opportunity to try and people who will take a chance on them and give them that opportunity. We've been fortunate on our journey to find partners who have taken a chance on us, like our finance partners at Advancedly.
Credit is an extremely important tool for poverty alleviation in helping people grow because it gives people access to things they ordinarily could not afford by boosting their purchasing power.
One of the major challenges that businesses across Africa face today is the lack of access to funding.
There's a huge gap in the consumer credit market. A lot of people who need credit to optimize their lives can't access it because even though they are theoretically credit-worthy, they can't provide concrete credit ratings that prove they are trustworthy.
Opportunities are plentiful, but there is the issue of having the funding to rise up to those opportunities and deliver excellently.
When you look at a lot of advanced societies today, you realize that the availability of credits is what has powered a lot of their progress and success.
At Advancedly, we pride ourselves in providing support to our progress partners by providing them with debt funding to grow and scale.
Lipa Later provides instant access to credit by enabling people to buy now, pay later.
CredPal provides credits to help people meet important obligations when they need to.
MarketForce was founded in 2019 to digitize retail trade for emerging markets by enabling consumer brands to grow their distribution network across Africa.
When you're looking to solve a problem in the market, especially when you're just starting out, financial partnerships are crucial to unlocking potential. Financial partnerships, like what we have with Advancedly, provides us with the fuel we need to make large strides forward.
Finding a finance partner that backs you with debt capital you need to fuel your business model is great. However, being in business with one that has been completely invested in our growth journey has been truly inspiring.
Advancedly understands what it's like to operate in the African market with all of its peculiarities.
With Advancedly, we are supported with tangible and intangible things that give us the confidence to chase our goals with precision.
Beyond finance partners, we are progress partners, working to build a world where access to money is not a barrier to progress.
It has been incredibly important to have a partner like Advancedly, who understands what it takes to operate across African markets, shares our ambition for growth, and can keep pace with our evolving needs.
We were so grateful to have been given the opportunity to try. That's what a lot of entrepreneurs need to succeed. The opportunity to try and people who will take a chance on them and give them that opportunity. We've been fortunate on our journey to find partners who have taken a chance on us, like our finance partners at Advancedly.
will call you. Don't worry. We have to make your entry grand. Let's settle in. It's 11 a.m. Let's settle in. It's 11 a.m. So we shall very swiftly move on. And our first session will be on debt restructuring and insolvency. And we have a panel of 3. And I'll just introduce the moderator, Desmond Odhiambo, before we start. So kindly put Desmond's profile on the screen. Okay. Desmond is an advocate of the High Court of Kenya and a partner of Cliff Decker. How do you describe it? Hofmeyr, CDH. He has over 12 years experience in providing dispute resolution and business restructuring services. He advises businesses on how to optimize their operations through debt restructuring, development of systems and structures for procurement, contracts, and human resource management. Notable experiences include advising a leading retail supermarket on how to restructure its debts and successfully negotiating a standstill agreement with multiple creditors. He is a member of the International Association of Insolvency and Bankruptcy Professionals, INSOL, and a member of the Chartered Institute of Arbitrators. Please join me in welcoming our moderator for this session, Desmond Odhiambo, who will also introduce his panel. Welcome, Desmond.
Thank you very much, Fred. I'd like to call my panelists to the stage. I can see Kereto Marima is already here. I'll ask Christine Mugenyo to join me to the stage. I will introduce them more fully once they're seated. I'd also like to invite Robert Habwe to the stage. So welcome everyone from the tea break. So the session that we have right now is on debt restructuring and insolvency. And the reason we have this panel session in this conference is because when you talk about banking and innovation, it would be remiss not to discuss how to deal with the bottlenecks in the financial ecosystem. And one of the bottlenecks in the financial ecosystem is credit risk. And one of the ways that one of the innovations that had been brought up in the legal framework to help deal with credit risk was the Insolvency Act of 2015. The idea or the purpose behind the Insolvency Act of 2015 was to come up with a framework that would encourage the turnaround of companies that are in financial distress. However, according to the Deloitte restructuring survey of 2023, a staggering 93% of the restructuring professionals and lenders interviewed said that the success rate of administration under the Insolvency Act of 2015 was less than 50% of the companies that were going into it. 60% of the respondents who were interviewed also said that they saw no change in success compared to the kiss of death regime that preceded the act. So one of the common reasons cited for the low success rate is that companies are filing for insolvency a minute to midnight when there's nothing that can really be done. So to help us unpack this and this discussion and let us know whether this is just a mere perception, whether it is a reality on the ground, is my esteemed members of the panel. And I'll start with Kereto Marima. Kereto is an accomplished corporate recovery expert with over 2 decades of experience in the East Africa region as a licensed insolvency practitioner in Kenya. He has handled several complex restructuring and formal insolvency assignments spanning several sectors such as manufacturing, hospitality, agriculture, financial, real estate, aviation, construction industries, amongst others. He has spent time also shaping the professional practice in the region, as well as provided valuable insights and suggestions to regulators and key government stakeholders in the current insolvency regime and regulations, as well as mentoring younger members into the profession. When not working, he is a keen marathoner, as well as a mountain biker, and you can tell from his physique. Then we have Robert Habwe. Robert is a registered insolvency practitioner with hands-on working experience in insolvency and receivership, with a work span of over 15 years in Kenya, Uganda, and Tanzania, where he has been involved in managing of insolvent companies and in the sale of assets. He has vast experience in exit management and liquidation of companies, and has been involved in the management of the company's business operations, pending sale, preparation of sale prospectus, estimation, realization values of various classes of assets, liaising with potential buyers, relevant government departments, and labor unions. Robert is a holder of a Bachelor of Commerce, a certified public accountant, a CPA, a member of the Institute of Public Accountants of Kenya. Robert sits on the board of Association of Turnaround and Insolvency Kenya Limited. He's also the manager financial advisory from Deloitte. Then last but not least, we have Christine Mugenyo. Christine is an advocate of the High Court of Kenya and is a senior associate at Cliff Decker Hoffmer in the business restructuring sector. She specializes in advising businesses by providing tailored solutions at every stage of the business cycle. She particularly assists businesses in adjusting their financial situations or organizational structure to align with present demands and changing business operations to maximize efficiency. She has experience in working with company directors, shareholders, financial institutions, creditors, suppliers, employers, and insolvency professionals in providing client-focused solutions while mitigating risks. So welcome, my panelists. So maybe to begin with a discussion, I would invite Kereto just to help us unpack this topic of debt restructuring.
Thank you. Perhaps it's easier if I stand here. It's a bit of a brief lesson. Remember a bit of Economics 101. Good morning, ladies and gentlemen. My name is Kereto. It's a bit of a difficult act to follow. I was in for the first panel, and everyone was talking good and positive things about fintech, the new modern things about lending and the new methods. And then you have to have, after your coffee break, the other side of lending, when things go wrong. So I will be brief, and we'll try and make it a little bit interesting, and I do look forward to a lot of engagement with yourselves on how we take things through. So, right, tech doesn't, all right. I think those of you who did Economics 101, either at A-level, O-level, or in university, if you passed through one, you do remember this. This is what every banker wants to see, the typical business life cycle, startup, your revenues going up, high growth, maturity, and generally decline. That's the general mood for, or general cycle for any business or company. And throughout the talk, I may distinguish between a business and a company. I view a company as the legal vehicle that you turn back and do carry out your business activities with, and a business as an actual solution that you provide to clients, and that's what you turn back and charge them to make revenue. So whenever you're approaching a business, an insolvency practitioner, I always stand back and ask you very early on, what's the business and what's the company? Because over years of experience, I've come to realize that those are two different things, and when you're trying to craft a rescue or decide a way forward, you need to understand where value actually is. Sorry. You all like good times. You like giving money when everyone has a nice positive story. And I think the last I checked, for very many years, our banks had been reporting an NPL of about 3% or 4%. I think it's only from last year that everybody has started acknowledging that we should be running at that. I think officially, I think everyone's results I started seeing from 31 December 2022 are talking about 14%. My personal view is that it's actually running a little bit higher than that, but I will not give any comments as to what I think the actual real number is. So the decline part is what we're going to be discussing here. And this is the decline bit of any business. And it's a function of time and the options that you have as time passes by. On the y-axis, you can see there's an aspect to do with health. So as health comes down towards zero, and as time goes further up along the end, you have a lot less by way of options available to you to actually turn back and restructure your business. If you come in early enough, not at the stroke of midnight, chances are that you may be able to get a restructuring or a discussion that is where you're in a lot more in control. If you take a lot of time and you're the owner of the business or the shareholders or the directors, please understand that the business now shifts to the people who actually hold pieces of paper called debentures and fixed and legal charges. I should have said, clarified at the end that I solely deal in the corporate insolvency segment. There's two aspects of insolvency. There's a personal bankruptcy side, and there's a corporate insolvency side that deals with actually businesses and companies. So this talk is going to be actually a lot more, or this discussion is going to be concentrating on the corporate insolvency end. If you come late, if you're the shareholder or the bank, it's not going to be driven by you. It's going to be driven by the banks and the people who actually own the paper. So I see a couple of bankers in the room. They're the ones going to be in control. So if you're a business person, you need to understand that you need to come a little bit earlier to either approach the bank, the lawyer, or an insolvency practitioner to turn back and still be in control. But seeing that this is all about bankers, since they are the ones with the money, and you've lent money, how do you actually turn back and understand when something's going wrong? The first thing for me is whenever the whole aspect of early warning signs when when things are going wrong, you start looking at the earnings decline, you look at the P&L. If somebody's actually sending you regular results, so I think every banker here, on your debenture, you simply turn back and tell somebody, one of the covenants is you need to send me management accounts and audited accounts. I don't know how many of you actually ever receive those from your clients, and if you do receive them, do you actually go through them, or are they actually the correct set, or it's just a tick box exercise? But if you look through those, you will start seeing issues to do with our earnings decline. I think we can talk openly about listed companies. So if you take a look like our favorite airline, you could see its trouble starting out from 2011, 2012, when it started running into profit issues coming down. I think, yes. And then you started seeing issues to do with balance sheet strain around there. You start seeing, if you're a banker, you start seeing covenants being broken out from a company. I do remember KQ, I think it was public. We can speak comfortably about KQ because its restructuring has been in the public domain. they kept on breaching covenants with the various financiers and always asking for extensions or concessions on some of those balance sheet covenants they had to do. I think it was interest cover and cash cover sort of thing. So you need to be looking at that sort of thing to understand, okay, what's your customer actually doing? And then you're into cash crisis. This is when you banks start seeing things. In the olden days, it was nice hearing guys talking digital things. A long time back when I started my career, checks still used to happen. And you start looking at checks hidden in drawers or checks being, I think, what is it called? R2D, refer to drawer, being bounced. If you're the one running that account, you're noticing a lot of bounced checks happening out from things. Or if somebody's on OD, he's permanently hardcore. Money comes in and 2 seconds later, money is being paid out. He's turned hardcore and that sort of thing. And you start seeing issues to do with creditors. You start seeing letters from auctioneers or somebody busy telling you basically firefighting and saying, I need to let this check go through because this supplier is not going to issue me with product and my business is going to come through. Or you start seeing cases being filed in the paper or auctioneer notices. That's a cash crisis. And then finally you come into the insolvency stage out there. Which is generally that's the formal end of the insolvency. You either start seeing judgments against the person, or if you are one of the banks in the panel, you may see another bank has jumped ahead of you, either appointed auctioneers to kick off the start of a legal charge, or if it had the rights to appoint an administrator or something of the sort, it kicks off comfortably without you. And then your risk department starts worrying. And you all start having to do those NPL meetings, and if you are the CFO, you start asking the credit risk guy, why didn't you know about this? You are now affecting my earnings that we said we were going to tell the board. So this is does affect your bonuses. But let's talk about positive things. So, and I think this is what we will discuss a lot more, which is around when you come early enough, the options are many. You're busy talking about your transformation and reorganization of your business. You are still in control as a shareholder. Your bank still wants to talk to you, probably agreeing to refinance, restructure, or term out, or give you some fresh cash, or tell you, okay, we can do one or two things together. When you're in balance sheet strain, you start talking this word, turnaround and workout. Ignore investigations, that means they no longer trust you. But workout means they're prepared to listen to your story the second time, maybe, or the first time. This is where you start having interesting fancy things like debt equity swaps or agreed and consensual asset sales, or structured or formal workouts, formal or informal workouts, depending on what they are. This is where we start having what Christine talks about, the standstill agreements, and where you're trying to tell everybody, we think we have a business here that we can salvage. We just need cooperation from everyone and a little bit of time. You never have time. That's my view over 20 years. And then if things don't work, you have the bankers just simply saying, get us back our cash. It stops moving from being control of the shareholders or directors and moves fully to the control of the bank, or the bank that actually holds the real paper. And it enforces by going through by way of a formal insolvency. And that's my 3 minutes or 4. I think to the moderator, I think I've overrun. I will leave this slide up because this is what's going to guide a lot of our discussions today and the panel discussions, and hopefully your questions. Thank you very much.
Yeah. Thanks, Kereto. I'd like us to maybe just to take to delve a bit deeper into what you described as the early warning signs. And maybe, I think one of the things that you mentioned was a breach of financial covenants, which is an early warning sign that would alert a lender that their portfolio company, is not doing so well. Perhaps maybe I could just invite Robert, maybe just to comment, from your experience, are there any other early warning signs that, a banker can look out for?
Thank you. Yes, in addition to breach of covenants, there are other signs. First, I'll start by saying any signal that comes from a data company should be taken seriously. It sometimes might look trivial, but in the long run, that signal will matter. A simple signal, just like even maybe the owner of the business, maybe getting married again, that's enough. Is enough for a banker to start questioning. Is our things like guarantees, are they still holding? There are issues like, in addition to guarantees, you'll find probably your assets also being transferred to another party who is not part of the guarantees, especially for SMEs and personal businesses, where you'll find the wife and the husband are the directors and are the ones signing your guarantees. So if another party comes in, probably your assets might disappear. So it can sound as trivial as that, but take any signal coming from the business seriously. So if you look at that curve, where the company gets at the top, as we know, as the company rises, there it attracts friends and enemies. That is the first part is going up. The friends are bankers. Bankers will all rush in to give that company money. And the enemies also will be looking at it, like the tax authorities will look at it. Can we come in and tax? This is a new product and it's going high up. And other enemies will be competitors. They'll also come in. And that's why the company gets at the top. It starts stagnating. There are many competitors. New taxes have been introduced. And bankers are also there milking it, probably getting their interest. So at that point now, when it gets at the top, there are other signs you need to look at. Why the first is the declining profits, which I think, as Kereto has already introduced there, at that point, when the profits are declining, look at the other things that come out with it. Some of the signs will be disputes with the suppliers. Of late, you have seen there are so many applications in the papers, newspapers, where creditors apply to High Court for liquidations. So those are some of the things you need to look at. Those are the signs. Once you see that the data company is having disputes with the with the suppliers, that's one. Again, disputes with customers. Once it appears in the papers or in the media, or you get a way to hear of any dispute with their customers, just know something is not going on right in their data company. Another issue is deterioration of their products, quality of products. Once it comes out there are issues, or some of the products have been thrown out of some supermarkets, please start a conversation with your data company, get to the directors and ask them what's going on. Don't just look at it as this trivial, it doesn't involve us. At that point when where the earnings are going down, in most cases, that company is paying the bank. Where profits are going down, that guy will try to ensure all the bank installments are being paid. So every month you'll be getting your check, but the company is going down. So if you don't start controlling it from there, this company will end up to the other far end, whereas Gareto put it, their chances of recovery or survival are very minimal. I think those are some of the main signs of it.
Yeah, thanks, Robert. And I like what you said about any sign, no matter how small it may appear, could be something that would help a banker take some proactive steps. Maybe Christine, also just to hear your comments, is there anything you would like to add on signs that we could look out for?
Thank you, Desmond. So another sign that you can normally look out for is in terms of the management. So what we have seen is that there are some times that you'll be able to identify from the management of the business or the company some signs that the company is not doing well. So for example, where you have a change in the management of the company. So if you have very frequent changes in the management of the company, that could be a sign that the company is on the decline and that the company is headed to financial distress. Another thing is, for example, if you have negative media coverage of the people in the management of the company, because as we know, the management is the face of the company, and so if there are issues with the directors or the issues with the CEO or the MD, then that would negatively affect the company, which could be a sign that the company is headed to financial distress. Then another thing is where, for example, in the management of the company, there is no clear or direction or focus. Like from your discussions with the business management, you can tell that they don't have a clear pathway in terms of the direction of the business. And lastly, it is also another sign is the inability of the management of the company to react to any market changes. For example, we saw a lot of companies during the period of COVID, they were able to implement changes to their business structures, they were able to be innovative. So if you have a management where they are not able to react very rapidly and quickly to these changes in the market conditions, then that could be a sign that the company is headed to financial distress. Yes.
Thank you, Christine. Some practical insights there. So maybe if I could go back to yes, Robert.
No, just to add to what my colleague has said, when key management staff start leaving, that's a very key sign that that company has issues, and the main one is the CFO.
Actually, if I could just add, for the bankers in the room, when you see, in my mind, practically not the MD sometimes, when you see 3 or 4 CFO changes, people in that finance department are walking out, particularly the good people who turn back, give you focus, the company normal. When you're on that growth cycle, and the guy who used to come and convince you to give that loan and increase and tell you, yeah, we need another 100 million, we can do it, and he's ensuring that your payments happen every month. When that guy walks out, and the team that supported him, his management accountant, the treasury person, depending on the size of the company, and you start getting an unhealthy turnover in number and also in quality. You can tell when somebody has a good finance person in there. Those forecasts are spot on. If they run into trouble, they are quick to come and tell you, we're running into trouble, we're going to miss our payment next week, but that's because of X, Y, and Z. These are people on top of the company, they know what's going on. But when they start walking out, and today you are introduced to Mr. X, tomorrow to Miss Y, to start telling you what are these finance people seeing inside there on a day-to-day basis, that they're all busy looking for work out to go. They don't see their future in that entity, and they're up and going off. So that's my view around that. Thank you.
Okay, thank you. So I mean, we have discussed and we have identified the warning signs, that a banker should look out for as a sign of distress. So maybe if I could maybe just bring it to Robert. I mean, what is the first step that a banker should do after they have identified those signs you have mentioned? You know, all of a sudden the man has changed his spouse. You know, so what should what should the banker do?
Once these signs have been, okay, the bank has noticed that, yes, I'll say the first step is having a serious conversation with the board of that company. That's the initial step. And because at the declining stage, some of the issues that might be affecting the company are things that if you discuss with the directors, maybe are things that you can solve. They are not probably long-term or something that the board might decide to implement. Let's say profits, when the profits are declining, chances are probably the costs are too high. Or it's not, the company is not capable of pushing these costs to the customers by through increasing the prices and mainly increasing the prices. So in such a situation, the company might decide to come up with some internal mechanisms to cushion its performance and move back up. But you need to get a conversation first to know exactly what it is. If it continues or it persists, then the next step maybe can follow where you can call in professionals. You discuss with the directors, you agree to get professionals to come and review the business, an independent party to come in and review the business and give proposals on the way forward.
Thank you. And as we continue with the discussion, please, for those who on our online audience, please, you can be typing in your questions and comments so that we pick them up and address them. Then, Kereto, you spoke about opportunities for saving, solutions for saving the company, depending on where it is on that cycle. Maybe if you could just expound a little bit on what you meant by business transformation.
Okay, thank you very much. Right, business transformation sounds like a management consultant's term, but just back to I'll speak to the bankers in the room around the options. It's a function of, you've got two parties in this relationship. There's you, the banker, and then there is the customer. And it's a question of who understands very early enough what is going on. If you, as the banker, have a really good risk team, and they are spot on identifying that there is a problem with this particular customer, you then try and stage where they are on this graph that I've put. Is it just a question of an earnings decline, or are we looking at a terminal case? And sometimes some of your options as a banker, you're not in this for charity. I believe all of you would like your bonuses at the end of the year. The question is, how do you turn back and resolve that problem? When the business is still turn around and generating a profit, a positive cash flow, possibly a lot more reduced than before, you turn back and look at solutions such as, if you're a tier 1 banker, do you push this fellow out of your bank politely, nudge him on along into a tier 2, and can turn back and manage him? It's not your problem. That's one possible solution. If he's still bankable elsewhere, do you turn back and push him out to become somebody else's problem? So if you are a tier 3 or tier 4 banker around in this market, you may find that sometimes you're wondering why somebody is being pushed out from a tier 1 or tier 2 bank, and you're happily taking that account. It's because they're like, look, we can see a future problem. That's out. They have managed it out of their books. The question is, when it's in your books, what are you doing about it? If it's still pretty much early on and where we're into turnaround, a turnaround is a function of, do management actually understand they're in trouble, and do they actually want to do something about it? Because when we talk about business failures in this region, I generally classify them into a couple of places. There's a straightforward thieves who've basically externalized whatever have they borrowed out from you, and they've seen that this business has its limited lifespan. And the sooner you realize that is the nature of the character of the party that you're dealing with, then you either figure out how to shift straight away that person's book out to somebody else, or start considering a quick and formal insolvency on how to just grab your securities and protect yourself, or see if you can also manage him through his theft to get you to extract yourself or shift him down. Or if there's actually a business that is viable, this is where we start talking about the standstill arrangements, or that is standstill, and standstills do generally work only if there's multiple bankers or several large creditors. If there's several small creditors, it's very hard to actually get a standstill. You need a standstill with the big boys because they're the ones who actually make a decision as to whether or not the business actually carries on. But if the business is good, then you talk about issues to do with either a recapitalization, where somebody is busy talking about if they're shareholders, they're going back to if they're listed company, going back to their shareholders to say we want to raise more money and giving a credible business plan, or trying to tap out into they try and tap out in for fresh equity or fresh funds. That would be one aspect of over recapitalization. Or two, consensual asset sales, where somebody may have surplus assets that are not required for production, or that they've just made the decision we're probably shutting down this factory, we no longer require these go-downs. We can dispose of those assets, stand back and pay down the debt. Those are a sort of financial restructuring solutions. Somebody saying, I'm going to slim down to grow, I will cut down, I'll sell assets, pay down the bank, or reinvest into a new product line to get my groove back on with customers and launch a new product, or that sort of stuff. But that turnarounds work if you actually have a viable business, and a viable business means you have a story, a product that customers are prepared to pay for and pay decent value for. Thanks.
Okay, thanks, Kereto. Now, maybe Christine, you could also just chip in. I mean, during this time when a workout is being arranged, and Kereto mentioned that there are tools that you can use to keep the creditors at bay, or rather to have a ceasefire. Maybe you could just comment, what tools are available, what the effectiveness, and so forth.
Thanks, Desmond. So I think, as what Kereto has said, the main issue is that when a company is in financial distress or headed towards that, what they need is time to be able to implement the plan to turn around. So at this point, they do not need pressure from creditors, or they don't need pressure from the bank to be able to finance, to meet their obligations, because they need time to implement the plan that they have come up with. So some of the things or some of the tools have been introduced by the Insolvency Act 2015, and also there are some other informal insolvency processes, as Kereto has talked about, the standstill agreements, which are agreements that you have with creditors for them to give you time to be able to sort of like come back to the business and be able to make money, and give you time to be able to meet your obligations. So, and in the Insolvency Act, there is a formal insolvency process called a company voluntary arrangement, which is where you enter into an agreement with the creditors of the company for them to give you time to be able to meet your obligations at the time when now you're able to have recovered. So what we have seen is that this tool, when used sometimes in conjunction with administration, which is also something that was introduced by the Insolvency Act, it gives the company or the business breathing space to be able to make a turnaround. So, so this is a very efficient tool, and I think most of you are aware that this is one of the tools that was used in the Uchumi case to be able to give the company time to be able to get back on its feet. Yeah.
All right, thanks. Maybe if I could just bring in the audience just to chip in into this discussion. Any questions from the audience in regards to either the early warning signs of insolvency, what your experience has been? Has it been easy to pick up on these signs? Or has it been, is this the first time you are hearing about it? Or maybe if you have a question regarding the workouts and when applied. I can see there's a question on the chat. So there's a question that says, Robert, it appears that there are differing standards that are deployed by the practitioners in the field, with each guided by their own understanding. What has the jurisprudence been from the courts? I'm not sure what the question is asking, unless, Robert, you have understood it. Okay, there's another question. Where is the place of the regulator in this conversation? Oh, that was okay. I think that's from the previous panel. Okay. As you think about the question on what the jurisprudence is from the courts, maybe if we can have any question from the audience. Yes, please.
Thank you. The panel, I mean, the subject was well articulated. You did justice to it. Maybe not a question, but just some contribution. There's a beautiful chart that has come up there, the beautiful diagram that was used for illustration. Well, it captures it. But a word of caution for the bankers and for everyone and for the litigating lawyers and everybody in that ecosystem is that when problems arise, when problems are triggered, and well, these warning signs, you can probably generate 1,000 of them, from bouncing checks to checks issued ending in 000s and all that, okay? But the most important thing is that each business is unique in its own way. There are no two similar cases, okay? So examine the business, examine its unique circumstances. A business in services industry, okay, does not behave the same way a business in manufacturing behaves, because they're addressing very different issues. So you may look at the structure of the business. If the business is dependent on one supplier, or the business is dependent on one off-taker. If that off-taker is, let's say, Kenya Breweries, or the supplier is, let's say, who, okay? The moment you realize that there's strained relationship between that key off-taker and your client, then that, of course, should trigger action. And the other thing is that in Kenya, again, rescue packages. I'm a banker, yes, but here we are all guilty. I don't think banks in Kenya understand what rescue packages are. And even if they do understand, the business may understand, credit may not understand this. So there's divergence there. So there's some bridging to be done. Just within banks, different units have their own understanding of things, okay? The business people, these the relationship managers and probably the director of units may understand what is going on in the business and what need to be done. And most of the time, credit will come from a textbook theory, kind of things, and then things don't work. So rescue package is where, yes, somebody has sinned, somebody has defaulted, but you examine the circumstances and you're still willing to even give him more money so that he comes out of this. I don't think the average Kenyan bank is at that level of thinking. Thank you.
Okay, Kerito, you'd like to make a comment to that?
Thank you. I don't want to offend the bankers in the room, as I still do require business and you're my customers. But I must agree, my interaction over the years has shown that there is an, I'd call it an interesting push-pull or tension relationship in the banks between the business team and the risk team. The business team are obviously remunerated from selling loans and pushing out a product and managing the relation with the client, and the credit risk are remunerated on the basis of keeping that portfolio clean. So it's a bit of a healthy tension, and I believe it should always be there. The question is, how do we educate both sets of the bank to have this tension, but to know when a file needs to move from the business end into the credit risk end, or how to I think both parties have to understand that the health of that portfolio is both their responsibility. And how do you move a skill set from the credit risk into the business side, such that you have a conversation between the two sides that is actually sensible on how to actually deal with this customer. Now, what I have seen in the recent few years in the larger tier 1 banks, we're starting to see dedicated units actually being carved out of the credit risk teams, simply just because they have got portfolios that are large enough to actually, the book is large enough to actually support a specialist team in the bank that can look at these struggling businesses. So a lot of the tier 1s, you start finding have what they're calling a special assets management unit or business support or corporate support unit. That's a sort of embedded within credit risk or in between business relation and credit risk sort of situation. So we started seeing that with the larger banks. For the smaller banks, they may not have the ability to be able to set up such specialist teams, and therefore you're starting to see that sort of differentiation happening. On your comment that every business is unique in its own way or different segments, I do agree to that, and that's why you find most practitioners offering what is known as a deep dive, known as an independent business review, where you walk in to understand the unique issues specific to that business, such that the solution is not then just the smorgasbord that we just put up there, that you're very specific to that particular person and saying these are the actual issues that are actually ongoing. As my colleague Robert has picked out, it could be a simple issue that yes, there have been adjustments on the family front, and there are now more shareholders at home, and it's causing an asset redistribution process, and chances are that the bank is the one getting the short end of the stick there. It's issues like that, and trying to turn back and say, okay, right, this is the actual way for this particular customer. May not happen for everyone. What we just put out there are the general generic things. Thank you very much. I hope I've answered your question comfortably. Thank you. Any more questions from the audience?
Yeah, thank you, panel, for the insights. Mine is just a comment on what's the success for this turnaround. and more specifically with the revision on the Insolvency Act, where now we are focusing more on encouraging financials to be able to come in early and then be able to manage. Then secondly is, do you have the expertise when you're saying turnaround? Who will do the management? Thank you.
I think I'll answer the first part, and my colleague Robert will answer the second, and then back to the moderator. The first question, if I'm right, was what's the success rate? Is it possible to put back the last graph I had up there? If you come at 1 minute to midnight, this success is, I'll turn back and ask you, who are you? Who's the actual stakeholder coming at 1 minute to midnight? And what do they define as success? All right? If you are the banker and you're simply saying, look, we know that we hold the securities, we have the legal charges, we have the debentures, we don't really care about anyone else. We want to go in and just take over our assets, and we recover, we sell, we're out, done and dusted. The banker could define that as success for themselves, which is they're done, they're dusted, they're out, they have no loss or they have mitigated the loss. If you're the business owner and the banker has chosen to take this route, you may look at it as a failure, and you'll be looking to see at what risk are my PGs if I granted any to, and can the bank come after my other assets? If you came in early from a consensual point of view, then perhaps unfortunately, the one case I'd like to openly talk about is currently ongoing in our courts. So I cannot comment, but it's been in the papers there. So if you know what it is I'm talking about, the shareholders actually gave the answer as what they thought about the business prospects of that business. That was a timely discussion, I believe the management there came out early, accepted that they had problems, and put a plan out in place. But sections of their key stakeholders decided, we don't buy that plan, and that's a reality that sometimes a business case has actually changed out for a company. With respect to the question as to whether or not we've seen a lot of success under the new act, my view is that a lot of banks, we've had close to 15 years of really good growth. When I look at bank balance sheets in the early 2000s when I started off, you can start telling 2 decades comes easily. The size of the bank balance sheets, the size of what was known as a bad debt at that point in time, to what the bank balance sheets now are. I think all our tier ones are above a trillion shillings. So for them, writing off 200-300 million bob is may or may not be a big issue. But what I have seen consistently is that banks or even the directors themselves come in a little bit too late, that the solutions that I'm able to suggest are not on the upper side of the curve. They're down on the lower end. Somebody's coming in, and by the time you're getting the real story, you're saying, well, look, these are the only practical options that are now actually on the table. I think we will see success out from this after we clear through what I think is a hangover from all our banks which have not declared, who have been, shall I say, managing a very interesting NPL number over the last 10 years. And now the reality is a bad debt does eventually actually pop up. It's now starting to pop up when we are going into a difficult economic time. So you will not see much by way, in terms of success, by way of a massive turnaround. What you will most likely see is business exits being shifted out to new owners who actually have the capital out to probably reinvest into those sectors. And if it's in businesses that are no longer relevant, if you don't mind putting the earlier curve, sorry, the first curve. Oh, right. Yes. What I should have stated at the start is that this is the typical graph for a business life cycle, but it is actually dependent on the sector that you are in, okay? If you're in manufacturing, light or heavy manufacturing, this is a 7 to 15 year sort of curve. If from the panelists who spoke this morning in FinTech, they go through this in a year and a half. In January, you could be it. By September, some new piece of tech is out that that makes your value proposition gone. So that, I think, answers. So what we are seated on a lot in Kenya right now from our banking point of view is a lot of legacy bad debt. So we're not going to see a couple of good stories for the public. Maybe good for the banks as they exit, but yeah. That's just the reality of where we are from our business. Yeah. IP stock straight, man.
Thanks, Kereto. I'm not sure how much time we have left. The MC is 5 minutes. Okay, so maybe Robert, we'll have one more question. Maybe we can just take the last question and then. Okay, we have. I'm told that there's a.
The gentleman had asked whether we have the expertise to do the turnaround. I think that's, I can confirm we have the expertise. If you follow what Kereto has said, you come in early, we have the expertise because these businesses are managed by directors. Once you come in early, we'll bring in Kereto to guide, to supervise what has been proposed, and run with that system or program that we have already agreed upon. That one is as easy as that, and the expertise is there to do the turnaround. The only problem is, though we got a new act in 2015, but almost the people who are expected to implement are the same people from maybe our clients. The bankers we have, most of the time these things happen very, very late. And when it is late, there are only two options when you come late: liquidation and receivership. Receivership, go in, sell, realize the assets, pay the bank whatever they can get. And liquidation, almost the same process. Sell, whatever you get, pay off the creditors. That's the only two options you have. Even if though I've noticed we are mainly now being forced to use administration. Administration is a tool that can be used for turnaround. But if you call in an administrator very late, he will just end up almost doing the same thing because he has three objectives. The first one is to turn around the business. And if he cannot turn around the business, he can go to the other options, which are sell off the assets and pay off the creditors. So it's the same way. Unless we come in early, we get in accountants who can come in, do independent business reviews, come up with the proposals, from there act. That one will always we always get out the turn around the company, and the expertise is there, and we can do it. And again, just to comment on the first gentleman, the one who was talking about maybe training and awareness to the bankers. I think I sit on the board of the association. We have an association for insolvency practitioners. Previously, we were faceless. Many people had never even met receivers, the so-called receivers. But we have an association, and we have trainings. I think about after every 2 months, we hold trainings where we train bankers. Part of the membership is mainly, we draw our membership from bankers and law firms. We are currently, I think the next training will be on with the judiciary. So we are training all the stakeholders. That's the judiciary, KRA. We had the last one, we had KRA. So KRA is in, we have bankers, we have lawyers, and ourselves. So we are all there learning and teaching and exchanging knowledge on the issue of insolvency, the Act and the turnaround and restructuring. So please, we have noticed most of the banks, all the major banks are our members, but the people who are sent, most of the senior staff will not come, will not attend, but please make a point, attend those trainings. Anytime you see our association, anytime you get those invitations from our association.
Okay, thank you very much. I think because of time, we'll have to leave it there. We are available over lunch hour for further interaction on the topic. I think what you've just said, Robert, sums it up well. For a successful restructuring to happen, it's important that interventions are made early on in the distress cycle. So for the bankers, you've had the challenge. The senior people in the room, I can see some of them. You have been informed to come for the capacity building or sensitization so that we can collaborate. I think the key theme here is collaboration. The bankers have to collaborate with the insolvency practitioners, with the lawyers, with the borrowers, so that we enhance the financial ecosystem. So with that, I think we'll close. I invite you to give a round of applause to the panelists as they take their seats.
Thank you so much. I think you can appreciate them as they walk down. There was some sort of eerie feeling when the presentation was going on, but it is what it is. I want to thank you for handling that very well. On the issue of capacity building, I think one of our directors, we have our director, Ken, from the KBA. We can organize a training through the KBA where we build that capacity. And I believe the bank where the gentleman who asked the question comes from is a member of KBA. I think we are moving well as far as time is concerned. It's noon. We have one more panel to go. But I'll ask, we have a video. If you look at your program, there's a video to be shared from ICC. So I'll ask the Secretariat just to run it through. And then we'll have the last panel before we go for lunch. Thank you.
Hello, everyone. Hope you're all doing well. My name is Will Moody. I'm speaking to you today from ICC Academy. We're actually based in Singapore, but yeah, apologies I couldn't join you in person. Some of you may be aware of the ICC Academy. We are the online education arm of the ICC, and we produce a range of online courses and qualifications designed to help those professionals on the front lines of international trade. And one big group of that is trade finance professionals, of course, and those working within banks. Some of you may be familiar with our Certified Trade Finance Professional course or qualification, the CTFP. And yeah, I'm delighted to talk to you today about a new course that we've created called the Certificate in Digital Trade Strategy. And of course, it's very relevant to what you've been discussing already. And I hope this is useful. So I have limited time, so I'll just jump straight into things. I'm going to share my screen. Okay, so I'm going to move myself off so you guys don't have to look at me the whole time. Yes, so like I said, the topic of today's discussion is the Certificate in Digital Trade Strategy. That's a new course that we created in partnership with the ICC Digital Standards Initiative, DSI, which I'm sure some of you or many of you will probably be familiar with already. So just to set the scene really on why we created this course. So this fact is from the Future of Trade 2030 report by Standard Chartered, and they surveyed, I think I can't remember the exact number, it was about 500 CEOs of corporations, and 89% of them agreed that the adoption of digital trade platforms is a key enabler in making trade faster, more transparent and secure. And then another something that I pulled out from that report is that 5 out of 10 corporates place accelerating the next wave of technology adoption within their top 3 priorities. So Standard Chartered identified digitalization as one of the 5 key trends that was shaping the future of trade. So what I wanted to talk about today is, if this is a priority, what is being done to upskill businesses, employees within businesses. It's all very well saying, in a survey that this is a priority, but we wanted to find out what is actually happening on the ground to get banks ready for the future. So, or corporations, it's not just banks, of course, but it's everyone affected by global trade. So this is some feedback from our learners on our CDTS course in 2022, and you can see the question we asked them was, what's been their biggest professional challenge or frustration when it comes to digitization? And I've italicized, some key phrases here, I think, which is, things are happening at a very slow pace. They had to fight hard to raise awareness and boost adoption of digital trade tools. There's a lack of awareness and interest at the local level, and core banking and infrastructure don't support the process well. Line managers should understand the system better. So it seems like there's a bit of a disconnect between whether this is a priority, but the training isn't really happening yet. And that's what we wanted to change really with the CDTS, and one of the core reasons we created it. There's clearly a frustration echoed in these comments about the pace of change and the lack of awareness and interest in getting organizations ready for the future. So this is the key part of the talk really, which is your bank ready for the future? And I wanted to first of all just introduce the CDTS a little bit more. It's a new online certification, like I said. It's a 5-hour course, 5 modules, self-paced, and it's designed to give individuals a complete end-to-end picture of what is needed to digitize trade and supply chain processes at scale. It's sort of designed to give you the building blocks, if you like, of everything that goes into those processes, so you can have that high-level macro understanding. And it's a very unique course. So it brings together more than 20 industry experts across the public and private sector from different parts of the supply chain. And it's really the only course of its kind available. It's the first time this kind of curation of expertise has been brought together. So, and the course is really designed to help individuals and banks do 3 things, and that is identify the right strategy to accelerate their digitization roadmap. I won't talk through everything on these slides. I believe it will be shared, I hope. But yes, the building blocks, like I mentioned earlier, are very important. If you're going to create a digital strategy, you need to understand every part of what might go into that first to create something that's effective and gets adopted and is really holistic. Standards, understanding the standards that are available at the moment, and adopting a standards-based approach, so you kind of avoid a fragmentation in the digital strategy that you're creating. And that's what the CDTS is designed to do. It'll talk you through the various standards available and help you articulate the benefits of this internally, so that you can maybe convince others if necessary, and also of course increase your ROI if you're creating a digital strategy. You want to make sure that there's no digital islands within that. And then finally, the most obvious sort of idea of a course on this subject matter which springs to mind is to remove manual inefficiencies and boost profitability using real-time data. Ultimately, the course is designed to help you make more informed business decisions in a faster fashion. Okay, and then the curriculum of the course is split up into 5 modules. The first one is about the foundations of trade, really, how trade processes are organized, and we look at that from several different perspectives. And really it's designed to get a grip on, help you get a grip on why things happen in the order they happen. And then module 2, the challenges associated with trade and trade finance, digitizing trade and trade finance. And that is, we included in that module is a digital trade and trade data dictionary. There's a high-level overview of the existing fintech landscape, and also we talk about the challenges and opportunities of digitization from a bank's perspective. Number 3, a really important module, and something that's kind of sort of on the cusp and innovative, really, which is the making of a legal environment for digital trade. How does this work in practice from a legal perspective? And we cover ETRs and of course the new model law on ETRs, the MLETR, and that's really designed to sort of talk you through the making of that legal framework. And then the 4th module is around corporate digital identity and identifiers, and we talk through 3 different EBL standards as well within that. And then module 5 is about interoperability frameworks. So we have the standards called toolkits for paperless trade that DSI created. Okay, and then there's 3 sort of core reasons that we feel like people should take the course. Number 1, get preparing yourselves for the future by gaining that end-to-end understanding, the building blocks of what needs to go into a digital trade strategy. It's a unique course, like I said. You'll see some comments from some of our learners in a minute that talk about how there wasn't any other course available on this topic, and it's clearly something that a lot of people feel passionate about and want to learn more on, but there wasn't anything really available, and it's taught by, like I said, a range of industry experts from across different parts of the supply chain, from the private and public sector. And then finally, it's self-paced, so it's learners can fit it in around a schedule. There's no classroom schedule or sessions they need to attend. They can do it within their own time, and that's going to give you that base, high-level overview for the future. And one thing I wanted to run through quickly was, I've mentioned a few times the range of expertise here and the different course authors. So we have economists from FINTECH, we have ITFA, we have some of the big shipping organizations, we have miners and shippers, we have the WTO, again, another shipper. We have BIMCO, one of the trade organizations. We have Hannah Ngoyen from the DSI. I'm just going to let this run so you can see that the range of authors. Across various, we've got a port there as well, across various different parts of the supply chain. And then someone from JP Morgan there as well. And we talked about the legal framework. So we have an attorney and former deputy director. So I think you guys get the idea, but there's a lot of authors in there. And the next thing I wanted to talk about was how many different countries have enrolled students in the course, but also one thing that really sticks out, and I hope is a good news to everyone there, is ICC Kenya, obviously hosting this conference, and we have, I think, potentially the biggest number of learners last year came from Kenya itself. So that's really great news, and that is, one thing that we hope to build on today by sharing this course with you guys is to get more learners from Kenya. And then by industry, banking and the fintech industry is very much up there as the sort of one of the bigger contributors to the learners on this course. And then getting towards the end now, but I wanted to run through some feedback from CDTS learners. Why is taking the course a priority for them? And some key phrases here that I want to pick out. They want to be part of the future. I think that's a really powerful phrase and a really powerful piece of feedback, and something I'm trying to emphasize here. This course is the piece of feedback we got was that people are worried about getting left behind, and they want to keep up with the pace of change and stay competitive. And this course is a way to do that. And I hope that kind of chimes with some of the themes you've been talking about today. And then finally, why this course over other courses? And you can see that it's the only course I could find dedicated to digitalization of trade processes. There aren't any courses like this in the UK yet. So it is kind of innovative course. And we're really trying to help organizations prepare themselves for the future. We've got some top-notch content creators involved. So yes, that's the end of my discussion with you today. And I apologize I can't be there to answer questions, but if anyone is interested in finding out more about this new course, please do feel free to get in contact with me. I'll leave my email address there. We're also providing a 20% discount for conference attendees. So again, contact me and we can discuss that. And I've left the link there for anyone to check out more details of the course on our website. So all that remains is for me to say thank you very much again for inviting me, ICC Kenya, and I hope this has been valuable. Thank you.
Thank you so much. You've clearly seen that Kenyans are leading the pack in terms of certification. So I think this is also part of the conference we had last year, where we really pushed for people to get the certification, and you can clearly see the results. And the ICC is still partnering with Kenya. ICC Global is still partnering with us through the various commissions. And at this point, maybe I'll ask the chairman just to mention something. Ken.
Thank you, Frederick. For those of you who may not have been here early in the morning, as I mentioned, ICC Kenya has partnered with ICC Academy to build capacity and the skill sets in the country. And as you can see, this is something that began last year, and you can see the numbers that are reflecting in those who've done this new course on the CDTS. As mentioned earlier, we have a 33% discount on members of ICC Kenya who take up the ICC Academy courses. There are 12 courses. This was just one of them. There's a broad range of courses certified by the ICC Academy, touching in all areas of trade finance. There's arbitration, there's risk, there's money laundering, and you can get more details on the ICC websites. So there is, following the partnership and the MOU we've signed with them, there's a 33% discount on those courses. They range from a 1-week course to, I think, a 3-4 months courses. And there are also about 40-something e-modules also touching in the area. So there's a whole range of capacity building and skill sets that are available. And for their literature, they've also extended to us through our MOU a 20% discount on books and literature that you get from the ICC Academy. A lot of these books are e-books, so you can just download them now. So I think that for us as ICC Kenya is the way that we are looking to partner with organizations and contribute to the industry and the business as a whole. Thank you.
Thank you very much. When I was coming in the morning, I met someone there and I told them I'll be today's MC. And they told me, I hope you have jokes. So I told them, I'm an accountant and we rarely make jokes. You don't even know how to joke. So if you don't laugh a lot today, don't take it against me. It's basically because of my vocation. At this point in time, we'll have our last panel just before we go for lunch. Right now, it's at around almost 20 minutes to 1 o'clock. So we'll try to make it I think we are doing well on time so far, isn't it? Are we not? Are we? Okay, I think we are. So I'll invite our chair, Ken. We had already introduced him in the morning to take us through this last panel. Ken, welcome. Continue writing your questions on menti.com. Even if we don't respond to them on the floor, we shall ensure that they are responded to through the chat. It's okay.
Thank you. The next panel is on the arbitration in banking, a viable alternative to litigation. I would like to welcome the members of the panel. Nikhil. Who else? For this panel, I understand that Dr. Kenneth Mutuma is going to join us online. So I'm going to introduce Nikhil, whose profile you can see there. Nikhil is the chairman of the ICC Kenya ADR and Arbitration Commission. As I mentioned, we have 4 commissions under ICC Kenya, and he's the chair of one of the commissions. He's a director at J. Miles and Company and specializes in domestic and international arbitration and fraud investigations. Nikhil has represented state and private entities in arbitration before the various international tribunals, and he has recently had a team in training the Kenya Ethics and Anti-Corruption Commission, the AG's office in Ethiopia, and the government of Somalia on the use of ADR. He has represented regulatory authorities in fraud and asset recovery investigations, and which has resulted in successful recovery actions in multiple jurisdictions. Nikhil is also the managing partner at the Kenya law firm of Desai and Company Advocates, which is a sister company to J. Miles and Company, which provides a wide range of Kenya law advice and representation to clients. Welcome, Nikhil. The other member of our panel is Raymond Mulenje. Raymond is the Director of Legal, HR, and Advocacy at the Kenya Bankers Association. Raymond has over 18 years experience in legal practice, HR, and stakeholder engagement, gained in both private practice and corporate leadership roles, including corporate legal counsel, human capital employment, labor relations with leading organizations, including De La Rue, Security Print, FKE, Equity Bank, RERA, and private legal practices. At KBA, Raymond spearheads the banking industry legislative, regulatory, and policy advocacy engagements with legislative, policy, and regulatory bodies. He coordinates the banking sector's HR and human capital matters, stakeholder engagement on diverse matters affecting banks, and management of KBA's secretariat, legal, HR, policy advocacy, and company responsibilities. He's a board member of the Mediation Accreditation Committee of the Judiciary. He's an advocate of the High Court of Kenya, a commissioner of oaths and notary public, and is a practicing member of LSK, and also the Institute of Human Resource Management. He's an alumni of the University of Nairobi, Kenya School of Law, Cambridge College, UK, and the College of Human Resource Management. The other panelist who is going to be with us online is Dr. Kenneth Wayne Mutuma. Kenneth is the Vice Chairman of the Chartered Institute of Arbitrators of Kenya. He's an advocate of the High Court of Kenya and a partner of the firm of Kihara and Wine Advocates. Kenneth holds several academic qualifications, including a doctorate and master's in law from the University of Cape Town, as well as a law undergraduate degree from the University of Liverpool. Dr. Wayne is also a chartered arbitrator at the Chartered Institute of Arbitrators in London, as I've mentioned, and is a certified professional mediator, a certified secretary, and a certified governance auditor. He possesses accumulated experience and academic leadership in ADR, corporate governance, and international law, and is currently a senior lecturer of law at the University of Nairobi. Kenneth has extensive senior management experience across local and international settings, as well as practical knowledge of interdisciplinary issues. He continues to serve as a legal advisor to a range of international organizations, governments, public and private entities, working to address various development challenges. He also serves in the Independent Elections Panel of Cricket Kenya, the PPP Disputes Tribunal, I'm sure you're very familiar with that, the FKF Appeals Committee, and currently is the chair of the National Examination Appeals Tribunal. I'm also an arbitrator myself, and we want to introduce a concept. We in the ADR fraternity, we call it appropriate dispute resolution. It's no longer just alternative. There's a concept of appropriate dispute resolution. And we hope at the end of this panel discussion, you will appreciate that it is appropriate and more than just alternative. Now, from the banking perspective, a general overview of the banking products and services. A broad range of banking products and services are suitable for arbitration in our view. And this include loans. You had credit being mentioned earlier. Loans, payments, safe custody, trade finance, foreign exchange, investments, safe custody. These are all bank products. And naturally, where there's money, there will be disputes. That's inevitable. And for us, we look at what aspect of dispute resolution can be offered as an alternative to being litigious. A lot of people say we are a very litigious society nowadays, but I think it's more to do with customer awareness. But there are alternatives to that. I think I'll start with Raymond to take us through this. Raymond, in the past, the banking sector has not embraced arbitration as recently as other sectors like construction, procurement, and the capital markets. However, recently there seems to be a general increase in the use of ADR. What has necessitated this change in growth in the use of arbitration in financial services?
Okay, thank you, Ken, and good afternoon. Yes, from the banking perspective, as you've rightfully said, from the past, because previously, the past banks have been conservative, actually in getting to move ahead on many aspects on how we do our processes. So we've been quite conservative. So we are comfortable with just the tested and proved mechanisms to be able to resolve our conflicts. That was litigation. And then also the other bit was our training also, both business, the business people, and then also the councils, both in-house and the external support that we normally get. So our training actually was majorly on litigation. And then also the training that we have done on arbitration, most of it and the examples given were actually on what you've mentioned, matters to do with constructions, matters to do with procurement, but very little to do with banking. So we were more comfortable because now, the nature of the contracts that banks have with customers and our stakeholders are normally, there are securities attached to our contracts, there are collaterals attached to our contracts. So the easiest way, and then again, as it's been mentioned, when we get to realize and decisions are being made at midnight as to now, it's not an issue of turnaround, it's an issue of being able to recover. Now, those decisions make it a bit difficult for parties actually to be able to agree, to get to a discussion, even agreeing on an arbitrator, or even agreeing to a mediation. That option ordinarily hasn't been there. So most of the time, we've actually just been able to be pushing towards the tail end of, are we going to do the insolvency or are we going the litigation route? So our training and our culture has actually been a major hindrance, and then also, as I've said, our contracts. But from the KBA perspective, and just to mention also, the beauty with the Kenyan banking environment, we are quite very close, and we work together through the Kenya Bankers Association. So part of the culture change is a bank will wait to be able to see what another bank is doing, to be able to make the step. So from the KBA angle, what we've done is just the realization that yes, there are a lot of funds which are actually being held in litigation. So this year, we are very, very deliberate on matters appropriate dispute resolution mechanisms. So in April, we actually had a conference just to be able to drive the message that we don't have to go to court. We can even start with mediation. And even as we sit now, what we've done is we're in partnership with the judiciary. So there are quite a number of 4,000 cases just in 4 stations, Nairobi, Mombasa, Nakuru, and Kisumu, which have been screened and going for mediation. Just as a step to be able to have this culture change from the business angle of banks, and then also from our legal support, both in-house and external. Once we succeed on this mediation angle, it will also be very easy now to be able now to step up and be able to say, even when the dispute has not been settled at a private mediation session, you can now be able to do it to move to arbitration, which will be faster and then cost effective. And then you have also the advantage of actually having to choose who is going to make that decision for you, as opposed to throwing it to the courts, and then now the courts have to make the decision. Yeah. So we are keen to be able to ensure that money is circulating within the economy much faster. And then it's been said that, currently, the differentiating factor within banks is how you're offering the service. So it's not an issue of conquering new territory. So the issue is we need to retain the customers that we have. So if I'm KCB, I&M, I need to retain the customers that I have. And part of the retention strategy is adopting mechanisms where the bank and the customer are actually agreeing as to how to be able to resolve the disputes here. Thank you.
Thank you, Raymond. Thank you, Raymond, for that introduction. Now, for the banks to embrace arbitration, they need to have arbitration clauses. I would like Nikhil to tell us what are the key issues to consider when drafting an arbitration clause, and how can the same be tailored for banking disputes?
Thank you, Ken. Can you hear me? I don't think the mic's working. Hello? Thank you, Ken and Raymond, and good afternoon, everyone. So with regard to the arbitration clause, I think perhaps I'll start with some of the issues or concerns the banking sector has had in choosing arbitration over litigation. There was an ICC report carried out in 2016 focusing on the financial institutions and why there's this reluctance to choose arbitration over litigation. And the obvious ones are clearly that there's a lack of summary judgment. So for example, when you're litigating and the other side does not have a case to actually answer, you don't want to go through 2-3 year process. The court can actually order a summary judgment just on the basis that there's no legal merit in a claim. In addition to that, there was this perception of arbitrations are expensive. Arbitrations actually don't reduce time in terms of resolution of disputes. Now, over time, I think the arbitration fraternity has been mindful of all these concerns, and in effect, when arbitration became prevalent, it was meant to be faster, cheaper, and more effective. But I think as time went, that changed, and then that was recognized by institutions. So you'll see that by its nature, arbitration is consensual. So you can agree to everything at the start or even before the dispute arises in the arbitration clause. You can control time, you can control cost, you can control how that process is carried out. So the arbitration clause becomes very important in dealing with financial disputes. So I think the first thing to consider is, will it be an institutional arbitration or an ad hoc arbitration? Institutional arbitrations whereby you use rules such as the ICC rules, CIR rules, which will govern the conduct of the entire arbitration proceedings. Now, it's very important to have that in mind, because once you agree to an institution conducting or supervising your arbitration, you're bound by those rules. So you have to think, so for example, if you're using the ICC rules of arbitration, and I think I'm allowed to say this, but if it's a very small dispute, you may not want to choose the ICC arbitration rules because it may increase your administrative costs. Because once you choose institutional rules, you pay the institution for carrying out that rule. But at the same time, it covers other issues. So it covers issues such as how do you appoint an arbitrator? It has fallback procedures, so you're not stuck in court at the moment where you're actually trying to commence the arbitration procedure. So it's very important to look at the rules. Do they fit into your particular requirements? Look at the size of the transaction. Some rules have amazing sort of provisions like expedited rules for arbitration. So what that is, and I'll give the ICC as an example again. Currently, if you choose the ICC arbitration rules to govern your arbitration, you automatically agree to the expedited rules of arbitration applying, which means that if your dispute is between $2 to $3 million, the arbitrator has to conclude that within, I believe it's a 6-month period. So automatically you can see great advantages. I think we'll all agree that you can never get that outcome in the Kenyan courts within 6 months. And you can actually agree on how that's carried out. I'll just mention that I'm sitting as an arbitrator in a matter currently, and it's a small matter. It's to do with a microfinance financial institution and a borrower. And when the matter was referred to us through a local arbitration institution, it was just the rules that were applied. Within the first meeting, which took place in 1 week, we agreed that the matter is not contentious, and therefore we can deal with this on a documents-only basis. We agreed that from the time that I got that brief, we would conclude all filing of pleadings within 1 month, and after that is done, within 2 months I would render my award. So that's a 3-month period from the time we get the brief till conclusion, which is, you know, comparable to, so all these things can actually be incorporated. Other important considerations in the arbitration clause, obviously selection of arbitrators. You can put in provisions on, do you want an arbitrator from a particular jurisdiction with particular expertise? You know, do they have to have a certain background? Again, you can't do that in a court of law. You would have, you would be assigned the judge that is given to you, especially for financial disputes. So selection of arbitrators is a must, particularly for large financial transactions. So let's think about a syndicated loan agreement where you have a facilities agreement, an intercreditor agreement, parent guarantee, number of agreements, all interconnected. Something that happens in one agreement affects the other agreements. Now, one of the issues obviously that was placed with arbitration is when that happens, number of agreements, say 3 disputes in 3 different contracts, the court can usually consolidate the matters, right? But in arbitration, that wasn't allowed because you're not talking about one court and one judge. You're talking about 3 different arbitrators or 4 different arbitrators. So especially in financial disputes which are a bit complex, you must include a consolidation and joinder provision. And, you know, not very complicated. It could read something along the lines of, in each agreement, parties agree that all these agreements project documents are interconnected, and as such, the arbitral tribunal have the power to consolidate and join any concurrent proceedings, right? So again, that takes away one of the bottlenecks which financial institutions felt that arbitration was not offering them as opposed to litigation. I mentioned summary dismissal. As I mentioned, some of the, and I think I'll speak about that a bit further later on, but it is available and you may want to include that in your provision. Interim and conservative measures. Again, arbitration is not trying to take away court supervision or court powers completely. Definitely, especially in financial disputes, you can see the benefit of having a court order to assist with freezing an asset before someone dissipates that asset while the arbitration is going on. So if you want that, while it's usually covered in institutional rules and the basis of the seat, you could expressly put that and give comfort to all parties. And interestingly, when financial institutions enter into large transactions, even small transactions, they have the upper hand. Probably most of the time, they have the upper hand in how the contract is drafted and take advantage of that. The arbitration clause could be geared towards your needs. If you want to have certain matters dealt with in a certain way by arbitration, include that. If you want certain matters dealt by litigation, include that. Just it has to be well reasoned and make sure there's no conflict in that. So very important to ensure that all the arbitration agreement is the basis of how your dispute resolution is going to be settled. In courts, we have an entire civil procedure rules, which is numerous pages. In arbitration, we have the arbitration rule agreement, which is the core of the dispute resolution process. So always pay a lot of attention for that. Even one wrong wording in there could make that clause invalid. So it's a very important clause in every document.
Thank you, Nikhil. Dr. Kenneth, is he with us online? Will he come on screen? Thank you, Dr. Kenneth. There is low consumer confidence in the arbitration process, especially for the bank SME customers. And it revolves issues around funding, costs, small claims, knowledge of the Arbitration Act, and so on and so forth. What can be done to increase this consumer confidence?
Thank you very much, Ken, and distinguished members of the panelists, the audience that are present physically. Let me respond to that question by sort of scouting a background. There's a sense in a lot of our discussions that a powerful sector is sort of peripheral and playing catch up. Here I'm speaking about MSMEs. And that, of course, is countered by the sort of research that we get, particularly in this part of the world, when you look at the contribution of that sector. In the context of banking, of course, there are different research studies, surveys that have been done that demonstrate the significant source of funding that's vested specifically in the MSMEs. I think one research talks about 57% of total customer deposits and so forth. Those sort of figures again are reflected when you're looking at lending. In our country particularly, that soars quite high. I enjoyed the discussion earlier when we were speaking about fintechs and so forth. So when you look at those figures, when you start thinking about the disputes that emanate in that sector, it's very important to profile ADR processes, and in this specific instance, arbitration, as an affordable and efficient route for MSMEs to actually resolve their disputes. That means looking at the entire ecosystem and asking how that context can actually, that entire ecosystem at different points can be improved to allow MSMEs to actually have an enhanced sense of confidence in arbitration processes. The first of that, of all of this discussion would have to be accessibility. So I was listening to Nikhil's presentation, and I was thinking about the informal sector and the sort of disputes that you sort of gave a quick overview over, Ken, earlier on, and the extent that platforms exist for these entities to actually participate in arbitral proceedings. That has a geographical connotation to it. It requires us to think about emerging markets, Kenya and several other African countries, and think about where these corporations are located. Many of them would be in the rural areas, and think about the role that banks can play in facilitating the question of access. I think a lot has already been said in the context of fintechs. And Nikhil, I think, made references to that when he was talking about the ICC rules and the possibility of multiple avenues through online case administration, video conferencing, and so forth. A similar challenge for this particular group of entities relates to speed. And as you can imagine, dispute resolution hammers the informal sector and the small microfinance sectors in how fast these disputes are actually resolved. Again, Nikhil, I think, spoke about the court processes. So that gives you a background on where these entities start from. And they don't have the capacity or financial muscle to sustain the duration of those proceedings. Arbitration offers fantastic recourse in this regard. You look at the Kenyan Arbitration Act, particularly Section 19A, I think there's such an emphasis on what was meant to be an advantage of arbitral proceedings, which is expeditious conduct. And yes, we have swung on both ends of the pendulum. I think we are trying to get ourselves back again to making that a reality. There are several reasons why we sort of seem to have lost that advantage in more recent times. We speak about the lawyering of ADR, and that is certainly felt mostly with arbitration, where the technicalities that of procedure and so forth that exist in the courtroom and formal litigation have sort of crept into the world of arbitration. So I think key, if we're really going to speak to the needs of that sector, then we need to start living up to that essence of expedited proceedings. Fortunately, as we had earlier on, that this is a consensual process, and parties, the key phrase that we use in arbitration is the autonomy of parties, and that autonomy is certainly expressed through how they agree on procedure. And there is considerable room through the arbitration clause, through rules that are adopted, institutional rules, appointing authority rules, and so forth, to factor in, as we had earlier, the notion of speed. The other major barrier, Ken, of course, without saying, is cost, because you are not dealing with financial giants here, and MSMEs first and foremost would look at this impediment of how to minimize these financial barriers. Now, I think finance institutions have a stake in supporting that process, and there are parallels, of course, that can be drawn from the small claims court, but there are other innovations, I think, that have been adopted. I know in India, there may be some interesting innovations in this area where this principle of sharing of fees and expenses has found an alternative of that's based on equitable sharing, not equal sharing, but equitable sharing. And one would ask, of course, why would banks want to do that? And the answer is if there's anyone who will benefit from the ability to remove the congestion when it comes to speed and costs in the resolution of disputes, that would be banks. So there is a school of thought that's emerging in those jurisdictions where banks take up a higher share just of those costs to enhance MSME customer confidence in the process. There is also the bottleneck, of course, of awareness. And I remember my earlier remarks talking about this sector and a lot of work that's been done. That work has focused so much on the formal and finance sector, for formal large enterprise customers and so forth. Even when you think about arbitration and the general knowledge that's out there, there's a relatively low level of awareness by MSMEs on some of those merits that we are discussing and we take for granted. I think there is scope in the context of our discussions here to explore how we can collaborate. I don't think this is the work of any specific organization or corporation, but we need a collaborative effort. It's an effort based on partnerships to raise general awareness around arbitration as a viable dispute resolution mechanism. A good example is what WIPO have done. Intellectual property can be very elitist in the way it operates, and so WIPO has set up this arbitration and mediation center and has created nodules across different cities, different jurisdictions where there's some kind of complementary procedural guidance that's offered to SMEs. So ICC may want to start thinking about that through the different chambers of commerces that are working across the globe. Last but not least is the general post-arbitration constraints in our world here. I think here, particularly in Kenya, that's revolved around possible challenges that emerge after the award and the role of the courts when it comes to the challenging of those awards through Section 35. I think this debate is still out there and it's open, but there's a sense that courts, we need to build a capacity within our judicial system to understand arbitration as a dispute resolution mechanism. We've come a long way because the start of our conversations used to be some kind of competition between the courts and the arbitral world, the arbitral practitioners, where courts at the very start felt that their area of competence was being under threat. I think we've moved from that, but there is still a sense when you look at a few of the decisions in the past 2-3 years. There is jurisprudence, the new tools, innovate, jurisprudence and so forth, and quite a number of other cases that we need to make sure that we've got judges that understand the process of arbitration and the uniqueness of it as a dispute resolution mechanism, the act, and they don't frustrate what you call the finality of the award through possible appellate recourses that may emanate from proceedings that are concluded. So that's my thoughts around when it comes to how one can actually further the inclusion of arbitration and enhance confidence by in arbitral processes by MSME customers. Thank you very much, Ken.
Thank you so much, Kenneth. Quickly, we'll move to Raymond. Are there initiatives within the banking sector focused on promoting the use of arbitration? And what is the future of arbitration in the Kenyan banking sector?
Yeah, thank you. Sorry, I think we have a challenge with our mics. Apologies. Yes, from our world within the banking sector, we've made progress currently, and it's quite significant progress. So, just on the overall ADR framework. So the first one, which two examples which are working quite well, there's the check processing within banks, where check from one bank has to be paid by the other bank. So there are normally disputes around that process, which is just in the bank, not necessarily now running to the customer. So this is Bank A and Bank B being able to settle that process. So it has worked well for the last 5-8 years on when there's a dispute, now we don't go to court. We actually just get either a mediator or through an arbitration process and be able to resolve it. So I can't remember that particular exchange and transaction actually ending up in court. So it's worked quite well. The second one is a section where there's quite a lot of controversy on the CRB, the Credit Bureau framework, where all information and there's an element of some default, and then banks report. Actually, that information is reported, and for CRB they report both positive and negative. But customers they'll follow up when there's a negative reporting, and then now what you call the negative listing, and then now trouble starts there. So we've put in a mechanism as an industry where when customers have complaints, you don't have to go to court direct. So part of which will involve a mediation process, and what you're looking at is now being able to graduate it in that if mediation doesn't work, is it an issue of us going to court, or can we now be able to select our own mediators to be able to resolve this particular issue? Because the beauty is most of the bank disputes are actually well documented, and it's just an issue of intervention and being able to look at are there compromises for us to be able to maintain this relationship. So in fact, even another clarion call to the arbitration process is being able to, and as we continue evolving, in that we don't necessarily focus more on the awards, but at least focusing more on like compromised awards, in that you look at this customer, there's a loan which they're having challenges, but they are temporary challenges which they can actually be able to overcome. So in getting to the award, can we have a situation where like it's a compromise, where we really get to hear the parties' interests, and even as we get to making an award, it's like a negotiated settlement award. So it will work better for the banking world, and that's what we are really driving, first through mediation, and then also now through arbitration. Now, the next thing is capacity building, which the major challenge again is just for both the customers and banks team being able to have that change of mindset, in that we now don't look at us really fighting, but actually as resolving the conflict. Because arbitration, mediation, being focused on can we resolve this particular conflict, not an issue of can we establish the rights. Because now if you go to court, it's an issue of you are right, you are wrong, But arbitration can actually be able to help us be able to resolve the conflict, but not necessarily be able to say one was right, the other one was wrong, or one is a winner and the other one is a loser. Then lastly, our regulator has come in also quite strong within the banking sector, because we are one of the sectors which are highly regulated, and Central Bank is keen to just be able to ensure that when there are complaints, when there are disputes, when there are challenges with customers, can they be resolved as fast as possible? Because it involves money, and you find when you drag, it makes the situation worse for the customer, worse for the economy. So Central Bank has challenged banks just to be able to ensure that when there are conflicts, let's look for means and ways to be able to ensure that we resolve them as fast as possible. And that's where arbitration now comes in becomes very significant in actually being able to achieve that goal. Thank you.
Thank you, Raymond. I think your presentation brings us very nicely to the next issue I would like to share with the audience. I don't know if the screen is on. The advantages of arbitration over litigation, where we can explain practically to the audience why we have the view that arbitration is a viable alternative to litigation. Do you have the screenshots? I think we'll skip that as they bring the screen. We're just trying to show it. Nikhil, there's a concept of summary judgments is one of the key things that is valued by financial institutions to dispose of the dispute matters quickly. What is your view on the summary process in arbitrating financial disputes, and does it infringe on a party's right to present its case?
Thanks, Ken. I think I'd mentioned earlier on that summary judgment was one of the main things that banking institutions noted as a setback, not being offered in arbitration, but being available in courts. And it becomes quite clear why, obviously, financial institutions would want availability of a summary judgment application or ruling or judgment on that, just because of the nature of the transactions banks deal with. So as a concept, I don't see anything wrong with summary dismissal of claims being available in arbitration proceedings. And indeed, I think for at least the last 10 years or so, there have been such arbitration rulings whereby summary judgment has been used by a tribunal. Now the issue comes in as to whether the arbitral tribunal has the power to issue a summary judgment. If you look at even the Kenyan Arbitration Act, you look at the UK Arbitration Act, there is a provision in probably most arbitration acts that the tribunal shall give each party a right to present its case and a right to be heard, right? Now the question arises, does that provision conflict with an arbitrator dismissing a suit without the matter going to trial, or just at a very early stage of an arbitration proceedings? And I think my definitive answer is that it doesn't. And the question and the reasoning for that is you're giving the arbitral tribunal the powers to adjudicate on your matter. You're substituting them in effect from the court, having the power to decide on your matter. And as such, the arbitral tribunal must have those powers to ensure a cost-efficient and timely resolution of your matter. Now, if you look at the Arbitration Act again in Kenya and around the world, they also talk about disputes being resolved cost-effectively and without delay. So if you're taking this power away from an arbitral tribunal, in my view, they can't fully satisfy their mandate. But obviously there is an issue, because obviously when a court rules on a summary judgment application and dismisses a matter, that in effect ends the matter. But in the case of arbitration, a recalcitrant party can simply say, you don't have the power to do this. You didn't give me a right to a fair hearing. I was not able to present a matter. But all that, again, can be dealt with, as I mentioned earlier. Certain institutional rules have actually put in place express provisions allowing an arbitrator to summarily dismiss a matter, subject to giving both parties a chance to be heard on that application. So if we look at the Singapore International Arbitration Center, the Stockholm, I believe, Chamber of Commerce, the ICC, in their notes connected to the 2021 rules, actually stated that arbitral tribunals who are hearing a matter under an ICC arbitration, under their wide case management powers, have the right to order or require summary dismissal of a matter. So I definitely think there is the power for an arbitrator to award that, either through the institutional rules or the local arbitration acts. But because not all jurisdictions, courts are at the same level of being either pro arbitration or supportive of arbitration, it is definitely a good idea to ensure that if you have the time, then this is included in the arbitration agreement where the power is expressly granted. Or secondly, look at the rules. The ICC has already stated that while not express, the ICC tribunal does have the power to grant them, and therefore that can be used in support. The SIAC rule says that. So if it doesn't say that, once an arbitration is started, hold a CMC and grant the arbitrator that power to expressly issue a summary dismissal. That will avoid any future objections after an award is issued, which without doubt the other side of the party will raise. I think another issue to obviously consider is, if you look at the Arbitration Act, there are limited grounds on which an arbitration award can be set aside. And one of those grounds, again, is that, and I'm talking about the Kenya Arbitration Act, is that a party has not had a chance to fully present their case, and as such they want the same to be set aside. Now, I may be mistaken, but I have not come across such an application being brought to the Kenyan courts. But if it were to be brought, I think there is an abundance of case law to, especially in the UK, we just issued a judgment. I think it was the Travis Cole case, where the courts in the UK, which expressly stated that an award rendered at the summary dismissal state does not make that award ineffectual, and it does not mean that parties have been denied the right to have their matter heard. So I think it is a growing, there is growing jurisprudence in this area, but I would advise that any financial institutions who want to actually use these summary dismissal provisions expressly to either put it in the arbitration agreement or make sure it's one of the first issues dealt with at your case management conference.
Thank you, Nikhil. I don't know if you have the screenshot ready so that we can wind up before the Q&A. Kindly post your questions there for the Q&A. We wanted to share the benefits of arbitration over litigation. There are about 8 key points. Do we have it coming on board, or do we skip it? I think we can go to Q&A. We do have some questions coming in. I think we'll do the on-screen questions, then we can move to the audience. On matters integrity, what assurance do you give parties considering arbitration that is actually a process full of integrity, given some publicly no arbitral awards that have raised eyebrows? This is a very important question about integrity because of the confidentiality of arbitration. I think, Dr. Kenneth, you being the Vice Chairman of the Chartered Institute, be the right person to tackle that question.
Would you like me to go now, Ken?
Can you see the question?
Sorry, am I audible?
Can I repeat it?
Can you hear me?
Yes, we can.
Are you? All right, okay. So different, again, it's back to our earlier conversation around the dispute clause and the form of arbitration that emanates from that. So I'm assuming here that I'll be speaking on behalf of the Chartered Institute of Arbitrators, where we are the appointing authority, and matters then emanate from CIAB exercising that appointment. So we have a very detailed process in which matters of professional misconduct and ethics are centralized in London, in our headquarters. Complaints certainly can go to that point. We've got an ethics committee that specifically discharges its functions towards that. There is a sense that should be decentralized. I need to say that from the onset. That in light of the need for those decisions to be taken quickly and effectively, we need to find a way to decentralize that into the different branches. So let me just put that out there. The other mechanisms that we would use at the branch, one, of course, is the question of reappointments, where ethical issues have emerged, sort of a blacklisting mechanism where it's open knowledge, complaints have been raised to us through our secretariat office. We take cognizance of those complaints when it comes to future appointments. And here we're not just talking about the open ethical issues, but also gray issues such as the length of time in which arbitrators take to resolve issues, not necessarily stemming from the inordinancies of parties, but their own professional competence and so forth. And different appointing authorities would have different mechanisms to deal with this. The question is a very valid one because there is what has been raised as an impediment in this area is the fragmentation of practitioners. So there isn't what you would find, for example, with a lot of professional bodies operating in a national terrain, like advocates who have some kind of statutory oversight. You have the certified secretaries and so forth. In the world of dispute resolvers, and particularly the arbitration, given its transnational context, we have some kind of setback when it comes to using a statute and self-regulation, as it were, inside the borders of a specific country. So the most that we have when it comes to dealing with ethics is institutional arbitration, and then looking at the rules of that institution and the kind of powers that institutions can exercise over their members of the panels and their membership, for example, in our context of CIAB. I hope that sort of gives you a sense, Ken, and I'm not sure whether my sound is coming through, but please let me know if you've been able to catch at least something that I've said.
Yes, we got something. Thank you very much. I think Nikhil wants to add something on the issue of integrity.
Thank you. And just to add on to what Kenneth said, which I fully agree with, In addition to that, there are other mechanisms that are put into place. So Ken talked about the confidentiality of arbitration awards, and that's why you're seeing an increase in these sorts of issues arising. Certain institutions, for example, the ICC, have put in their rules that as soon as you subscribe to ICC arbitration, settling your dispute, you also automatically agree to them publishing your award. So that puts further pressure on an arbitrator to actually conduct an award. Again, when you're talking about institutional arbitrations, in addition to, you know, as Kenneth mentioned, the CIAB in Kenya has their own vetting, but institutional arbitration again gives you that additional protection, because before you become an arbitrator in any institution, you do go through a vetting process. In the ICC, for example, you have the ICC court, which you're not allowed to actually render an award without the ICC court scrutinizing that award in detail. And I've been in one of these scrutinizing exercises, and it's a detailed scrutiny of an ICC arbitration award. You have at least, you know, 8 to 10 members present, going through each element and whether that makes, legal sense, or has the arbitrator overstepped their boundaries. The intention is not to rewrite the award, but to actually have a sense on whether the award can stand up to enforcement in any jurisdiction, right? Which is the element of what international arbitration is. And then thirdly, we are starting to get codes of conduct being put into place. I believe it was ICSID, which around a month ago issued or published their code of conduct for arbitrators working in international arbitrations at the International Center of Investment Disputes. So I think as time goes, we're going to see that rolling out across the board, but yeah, that is a wait and see.
I did see a question on arbitration. Yes, I think Nikhil will answer this. Is it possible to abandon arbitration and return back to avenues such as realization of collateral, say under the Lands Act, without compromising the stage in the process of statutory notices?
So if I get that question, sorry, let me read it.
Perhaps in general, can you abandon arbitration and return back to other avenues?
Yes, I mean, once, again, arbitration is a consensual process, right? And I think we were going to have a discussion on arbitrability of some disputes. So some disputes may not be arbitrable. If, for example, you're dealing with a land transaction where the registrar is a key party or the government's key party, it may be that that's not possible. But say you have started an arbitration and parties agree that that should be abandoned, that is up for the parties to agree. However, once you have started an arbitration, the only way to really do that is filing a jurisdictional application stating that the arbitrator does not have one party stating the arbitrator does not have the power to determine this issue for XYZ reason, and then going back to or reverting back to the court system. I hope that answers the question.
Any questions from the audience? As we still wait for the screenshot, it's a very important, we want to share the audience.
Thank you so much. Hello, everybody. My name is Rupert Lipton. I'm a UK barrister. I'm a mediator. I'm a High Court of Kenya accredited mediator, negotiation trainer, public speaking coach. And I'm here, I guess, with my mediator hat on, certainly my mediator consultancy hat on, because I really believe that, as of now, it's the time for commercial institutions in Kenya, particularly and probably starting with the banks, to embrace mediation. So my appeal is that we don't forget mediation when we're talking about arbitration. Arbitration, of course, along with litigation, has its place, but what's not to like, and we heard Nikhil talking about arbitration clauses, what's not to like about dispute resolution clauses that allow for both, and what's not to like about the idea that before you go into what is ultimately an adversarial, combative dispute resolution procedure in terms of arbitration, why wouldn't you try and do things a little bit more collaboratively? And the theme, or part theme of this event today is innovation, and I would submit that a fantastic innovation in business, in banking, would be to find a mechanism to defeat the grooves that disputes run in. And by that I mean in most big organizations, there's a pretty well-worn track, and down the end of that track with a dispute comes lawyers internal, lawyers externals, and adversarial, legally based dispute resolution. And quite apart from being able to save time and save money and save stress, an organization, think for example of banks, that may not have the most favorable public image. I think it's probably not contentious to say that people are quite scared of banks and dealing with banks and having arguments with banks. Such an organization which could embrace a more collaborative approach to dispute resolution is likely to see benefits in terms of its corporate image, in terms of its branding, in terms of its marketing message, and ultimately as it starts to show its customers that it's on their side. And this touches on something which Pauline Macharia from State Bank of Mauritius mentioned earlier, this idea of having to think about the staff and the management and the customers. An organization that can become more collaborative stands, does it not, to potentially gobble up market share? And isn't that why we're all in business? And I would suggest that the wind is really blowing in the direction of mediation. My very good friend Raymond has touched on this. Just a couple of weeks ago, there was a training event sponsored by the judiciary in partnership with the KBA at Strathmore. Just under 250 court-accredited mediators had paid from their own pockets to come and be trained specifically on banking dispute mediation. The training was delivered by some senior legal banking lawyers, by a couple of international mediators. So a very, very serious program that's being sponsored there. Though I might say, whilst you can think in terms of, well, when our dispute gets to court, maybe it will be sent to mandatory court-annexed mediation. Actually, what we should be doing is selecting mediation before we go anywhere near court. A couple of months before, in April, I think this is the event that Raymond was referring to, was a mediation congress. The Chief Justice, Martha Koome, came in person to enthuse about the importance and value of mediation in resolving bank disputes. Patrick Njoroge didn't attend because he was in Washington seeing the IMF, but he got up at 3 a.m. to come live by a video link to put his weight behind the importance of mediation in settling bank disputes. And John Gashora, chair of the Kenya Bankers Association, CEO, of course, of NCBA, was also there enthusing in the same way about mediation. Now, mediation around the world, especially when it's not court mandated, when people have gone there voluntarily, has success rates of typically between 70 and 90%. So don't worry, arbitration fraternity, there are still some that get through, but the ones that get through tend to have been narrowed. The parties understand each other better. Some of the issues that they think they're arguing about, they discover that they're not arguing about. So it's only a good thing that there's a step of negotiation or collaborative dispute resolution before you get to that automatic adversarial approach. So here's the question, and there is a question, hand on heart, as bankers, if you're allowing disputes that grow in your business, in your organization, to step straight into adversarial dispute resolution, are you really doing the very best thing that you could be for your bank, for your staff, for your shareholders, and for your customers? Thank you.
Thank you so much for that. I think, yes, we have one from the audience. I think the last one, I'm told we have 2 minutes. Okay, 2.
Good afternoon, everybody. My name is Anthony. I am a regulatory counsel with one of the financial institutions here in Kenya. My comment, firstly, is that there's a lot of focus and pressure on financial institutions to adopt alternative dispute resolutions. But as you and I know, disputes arise from some disputes are either instituted by the banks, and others are instituted by customers, stakeholders, that is suppliers, and all these other parties. And of course, there is the focus is even made more stricter by the prudential guidelines, the Kenya Banking Sector Charter, and all that. How can we, or how can ICC, or even KBA, or these other industry associations, how can we then bring on the table all the other stakeholders? Because financial institutions could be really interested in ADR, but then if the other parties, or in quote, the adversaries, are not as keen on ADR as financial institutions are, then we may not be able to gain as much traction. Then the question is, what is it that we can do to be able to increase traction for ADR in dispute resolution? Thank you.
I think to answer your question, because you also mentioned from the ICC perspective, there's that stickiness towards not moving to ADR. And one of the things I can advise the banks is to have arbitration clauses in all their agreements with customers. Let it begin at the account opening level. Put an arbitration clause, because you cannot force a party to arbitration. Both parties must agree. So once banks take the lead to have their disputes being arbitrated by having arbitration clauses in the agreements with the customers, then you'd reduce that litigious nature, because there are several benefits that Nikhil mentioned, but before we wind up, about the advantages of ADR over litigation, including maintaining the relationship with your customer. So let it begin from inception, have policies on ADR, corporate policies, and in that way you can also drive awareness so that your clients don't rush to courts. They opt for ADR in their disputes with you. I think to wind up, Nikhil, you can wind us up on the panel quickly.
Thank you. So we wanted us to go through the benefits of arbitration over litigation. So I won't keep you long. I think we spoke about some throughout the process. We talked about cost and time. If an arbitration is conducted in a cost-effective way, it can actually save parties both time and costs. There are numerous mechanisms that can be put into place, as I mentioned, incorporating certain institutional rules, having provisions in the arbitration agreement, and definitely if everything is tailored as it should be, your time limits are reduced from what you would be going through in court, which I believe would be around a year plus for most claims in court. Perhaps one of the main benefits of arbitration over litigation comes up with the uniformal enforceability of an arbitration award, right? So I think most of you know that, and so we're talking about the international perspective into this. Even for a local transaction, you as a bank may be very successful in getting a multi-million judgment against a borrower or another alternative party. But then when you go to enforce that judgment in Kenya, you'll find that those assets have either been dissipated or they don't exist, right? With arbitration, once you have an arbitration award, it is enforceable in all New York Convention states, and that's automatic enforcement with only very limited grounds on which any court who is a party to the New York Convention would refuse to enforce it. As opposed to a judgment whereby currently Kenyan court judgments have reciprocity with only a few common law jurisdictions, such as the UK and some other jurisdictions. But most of the time, these assets are outside of those jurisdictions. So actually cashing in on a successful judgment is very difficult. So that's one of the key benefits of arbitration. I think we touched a bit on confidentiality. In Kenya, we're very used to seeing news articles of persons of, high-profile individuals, their land, their property being sold, or some other enforcement action being taken. That perhaps could work against a banking institution in terms of the actions they're taking against some of their clients. Again, confidentiality can be included in an arbitration proceedings where you avoid that issue. We talked about arbitrators and the expertise of arbitrators as opposed to relying on the court system. You can actually pick and choose which arbitrator you would want to be on a matter, be it an accountant, be it an accountant and a lawyer, which may be of benefit. And obviously finality. We all know the court systems have numerous tiers until which you will get a final decision. You have magistrates court, a high court, court of appeal. Finality in arbitration is guaranteed by most statutes. It's only very limited grounds, procedural grounds, on which an arbitration award would be set aside. So I think that sums it up. Yeah.
Thank you so much, Raymond, Dr. Mutuma, and Nikhil for that presentation. And on that, ladies and gentlemen, we wind up this panel discussion.
Thank you very much. Thank you, thank you. Give them another round of applause. From here, we shall progress for our lunch. Shine, I think we can take the photo after. Yeah. Okay, just make sure as you walk out for your lunch, you get a voucher, a food voucher from Shine. Yeah, thank you very much. We meet at exactly 2:15, 45 minutes. Thank you.
Credit is an extremely important tool for poverty alleviation in helping people grow because it gives people access to things the ordinary could not afford by boosting their purchasing power.
One of the major challenges that businesses across Africa face today is the lack of access to funding.
There's a huge gap in the consumer credit market. A lot of people who need credit to optimize their lives can't access it because even though they are theoretically credit-worthy, they can't provide concrete credit ratings that prove they are trustworthy.
Opportunities are plentiful, but there is the issue of having the funding to rise up to those opportunities and deliver excellently.
When you look at a lot of advanced societies today, you realize that the availability of credits is what has powered a lot of their progress and success.
At Advancedly, we pride ourselves in providing support to our progress partners by providing them with debt funding to grow and scale.
Lipa Later provides instant access to credit by enabling people to buy now, pay later.
CredPal provides credits to help people meet important obligations when they need to.
MarketForce was founded in 2019 to digitize retail trade for emerging markets by enabling consumer brands to grow their distribution network across Africa.
When you're looking to solve a problem in the market, especially when you're just starting out, financial partnerships are crucial to unlocking potential. Financial partnerships, like what we have with Advancedly, provides us with the fuel we need to make large strides forward.
Finding a finance partner that backs you with debt capital you need to fuel your business model is great. However, being in business with one that has been completely invested in our growth journey has been truly inspiring.
Advancedly understands what it's like to operate in the African market with all of its peculiarities.
With Advancedly, we are supported with tangible and intangible things that give us the confidence to chase our goals with precision.
Beyond finance partners, we are progress partners, working to build a world where access to money is not a barrier to progress.
It has been incredibly important to have a partner like Advancedly, who understands what it takes to operate across African markets, shares our ambition for growth, and can keep pace with our evolving needs.
We were so grateful to have been given the opportunity to try. That's what a lot of entrepreneurs need to succeed. the opportunity to try, and people who will take a chance on them and give them that opportunity. We've been fortunate on our journey to find partners who have taken a chance on us, like our finance partners at Advancely.
Credit is an extremely important tool for poverty alleviation in helping people grow because it gives people access to things the ordinary could not afford by boosting their purchasing power.
One of the major challenges that businesses across Africa face today is the lack of access to funding.
There's a huge gap in the consumer credit market. A lot of people who need credit to optimize their lives can't access it because even though they are theoretically creditworthy, they can't provide concrete credit ratings that prove they are trustworthy.
Opportunities are plentiful, but there is the issue of having the funding to rise up to those opportunities and deliver excellently.
When you look at a lot of advanced societies today, you realize that the availability of credits is what has powered a lot of their progress and success.
At Advancely, we pride ourselves in providing support to our progress partners by providing them with debt funding to grow and scale.
Lipa Later provides instant access to credit by enabling people to buy now, pay later.
CredPal provides credits to help people meet important obligations when they need to.
MarketForce was founded in 2019 to digitize retail trade for emerging markets by enabling consumer brands to grow their distribution network across Africa.
When you're looking to solve a problem in the market, especially when you're just starting out, financial partnerships are crucial to unlocking potential. Financial partnerships, like what we have with Advancely, provides us with the fuel we need to make large strides forward.
Finding a finance partner that backs you with debt capital you need to fuel your business model is great. However, being in business with one that has been completely invested in our growth journey has been truly inspiring.
Advancely understands what it's like to operate in the African market with all of its peculiarities.
With Advancely, we are supported with tangible and intangible things that give us the confidence to chase our goals with precision.
Beyond finance partners, we are progress partners, working to build a world where access to money is not a barrier to progress.
It has been incredibly important to have a partner like Advancely, who understands what it takes to operate across African markets, shares our ambition for growth, and can keep pace with our evolving needs.
We were so grateful to have been given the opportunity to try. That's what a lot of entrepreneurs need to succeed. The opportunity to try, and people who will take a chance on them and give them that opportunity. We've been fortunate on our journey to find partners who have taken a chance on us, like our finance partners at Advancely.
Credit is an extremely important tool for poverty alleviation in helping people grow because it gives people access to things the ordinary could not afford by boosting their purchasing power.
One of the major challenges that businesses across Africa face today is the lack of access to funding.
There's a huge gap in the consumer credit market. A lot of people who need credit to optimize their lives can't access it because even though they are theoretically creditworthy, they can't provide concrete credit ratings that prove they are trustworthy.
Opportunities are plentiful, but there is the issue of having the funding to rise up to those opportunities and deliver excellently.
When you look at a lot of advanced societies today, you realize that the availability of credits is what has powered a lot of their progress and success.
At Advancely, we pride ourselves in providing support to our progress partners by providing them with debt funding to grow and scale.
Lipa Later provides instant access to credit by enabling people to buy now, pay later.
CredPal provides credits to help people meet important obligations when they need to.
MarketForce was founded in 2019 to digitize retail trade for emerging markets by enabling consumer brands to grow their distribution network across Africa.
When you're looking to solve a problem in the market, especially when you're just starting out, financial partnerships are crucial to unlocking potential. Financial partnerships, like what we have with Advancely, provides us with the fuel we need to make large strides forward.
Finding a finance partner that backs you with debt capital you need to fuel your business model is great. However, being in business with one that has been completely invested in our growth journey has been truly inspiring.
Advancely understands what it's like to operate in the African market with all of its peculiarities.
With Advancely, we are supported with tangible and intangible things that give us the confidence to chase our goals with precision.
Beyond finance partners, we are progress partners, working to build a world where access to money is not a barrier to progress.
It has been incredibly important to have a partner like Advancely, who understands what it takes to operate across African markets, shares our ambition for growth, and can keep pace with our evolving needs.
We were so grateful to have been given the opportunity to try. That's what a lot of entrepreneurs need to succeed. The opportunity to try and people who will take a chance on them and give them that opportunity. We've been fortunate on our journey to find partners who have taken a chance on us, like our finance partners at Advancely.
Credit is an extremely important tool for poverty alleviation in helping people grow because it gives people access to things they ordinarily could not afford by boosting their purchasing power.
One of the major challenges that businesses across Africa face today is the lack of access to funding.
There's a huge gap in the consumer credit market. A lot of people who need credit to optimize their lives can't access it because even though they are theoretically creditworthy, they can't provide concrete credit ratings that prove they are trustworthy.
Opportunities are plentiful, but there is the issue of having the funding to rise up to those opportunities and deliver excellently.
When you look at a lot of advanced societies today, you realize that the availability of credits is what has powered a lot of their progress and success.
At Advancely, we pride ourselves in providing support to our progress partners by providing them with debt funding to grow and scale.
Lipa Later provides instant access to credit by enabling people to buy now, pay later.
CredPal provides credits to help people meet important obligations when they need to.
MarketForce was founded in 2019 to digitize retail trade for emerging markets.
is an extremely important tool for poverty alleviation in helping people grow because it gives people access to things they ordinarily could not afford by boosting their purchasing power.
One of the major challenges that businesses across Africa face today is the lack of access to funding.
There's a huge gap in the consumer credit market. A lot of people who need credit to optimize their lives can't access it because even though they are theoretically creditworthy, they can't provide concrete credit ratings that prove they are trustworthy.
Opportunities are plentiful, but there is the issue of having the funding to rise up to those opportunities and deliver excellently.
When you look at a lot of advanced societies today, you realize that the availability of credits is what has powered a lot of their progress and success. At Advancedly, we pride ourselves in providing support to our progress partners by providing them with debt funding to grow and scale.
Lipa Later provides instant access to credit by enabling people to buy now, pay later.
CredPal provides credits to help people meet important obligations when they need to.
MarketForce was founded in 2019 to digitize retail trade for emerging markets by enabling consumer brands to grow their distribution network across Africa.
When you're looking to solve a problem in the market, especially when you're just starting out, financial partnerships are crucial to unlocking potential. Financial partnerships, like what we have with Advancedly, provides us with the fuel we need to make large strides forward.
Finding a finance partner that backs you with debt capital you need to fuel your business model is great. However, being in business with one that has been completely invested in our growth journey has been truly inspiring.
Advancedly understands what it's like to operate in the African market with all of its peculiarities.
With Advancedly, we are supported with tangible and intangible things that give us the confidence to chase our goals with precision.
Beyond finance partners, we are progress partners, working to build a world where access to money is not a barrier to progress.
It has been incredibly important to have a partner like Advancedly, who understands what it takes to operate across African markets, shares our ambition for growth, and can keep pace with our evolving needs.
We were so grateful to have been given the opportunity to try. That's what a lot of entrepreneurs need to succeed. The opportunity to try and people who will take a chance on them and give them that opportunity. We've been fortunate on our journey to find partners who have taken a chance on us, like our finance partners at Advancedly.
Credit is an extremely important tool for poverty alleviation in helping people grow because it gives people access to things they ordinarily could not afford by boosting their purchasing power.
One of the major challenges that businesses across Africa face today is the lack of access to funding.
There's a huge gap in the consumer credit market. A lot of people who need credit to optimize their lives can't access it because even though they are theoretically creditworthy, they can't provide concrete credit ratings that prove they are trustworthy.
Opportunities are plentiful, but there is the issue of having the funding to rise up to those opportunities and deliver excellently.
When you look at a lot of advanced societies today, you realize that the availability of credits is what has powered a lot of their progress and success. At Advancedly, we pride ourselves in providing support to our progress partners by providing them with debt funding to grow and scale.
Lipa Later provides instant access to credit by enabling people to buy now, pay later.
CredPal provides credits to help people meet important obligations when they need to.
MarketForce was founded in 2019 to digitize retail trade for emerging markets by enabling consumer brands to grow their distribution network across Africa.
When you're looking to solve a problem in the market, especially when you're just starting out, financial partnerships are crucial to unlocking potential. Financial partnerships, like what we have with Advancedly, provides us with the fuel we need to make large strides forward.
Finding a finance partner that backs you with debt capital you need to fuel your business model is great. However, being in business with one that has been completely invested in our growth journey has been truly inspiring.
Advancedly understands what it's like to operate in the African market with all of its peculiarities.
With Advancedly, we are supported with tangible and intangible things that give us the confidence to chase our goals with precision.
Beyond finance partners, we are progress partners, working to build a world where access to money is not a barrier to progress.
It has been incredibly important to have a partner like Advancedly, who understands what it takes to operate across African markets, shares our ambition for growth, and can keep pace with our evolving needs.
We were so grateful to have been given the opportunity to try. That's what a lot of entrepreneurs need to succeed. The opportunity to try and people who will take a chance on them and give them that opportunity. We've been fortunate on our journey to find partners who have taken a chance on us, like our finance partners at Advancely.
Credit is an extremely important tool for poverty alleviation in helping people grow because it gives people access to things the ordinary could not afford by boosting their purchasing power.
One of the major challenges that businesses across Africa face today is the lack of access to funding.
There's a huge gap in the consumer credit market. A lot of people who need credit to optimize their lives can't access it because even though they are theoretically credit worthy, they can't provide concrete credit ratings that prove they are trustworthy.
Opportunities are plentiful, but there is the issue of having the funding to rise up to those opportunities and deliver excellently.
When you look at a lot of advanced societies today, you realize that the availability of credits is what has powered a lot of their progress and success. At Advancely, we pride ourselves in providing support to our progress partners by providing them with debt funding to grow and scale.
Lipa Later provides instant access to credit by enabling people to buy now, pay later.
CredPal provides credits to help people meet important obligations when they need to.
MarketForce was founded in 2019 to digitize retail trade for emerging markets by enabling consumer brands to grow their distribution network.
Credit is an extremely important tool for poverty alleviation in helping people grow because it gives people access to things the ordinary could not afford by boosting their purchasing power.
One of the major challenges that businesses across Africa face today is the lack of access to funding.
There's a huge gap in the consumer credit market. A lot of people who need credit to optimize their lives can't access it because even though they are theoretically credit worthy, they can't provide concrete credit ratings that prove they are trustworthy.
Opportunities are plentiful, but there is the issue of having the funding to rise up to those opportunities and deliver excellently.
When you look at a lot of advanced societies today, you realize that the availability of credits is what has powered a lot of their progress and success. At Advancely, we pride ourselves in providing support to our progress partners by providing them with debt funding to grow and scale.
Lipa Later provides instant access to credit by enabling people to buy now, pay later.
CredPal provides credits to help people meet important obligations when they need to.
MarketForce was founded in 2019 to digitize retail trade for emerging markets by enabling consumer brands to grow their distribution network across Africa.
When you're looking to solve a problem in the market, especially when you're just starting out, financial partnerships are crucial to unlocking potential. Financial partnerships, like what we have with Advancely, provides us with the fuel we need to make large strides forward.
Finding a finance partner that backs you with debt capital you need to fuel your business model is great. However, being in business with one that has been completely invested in our growth journey has been truly inspiring.
Advancely understands what it's like to operate in the African market with all of its peculiarities.
With Advancely, we are supported with tangible and intangible things that give us the confidence to chase our goals with precision.
Beyond finance partners, we are progress partners, working to build a world where access to money is not a barrier to progress.
It has been incredibly important to have a partner like Advancely, who understands what it takes to operate across African markets, shares our ambition for growth, and can keep pace with our evolving needs.
We were so grateful to have been given the opportunity to try. That's what a lot of entrepreneurs need to succeed. The opportunity to try and people who will take a chance on them and give them that opportunity. We've been fortunate on our journey to find partners who have taken a chance on us, like our finance partners at Advancely.
Credit is an extremely important tool for poverty alleviation in helping people grow because it gives people access to things the ordinary could not afford by boosting their purchasing power.
One of the major challenges that businesses across Africa face today is the lack of access to funding.
There's a huge gap in the consumer credit market. A lot of people who need credit to optimize their lives can't access it because even though they are theoretically credit worthy, they can't provide concrete credit ratings that prove they are trustworthy.
Opportunities are plentiful, but there is the issue of having the funding to rise up to those opportunities and deliver excellently.
When you look at a lot of advanced societies today, you realize that the availability of credits is what has powered a lot of their progress and success. At Advancedly, we pride ourselves in providing support to our progress partners by providing them with debt funding to grow and scale.
NIPA Later provides instant access to credit by enabling people to buy now, pay later.
CredPal provides credits to help people meet important obligations when they need to.
MarketForce was founded in 2019 to digitize retail trade for emerging markets by enabling consumer brands to grow their distribution network across Africa.
When you're looking to solve a problem in the market, especially when you're just starting out, financial partnerships are crucial to unlocking potential. Financial partnerships, like what we have with Advancedly, provides us with the fuel we need to make large strides forward.
Finding a finance partner that backs you with debt capital you need to fuel your business model is great. However, being in business with one that has been completely invested in our growth journey has been truly inspiring.
Advancedly understands what it's like to operate in the African market with all of its peculiarities.
With Advancedly, we are supported with tangible and intangible things that give us the confidence to chase our goals with precision.
Beyond finance partners, we are progress partners, working to build a world where access to money is not a barrier to progress.
It has been incredibly important to have a partner like Advancedly, who understands what it takes to operate across African markets, shares our ambition for growth, and can keep pace with our evolving needs.
We were so grateful to have been given the opportunity to try. That's what a lot of entrepreneurs need to succeed. The opportunity to try and people who will take a chance on them and give them that opportunity. We've been fortunate on our journey to find partners who have taken a chance on us, like our finance partners at Advancedly.
Credit is an extremely important tool for poverty alleviation in helping people grow because it gives people access to things the ordinary could not afford by boosting their purchasing power.
One of the major challenges that businesses across Africa face today is the lack of access to funding.
There's a huge gap in the consumer credit market. A lot of people who need credit to optimize their lives can't access it because even though they are theoretically credit-worthy, they can't provide concrete credit ratings that prove they are trustworthy.
Okay, good afternoon. We have an online audience as well. We want to welcome them back again from lunch as we start. So this afternoon we have 3 sessions. We have 2 panel discussions and a presentation from on the global banking rules, URDTT. And that will be brought forth by David Maynell, founder, Trade LC Advisory. Please put up his bio. Is he on? You can put him on. He can introduce himself as he goes through his presentation. David, welcome. Dave, welcome. The floor is yours. Thank you.
Hi there, thank you very much. I can't share my presentation. Can you enable me to do so?
So introduce yourself first, then you can share your presentation and talk through it. Thank you.
Yeah, I'm an independent trade consultant and advisor. I previously worked for Deutsche Bank up until about 8-9 years ago in a number of international locations around the world. Among my roles at the moment, I'm a senior technical advisor to the ICC Banking Commission and trade rules advisor to the Centre for Digital Trade and Innovation in the UK. I've been involved in drafting many ICC digital rules and paper rules as well. Okay, well, to begin with, I think we can all agree that over the circumstances of the last few years have forced a rethink in the trade finance world. and brought digitalisation into focus far more. Still at stages. Building are in place. But the challenge that we face is to replace what is estimated by the ICC to be something like 4 billion paper documents that circulate in the trade system. It was highlighted in the recent G7 conference that digital technology is at the heart of building back better from the pandemic and will play a vital role in improving internet safety and transforming the economy. And one of the key interventions that was identified by the G7 was greater adoption of electronic transferable records. And the members agreed to identify the legal and regulatory barriers that were preventing such usage to make more economic savings, generate efficiencies in time, security and data processing. Now, for my first slide, I just want to go back basically over the last 3 decades, because we've been looking at technology for a long time now. To begin with, we had many e-commerce solutions that were in place in the market around the world. And what we saw in banks was that many of the banks themselves provided their own proprietary trade online solutions. But the problem was that those solutions didn't really talk to each other. And I think the next key stage we saw was on the workflow side. We saw many banks outsourcing their trade operations or even centralising their trade finance operations. Some of these worked, some of these didn't, some are still ongoing, some finished some time ago. But the key really was to integrate the financial and the physical supply chain and together get closer together with the trade finance and cash management side. And what that needed was a digital data. It needed increased access points across the value chain. It needed a far wider range of client-oriented solutions, and we needed global applicability. But the biggest problem, as I've put at the bottom of the screen, is that whilst the physical supply chain moves forward very quickly each year, there was the financial supply chain that had been playing catch-up and was often very, very far behind. Now, I'm going to thank David Henner for this slide. I don't know if he's still on the call. He introduced me to this slide from IGTB some time back. And I like this because it shows a lot of the new technologies that are enabling the digitalisation of trade. And I found this to be a very useful picture in order to illuminate how and where certain technologies are already providing benefit. For instance, if you look at the DLT and blockchain side, this is already being used to create smart letters of credit, to enhance document examination, and for real-time verification and reconciliation. On the OCR side, optical character recognition. This enables text recognition and allows for completing of the checking for the completeness of documents. I won't go into the rest of this, we haven't really got time for any of it, but what I will mention in addition to this slide is that it was mentioned by the G7 that transferable records, such as bills of lading, are the most important commercial documents in trade and trade finance. But to clarify this, less than 1% of bills of lading globally are in electronic form. So this is a huge missed opportunity, given that electronic transferable records will make it easier, cheaper, faster and greener for companies to trade. It will really bring global trade into the 21st century. Now, on the trade finance market, we are, as I've mentioned earlier, seeing some changes. I think we're finally seeing a synchronicity between technology, between platform providers, market practice, law and ICC rules. I'll say a few words about law later on, and the ICC rules, of course, the URDTT I will talk about separately. We need the synchronicity because it would enable interoperability. Many people have spoken in the last few years about digital islands. In other words, people that can't, systems that can't talk to each other. We need this interoperability. As I've said in here as well, overcoming the inertia of tradition. In other words, stop doing it the way we've always done it, because we have always done it that way. We need to change. We need to break out of that. Now, 3 key changes that we've seen, or redevelopments in the last few years. The first was the UNCITRAL model law on electronic transferable records. Now, this enables the legal use of electronic transferable records, both domestically and internationally. I'll say a few more words about that later on. In July 2019, we saw the introduction of the ICC E-rules, the EUCP and the EURC, and these are rules that are supplements for electronic presentations under documentary credits and collections. And then finally, in October 2021, we saw the introduction of the ICC Uniform Rules for digital trade transactions, which serve as an overarching framework for digital trade transactions. So an overview, on the ICC rules again, I've already mentioned that the EUCP is a supplement for documentary credits and the EURC is a supplement for documentary collections. The updated versions of EUCP and the EURC were introduced only last month. So if you go to the ICC website, you can download these free of charge. And a quick word again on URDTT. These, as I've mentioned, serve as an overarching framework for digital trade transactions, thus providing global standardization, consistency, and conformity. Now, an overview of the URDTT. We could do a whole session on this, but we're going to try and get through it in a few minutes. They came into force on the 1st of October 2021. At the inception of the drafting process, the drafting group was given a strict mandate to develop a high-level framework outlining obligations, rules and standards for the digitalisation of trade transactions. Now, this work is now being supplemented by a commercialisation substream, which was established with cross-industry representation from all key trade regions. And this commercialisation group is examining both the ICCE rules and at URDTT and is developing a framework to evaluate the challenges and ideas to drive commercialisation and adoption forward. I'd also mention there is a URDTT user guide, which you can download from the ICC website free of charge, which details various generic themes which need to be taken into account when you utilise the URDTT. And these include such things as the buyer and seller agreement, legal issues, technology requirements, and the usage and examination of electronic records. There's also a very comprehensive section on operational issues, and I strongly recommend that you download this document just to have a look at it. So what is a digital trade transaction? As stated in the rules, it's a process as agreed by the buyer and seller, whereby electronic records are used to evidence the underlying sale and purchase of goods and services and the incurring of a payment obligation. Key considerations of the URDTT. In order to be subject to the rules, a digital trade transaction must specifically state so, and it should satisfactorily reflect the underlying commercial contract. And as a matter of course, and in order to allow for the necessary examination process of the electronic records, it must specify the terms and conditions by which compliance of an electronic record will be determined. On the benefit side, the rules focus entirely on the digital environment. No paper involved at all. As soon as a piece of paper comes into a transaction, it is no longer subject to the URDTT. Very important, the rules are independent, they are neutral. They are not subject to a platform provider, and they provide a collective understanding of terms and definitions. They align with the G7 framework for electronic transferable records, which means they are also compatible with the inter-trial model law on electronic transferable records. It means we can avoid lots of repetition within platform rule books whilst promoting and supporting the usage of electronic records. There's no need for the platform rule books to include lots of different rules when they can just stay subject to the URDTT. It doesn't, of course, prohibit and constrain the continued use of existing private rule books, but they are designed to provide a structure under which other rule books can extend. I said I wanted to say a few words about the law side. The uniform or the model law on electronic transferable records is already in use in a number of countries, such as Bahrain, Abu Dhabi, Singapore, and others. And there's numerous other countries on the way. One of which is the UK, where the Electronic Trade Documents Bill, now known as the Electronic Trade Documents Act, was approved by royal assent only a couple of weeks ago. And this will come into being within about 2 months. Now, this legislation started some time back. It's taken a while to get there. And whilst it may look like a small piece of legislation, it's actually a game changer for world trade. Much of world trade is underpinned by English law. That's a kind of legacy of the UK's historic role in trade. And this is not just across the Commonwealth, but for every buyer, seller, insurance, financier and intermediary that uses English law, the basis for contract law for handling trade documents. The bill will therefore have a disproportionately large and positive impact on global trade at a time when companies all across the world are facing unsustainably high trade costs. This reform will not only benefit the uniform rules for digital trade transactions, but also other ICC rules such as the EUCP and the EURC. And it's going to provide support to the trade industry to make the necessary steps forward in terms of digitalisation. Now, most jurisdictions around the world are working more on the legal side. For instance, in the US, in July, the Uniform Law Commission passed several amendments to the Uniform Commercial Code, which addressed things such as digital records, electronic signatures, etc. This is ongoing. It needs to be taken up by each state separately, so it will take a while. In the EU, there is some concern about fragmentation with GC members reforming laws, so they're trying to find a pan-EU solution. But Germany and France, for instance, are moving very, very quickly on this, and I expect to see some legislation in place this year. In Asia, in India, the Information Technology Act of 2000, which I don't really know too well, but I understand it grants legal recognition to electronic documents. So we're already moving forward in India. In China, the same thing. There's rapid adoption of instant trial model laws, and their task force is up and running, moving very, very quickly. As a final point on the law side, I just want to mention a comment from Chris Southworth, who's the Secretary General of the ICC UK. And he said the big point around English law is it's not about England. It's not about English law. It's about its role in trade worldwide. With many countries using the same centuries-old foundational law, the Rules of Exchange Act and Carriage of Goods by Sea Act, this should theoretically now mean they can adopt this new bill, wholesale or with minor changes. So the potential is there to accelerate legal reform faster than any other global network. Two final slides. I just want to give you updates on what's happening elsewhere. There was an ICC Digital Standards Initiative, which looks at establishing a global harmonised trade environment to address challenges and bridge digital standard gaps. These include things such as lack of coherent standards, legal uncertainty regarding the acceptance of electronic documents, platform rulebooks that are perhaps hindering cross-platform title document exchange, unclear requirements for foundational trade standards, and insufficient standards to simplify blockchain and non-blockchain integration. And finally, the other initiative I want to tell you about is the Centre for Digital Trade and Innovation, C4DTI. Digitalisation will enable us to deliver a far more inclusive, sustainable and greener trading system where more SMEs can participate in trade, making trade finance more accessible and paper no longer required. And what C4DTI is doing is providing an opportunity to make this a reality and meet many governments' ambitions to have a modern, open trading system. It's led by ICC UK, but it involves the government, it involves the DSI I've mentioned previously, and it's working with many different governments overseas. At the moment, very closely with Singapore and obviously in Asia and in Europe. They are looking to lead on digital trading ecosystems. They've created, some of you may have already seen it, the ICC Digital Trade Roadmap, something that's available on the ICC website free of charge again. And they're also looking at guides to legal reform and updating the Commonwealth Report on paperless trade. So these are really very quick. I didn't have given much time today, and I have to leave in a few moments anyway. I hope this gives you an idea of what's moving ahead on the legal side and also on the ICC rules side. I have got time for a couple of questions if anybody has any.
David, thank you very much for that presentation. I know we delayed, we rushed you on time. I don't know how much time you have. Do you have maybe another 5 minutes we can have questions?
I can give you a couple of minutes. Give a couple of minutes, yes.
Okay, thank you. So anybody with a question on the floor through Mentimeter or through our online team, you can ask your questions to Dave directly.
What I can also say is if you have, if any questions come up at a later date on these issues that people would like clarified, my email is on that screen and I can share the presentation with you separately. So people can also contact me by email if they so wish.
Indeed, David. I think what we will do is, you have a question? No. What we will do is that I think your details are there. We'll recirculate them. And in addition to that, probably we'll work with the Secretariat to see whether we can even have a webinar where we can explore on this in detail.
So I'm always happy to answer questions at a later stage if people wish to email me.
Indeed. Thank you so much, David. Thank you. Let us give David a hand as he leaves.
Thank you very much.
Thank you very much. Yeah. There's a clarification I think we had discussed earlier, the last panel. As we call in the next panel discussion, there's something we had discussed earlier. Do you want to clarify it?
Thank you. I was asked to clarify after the award has been rendered by an arbitrator, whether we have to go back to court for enforcement. The answer is yes, but you go back on a very limited ground under the Arbitration Act for recognition of the award for purposes of enforcement. So that is a shorter process. There are very limited procedural grounds on which the same can be set aside, but you would have to go back to get an enforceable award. Does that answer the
person who had asked the question? I believe they are satisfied now. Yeah, thank you very much.
Credit is an extremely important tool for poverty alleviation in helping people grow because it gives people access to things the ordinary cannot afford by boosting their purchasing power.
One of the major challenges.
Extremely important tool for poverty alleviation in helping people grow because it gives people access to things the ordinary could not afford by boosting their purchasing power.
One of the major challenges that businesses across Africa face today is the lack of access to funding.
There's a huge gap in the consumer credit market. A lot of people who need credit to optimize their lives can't access it because even though they are theoretically credit-worthy, they can't provide concrete credit ratings that prove they are trustworthy.
Opportunities are plentiful, but there is the issue of having the funding to rise up to those opportunities and deliver excellently.
When you look at a lot of advanced societies today, you realize that the availability of credits is what has powered a lot of their progress and success. At Advancedly, we pride ourselves in providing support to our progress partners by providing them with debt funding to grow and scale.
Lipa Later provides instant access to credit by enabling people to buy now, pay later.
Credpal provides credits to help people meet important obligations when they need to.
MarketForce was founded in 2019 to digitize retail trade for emerging markets by enabling consumer brands to grow their distribution network across Africa.
When you're looking to solve a problem in the market, especially when you're just starting out, financial partnerships are crucial to unlocking potential. Financial partnerships, like what we have with Advancedly, provides us with the fuel we need to make large strides forward.
Finding a finance partner that backs you with debt capital you need to fuel your business model is great. However, being in business with one that has been completely invested in our growth journey has been truly inspiring.
Advancedly understands what it's like to operate in the African market with all of its peculiarities.
With Advancedly, we are supported with tangible and intangible things that give us the confidence to chase our goals with precision.
Beyond finance partners, we are progress partners, working to build a world where access to money is not a barrier to progress.
It has been incredibly important to have a partner like Advancedly, who understands what it takes to operate across African markets, shares our ambition for growth, and can keep pace with our evolving needs.
We were so grateful to have been given the opportunity to try. That's what a lot of entrepreneurs need to succeed. The opportunity to try and people who will take a chance on them and give them that opportunity. We've been fortunate on our journey to find partners who have taken a chance on us, like our finance partners at Advancedly.
Credit is an extreme
sometimes, but I'll try to dive right into it. We're really just a liquidity partner for a lot of businesses, small and medium scale businesses across Africa and emerging markets, providing capital as a service to folks who are lenders themselves, where we have some predictability into their lending base, and then we can partner with them to extend capital to the last mile borrowers. We saw the examples of Lipa Later being a buy now pay later company. Some of us here know of Pezesha, and a lot of other companies that we have backed in this market. But beyond just giving capital to folks, we also got, just being in existence and being in the market, we got to learn about all the challenges that all the businesses face. And then we went on to build our embedded finance product, where we go into ecosystems where folks are typically not lenders, but there's an opportunity for merchants within those ecosystems to lend, to borrow and grow their businesses. If you think about the case of Market Force, for example, where a lot of small and medium scale businesses need actually access to inventory finance and working capital to be able to buy products and sell and continue to grow their businesses. Oftentimes they may not be deemed creditworthy by banks because their credit history or financial history is not very well documented. We're able to leverage alternative data within the ecosystems that they belong to be able to provide alternative credit scoring for them and then provide them with the capital they need to grow. I'm sure a number of us here buy stuff from Carrefour and Naivas. Oftentimes Advances sits behind the scenes powering progress for these businesses. If you go to Carrefour, 70% of the fresh food produce consumed in Carrefour stores every day is packaged and produced by a company called Tigoni Grown. We have literally always been behind the scenes powering Tigoni Grown. So every time you pick up a pack of fruits, vegetables, or whatever it is, 70% of the time you're consuming products that have been financed by Advancely. A lot of our partners as well also provide services to some of the biggest telecommunication companies and also, companies in Africa. Think about Diageo, EABL, Safaricom. Safaricom has gone there to take a very bold step into renewable energy and clean energy. And some of the folks who enable that happen have had to access the working capital and the financing they need to make that happen from Advancely. That's who we really are, and that's why we speak about bringing humanity into financing and providing intuitive solutions that really solve problems for entrepreneurs. That's what we are all about. And again, like we say, when the way for us to actually grow Africa, grow economies, grow the economy of Africa and African countries in itself is by ensuring that businesses, small and medium scale businesses, not just the large corporates, have the tools that they need to be able to grow and experience progress. So we're happy to be a progress partner to a lot of businesses, and we also look to work with anyone in the room who is looking to experience progress in their business. Thank you. I'm sorry. Where you can find us on advancely.com, www.advancely.com. My colleagues are over there as well. We're happy to speak with you. And then, yes, I'm also happy to engage with anyone directly. That's the easiest way to reach us. My email is really just simple, lotana.julian@advancely.com. Please shoot me an email. I have a very open email box, and I'm happy to engage, and then really just eager to power progress with folks in the room. Thank you so much.
We want to thank you very much for partnering with us. I know some of you are getting tired of me saying thank you to our partners. They do a lot to make ensure that our events are successful. We'll now move into our next panel discussion, and I'm going to invite Lewis Ndonga. Is he in the house? Yeah, welcome. You can put up his bio. Okay, so Lewis is an advocate of the High Court practicing with Premier Kenya. He has an interest in corporate advisory, commercial transactions, tech and data protection, law, and real estate law. In particular, he has been involved in advising various clients, including one of the largest betting companies in Kenya, on anti-money laundering obligations and use of proceeds of crime. He's an up and coming, not upcoming. He's an up and coming practitioner. This is innovation. He's an up and coming practitioner with technology, innovation, and data privacy space, interested in the use of law to support innovation and technology. He has recently lent his skills and knowledge in moderating the panel titled Anti-Money Laundering Compliance in Kenya in the FinTech sector in a recently concluded conference in Kenya, bringing together experts from the legal, banking, and telecommunications sector across Africa. So we selected him very carefully based on our theme, and we are sure that he's going to handle it very well. Welcome, Luis. Let's give him a hand.
It's okay. So, good afternoon, everyone. I hope you're all doing well. I'm sure everyone is now full. You have the mental space to go through the next session of our panels today. So, as you've heard, my name is Lewis Donga, and today we have a very interesting and engaging discussion regarding anti-money laundering and use of proceeds of crime with respect to the fintech space. I am actually very, very pleased to hear that Advancedly is here with us as a party or a member of the fintech space, and of course all of you within the space of the banking sector, how you're integrating technology within your own financial systems. This is a very, very keen discussion for us to have. So I will call up the first panelist. Her name is Mrs. Sheila Cadogan. So Sheila Cadogan is the managing partner at Adroit Law. She's an experienced policy analyst and legal practitioner, and her areas of expertise are trade and investment, capital markets, and anti-money laundering, with a focus on financial institutions. In recent years, she worked in the World Bank to develop the financial institutions, national payment systems, and mobile money laws in Somalia. Previously, she worked for the leading think tank on the continent, the South African Institute of International Affairs, as a policy analyst, and was instrumental in developing policies on harmonization of regional economic blocks in Africa, climate change financing for Southern Africa that informed negotiating positions for South Africa as a BRIC country during COP16 in Durban, gender and trade in East Africa, among others. She's a board member of Young Scientists Kenya and True Trade, the trading arm of Self-Help Africa. Thank you so much, Sheila, for joining us. So I will call up the next member of our panel, who is Mr. James Manyonge. So Mr. James is present here on behalf of the Director General of the Financial Reporting Institution, which is the institution in charge of regulating the laws, anti-money laundering laws in Kenya. So James is the Director, Legal Compliance and External Relations at the Financial Reporting Center. He is an anti-money laundering combating financing of terrorism specialist, a certified public secretary, and an advocate of the High Court of Kenya with 27 years post-admission experience in both private and public sectors. James was a member of the ESAAMLG assessment teams that evaluated the republics of Tanzania, Zimbabwe, and Mozambique. He is also the co-chair of one of the 4 review groups of the Eastern and Southern Africa Anti-Money Laundering Group, ESAAMLG, responsible for the monitoring the post-evaluation implementation plans of ESAAMLG member countries. James was the Assistant National Coordinator for Kenya's first ever Money Laundering and Terrorism Financing National Risk Assessment. He was also the Assistant National Coordinator for the just concluded Anti-Money Laundering and Combating the Financing of Terrorism Mutual Evaluation of Kenya. Over the last 17 years, James has undertaken responsibilities on anti-money laundering / combating the financing of terrorism, AML / CFT, anti-corruption, company secretarial practice, policy development, compliance, legislative drafting, central banking with particular reference to banking supervision / regulation, and has been involved in the development, review, and implementation of several financial sector initiatives and legal and regulatory frameworks. He is also a member of various committees and task forces looking into various policy, legal, and regulatory issues. James holds an executive master's in business administration from Kenyatta University in Kenya, a Bachelor of Laws degree from Marathwada University in India, a Bachelor of Social Legislation degree also from Marathwada University, a diploma in law from the Kenya School of Law. He is a member of the Law Society of Kenya and the Institute of Certified Public Secretaries of Kenya. So I would advise that as you're continuing within your professional space, do your best so that your profile takes me 10 minutes to read. So the final panelist is Miss Anne Matu. I'll ask her to join us on stage. So Anne is the Chief Country Compliance Officer for Citibank Kenya and oversees the City Compliance Risk Management Program. She also provides risk strategic direction and facilitates the implementation of the Compliance Risk Management Framework supported by the Comprehensive Strategic Plan in the country. Anne is an ACAMS certified and an experienced banker with 20 years banking experience, having worked in various functions in compliance, operations, KYC, cash management, financial markets, and consumer banking. So thank you so much, all three of you, for accepting our invitation and coming to our panel today. So I would just want to jump right into it. And I would like to start with an introduction to first look at what exactly is the basis of anti-money laundering in this country. We are aware that it is a very important discussion to have, but we need to understand, where do we find, if I was to do a simple Google search online right now, what is one of the first things that would pop up? And I'm sure one of the first things that would pop up is the legal framework, where the law comes from. So I'll start with you, Ms. Sheila, to just start off and give us a very brief introduction of the legal framework that supports anti-money laundering and combating the use of proceeds of crime in Kenya. So Sheila, over to you.
Thank you, Lewis. I think it's crucial actually that we have an overview of the legal framework, because you've seen many acronyms and we don't want to lose our audience today. So maybe in 3 minutes, I'll just give a bit of a snapshot of what the legal framework or regulatory framework that informs the fight on money laundering and countering finance terrorism in Kenya. Now, the one acronym that you normally hear when you talk about money laundering is FATF. FATF stands for the Financial Action Task Force. Now, the Financial Action Task Force is a body that was set up in 1989 with the sole purpose of setting global standards on fighting money laundering. Kenya is a member of the AFTF, and as a result of the recommendations that have been put forth by the AFTF, we are required to cascade those recommendations into our laws. Now, these laws, the main laws are four. One is what we call POCAMLA, or the Prevention of Proceeds of Crime and Anti-Money Laundering Act. And the Act also has its regulations, so the POCAMLA regulations. In addition to that, to assist us in fighting terrorism financing, we have the POTA, the Prevention of Terrorism Act, and it also has its regulations. In addition to that, because we are talking to people who are in the Banking Commission of ICC Kenya, the CBK has issued prudential guidelines, still on AML and CFT. Also, just to say, there are also other regulators that have issued guidelines, for instance, the Insurance Regulatory Authority. So they have also issued their guidelines to help the people that they regulate to fight anti-money laundering. Now, having spoken about the different acts that Kenya has, it's worthwhile to talk about the agencies. The agencies are well represented by my learned friend here, James, who represents the Financial Reporting Center. Now, the Financial Reporting Center is an interesting entity, but I'll come to that. It's interesting because it's independent in a certain way. So when it comes to fighting money laundering, most countries have what we call financial intelligence units. But in Kenya, we call it FRC, because the FRC is mandated to investigate. So for instance, as people who are in banking, when you file your cash transaction reports or your suspicion transaction reports, you normally file them with FRC, who then investigate. So in addition to FRC, which is independent, I would like to categorize the other agencies into 3 blocks. You also have supervisory agencies. So supervisory agencies are like your Central Bank of Kenya, which of course regulates banks, regulates microfinance institutions, and now digital credit lenders. Other supervisory bodies in that block of supervisors would be your Capital Markets Authority, your Retirement Benefits Authority, your IRA, and even the Betting and Licensing Control Board. So those are supervisors that we have in the market. Now from supervisors, the other block we have is law enforcement agencies. So your law enforcement agencies are DCI, which help with the investigative responsibilities, your EACC, which is the Ethics and Anti-Corruption Commission, your Office of the Prosecutor, DPP, and the Asset Recovery Agency. Now from the supervisor and law enforcement, we have another category which we can call reporting entities. So reporting entities are organizations which are required to report any detection of money laundering activities that are going through the entities. An example, without pointing fingers, are my learned friends, advocates or law firms. We are required to report any suspicious activities, but we don't. Others are insurance brokers, accountants, and many others. So in a nutshell, that's the framework, the legal regulatory framework. Just to highlight something, because it has been mentioned in Mr. James's profile. It was mentioned about the mutual evaluation reports. So the AFTF, what is the role of the AFTF? So the AFTF, apart from setting the standards, it assists the countries that are members of FTF to remain compliant, and in addition to that, it assesses the adequacy of the measures that they have put in place in their countries to fight money laundering. How do they do that? It is through the mutual evaluation reports that you had mentioned. So every other maybe decade or so, they go to the various countries and they do these evaluations. So first evaluation for Kenya was done around 2011, and out of that evaluation there were some recommendations. Maybe just to mention 3 of them was that we needed to have an asset recovery agency, which then was brought forth through the POCAMLA laws. We needed to have stringent measures or stringent provisions in the law with regard to beneficial ownership, which were then implemented in the Companies Law of 2015. We have recently gone through an evaluation, and the report of which was published last year. That report, Mr. James will probably speak to it, has been scathing in terms of Kenya's adequacy or the measures that we have in place for fighting terrorism. I think you've seen in the last 2 weeks there's been a flurry, or there have been some activities at the cabinet level and even in parliament. So I think as bankers or people in the banking profession, you should expect to see some changes in the coming months when it comes to the ML laws. Thank you.
Great, thank you. Thank you so much, Sheila. So I would like to now move to you, James, and just look at, we have businesses. Most of the people in the audience here are either bankers who have integrated a lot of fintech within their systems, use of mobile money. Right now, electronic funds transfer is really easy, or members who are strictly outside, individual within the fintech space. From a regulator's perspective, what compliance obligations do you expect to see? I'm not asking what you have seen. Again, as Sheila is saying, there's been a very scathing report on how much people are actually doing. So from your perspective, what do you expect to see from people in the industry that have integrated fintech or are using fintech within their business?
Thank you, Luis. I think first let me start by giving the apologies of my Director General, who was supposed to be sitting in this panel, but due to other duties, he couldn't be here, so he asked me to step in. So we're glad to be here at the Financial Reporting Center. And thank you for those introductions, which makes it then easier. So the legislation she's just talked about, the Proceeds of Crime and Anti-Money Laundering Act, together with the recommendations of the Financial Action Task Force, really set out the obligations of fintechs, of banks, of reporting entities, so to say. The Proceeds of Crime and Anti-Money Laundering Act has 2 groups of reporting entities: financial institutions and designated non-financial businesses and professions. So the obligations set out in Part 4 of that Act and they're applicable for all, whether you are a fintech, whether you are a bank, whether you are an accountant, whether you're a lawyer, a real estate dealer, the obligations are all. And why are those obligations there? She gave a very good rundown of the players in the space of combating money laundering. And she started right with the reporting institutions, right up to, she left it at the DPP, but she should have gone further to the judiciary. We all have a role to play. If we are to combat money laundering, if we are to prevent terrorism funds from flowing, then there's a role for each one to play, whether you're a reporting institution, as a fintech or a bank, or as a forex bureau, or as a professional, as an accountant, there's a role for you to play. Whether you are in the space of analyzing those transactions, of which we are at the Financial Reporting Center, we then look at those transactions and look at them, and then whether you're law enforcement or DPP prosecuting or judiciary determining or asset recovery going after those. So if we then play the role, because the way the AML safety framework is designed is that each of these parties, if we play a role, then we will do what is intended, which is really to keep the profit out of the crime, to make criminal activity not profitable. Because the trend has been that criminals, they need for business. They ought to make money. Some engage in criminality. The bulk, in particular, is for business. For if it's terrorism financing, it could be ideological, it could be business. So how do we remove the profit out of the crime? So the obligations which have been placed on reporting entities, there are about 5 or 6. The first one is to monitor on an ongoing basis the transactions that your clients deal with. Why is monitoring important? Monitoring is important because then we'll be able to pick out what is unusual. We don't intend that as businesses, you stop your clients from dealing with what they're doing. No, just business should continue as usual. But if there's something in your clients' transactions, in your clients' activities, in the way your client is operating, then you monitor that and you report that to us, to the Financial Reporting Center. The Financial Reporting Center, we are a financial intelligence unit. It's just that we use the word reporting. But when you look at it in terms of the whole framework, where do we say it? We're actually a financial intelligence unit. So you report, you monitor your client's transactions, and then you report that. Whether it's a suspicious transaction or a suspicious activity. The other obligation then is to verify the identity of the customer, the transaction, etc. So there's to verify, you have to know your customer, you have to know who James is. If you walk into open a business relationship with you, so who is James? How do you know that this fellow who's walking in is James? You have to ask for some certain documentation, identification, and just verify that I am who I say I am, and then carry out your checks. The other obligation which is required then of all reporting institutions, of which fintechs are then, is then to establish and maintain customer records. Now, if James is the customer, in addition to the identification documents of James as a customer, you then want to have records of how James is transacting. These records are important for us because the way money laundering operates is that you kind of audit the trail of the transactions. On most instances, you will not be able to establish at face value that the transaction or activity which has taken place is illicit or unusual. So we then need to maintain those records so that even you, when you're doing your reporting and your KYC, you're able to go back and then you can have something to report. And for us, when that is reported, we have something to look at, interrogate, and if you're not happy with, then we'll then report it to the law enforcement as you indicated, and then it will go up the ladder to then see. So maintenance of customer records is important. The law says this should be kept for a minimum of at least 7 years from the date of the transaction or the end of the business relationship. So if I terminate a business relationship with you as a fintech today, then 7 years from today, you have to maintain those records. Why? Because tomorrow, ARA might come calling, EACC might come calling, DCI might come calling. And they want to look at those records to be able to establish those transactions. Then we also have an obligation to maintain internal controls within the fintech or within the bank or whichever organization. The internal controls are important then to determine how AML obligations will be dealt with. The internal controls is the line of reporting within the organization. Who's going to make the report? To who do we make the report? How do we make the report? You have to have a money laundering reporting officer, or in other places it's called a compliance officer. This is the officer who is then responsible for interacting with the financial reporting center, sending the reports, determining if the information which has been brought to him is suspicious, warranting for it to then be sent at the financial reporting center. There's a requirement for the money laundering reporting officer to be a person of seniority within the organization, and this is to enable him to ask the question, because if you just appoint a junior officer, he may not be able to ask the question and be put down. So he has to be of senior management level so that he can be able to dig for this information. And he has to be independent. It's a requirement that this person should be independent and should be able to make independent decisions, whether to report or not to report, or what action to take, independently of the CEO, independently of management, because we need independence then and all this. The other obligation then, as set out in the Act, of course, is to register with a center. We need you, the fintech, to register with us so that we can know who you are, where you are, and in our registration, we recently, last year, we enhanced the registration mechanism. We want to know if you're regulated, who's your primary regulator, the space you operate in. We want to know the details of the CEO, the details of the board. We want to know the details of the money laundering reporting officer. We also want to know the ultimate beneficial ownership. She mentioned about changes to the Company Act, because what you're now seeing the trend is that there are people hiding behind companies, behind limited organizations. We want to know who are the natural persons behind all that. So we need to get that obligation. So in addition to all this, the other key thing is then to also understand the risks. The environment in which you operate in, one has to understand the money laundering, terrorism financing risks. So this will then be either the country risk, the sectoral risk, or also the institutional risk. Institutions are supposed to undertake risk assessment so that they can then understand the sector within which they operate in. So if for fintechs, whichever sector you're in, you have to undertake as an institution, who are your customers? Who are your products? What products are you dealing with? What risks? And when you're talking of risks here, I'm limiting myself to money laundering and terrorism financing risks. The products that fintechs deal with, there's the speed with which the transactions are dealt with. There's anonymity because there's non-face-to-face interventions. There's non-face-to-face transactions. In a bank, if I go to Anne's bank and I transact, I'm over the counter. She'll be looking at me like all the CCTVs also. But when I'm transacting on my mobile device, you don't know who's on the other end. So you need to look at all these risks. In Kenya currently, we've been experiencing cyber attacks in the private and public sector. What are some of the risks also arising from this technology? So these are some of the obligations that are then required for one to know to set place. Thank you.
Thank you so much, James. I can also comment and say that I think there's been a lot of working together internally between government agencies. I have personally seen this between FRC and, as Anne put it, BCLB. These two organizations are working as one to identify within this space what should we be doing, how should we be improving the kind of compliance we are seeing with members within that space. And now to move specific to sector specific, I think one of the most, I would say, unluckiest persons on this panel would be Anne, because she would need to answer the question on what risks
ideally, would somebody as you, what you've seen within the space as you've practiced, what risks have you experienced or have you seen is possible for entities working within the banking sector or entities that are integrating a certain fintech infrastructure, or even individual fintech entities operating? What kind of risks are present, and ideally, what mitigating measures do you feel entities should consider to try and curb these risks from becoming too much? So, Anne?
Thank you, Lois, and my fellow panelists. I think James has actually given the theoretical response to that question. He did cover the risks that you would expect from a fintech perspective. So I'll just really summarize what he spoke to in my comments. Now, when it comes to fintech, broadly classifying fintechs, it will be into three categories. Yeah? One is your typical solution providers, which would be considered low risk when it comes to money laundering and terrorist financing risk. We have the digital lenders. Digital lenders, the main risk would be reputational and credit risk. And we have the payment service providers. Now, this category has a higher money laundering and terrorist financing risk and bribery risk. This is also the category that most financial institutions or banks tend to partner with for purposes of taking advantage of their innovations. I think James did mention in terms of speed when it comes to transaction speed in terms of onboarding their clients, and specifically through speaking to financial institutions that do not have a retail presence or a big retail presence. It's increasingly expensive to have brick and mortar or presence in each and every county in the country, or even out of the country for cross-border flows. So we found that when it comes to reach outreach or being able to reach a wider base of clients, financial institutions will want to partner with fintechs. So where do we draw the line when it comes to responsibilities in terms of preventing money laundering risks? So say, for example, as a financial institution today, I partner with a payment service provider. Whose responsibility is it to ensure that illicit flows are not getting into the financial institution for one, or into the platform that I have partnered with? And I think what James said in a nutshell is that it is everyone's responsibility. We did have instance where I think there was a case you may all be aware of in the banking sector where there was a terrorist financing incident, and each of the players who were involved in these transactions expected the other player to have taken responsibility or to have taken preventive measures to ensure that the crimes were not committed within the platform. So as an institution, if you do partner with a fintech, really, I think the first thing to do is to take a risk-based approach and know that this partner, as much as they are either you treat them as a vendor or a fellow partner, even if you're just using the platform, at onboarding, understand the AML risk framework that they have in place, and so that you know that they're safeguarding you at the entry level, because these flows are finally going to come into your system as a bank. Conduct a full due diligence, and if there's need for training or need for you to continuously review the AML framework and the systems that this institution is using, then put that in your program and in your internal policies. When it comes to transaction monitoring, I think there is need to be aware of the additional leg of exposure in terms of third-party payments that may flow through your systems as a bank, and this coming through the fintech. And in that space, then you have more enhanced transaction monitoring in that space, because definitely the risk is higher. There is also an issue of when it comes to aggregates, and this is especially where you're dealing, say, with a payment service provider that is providing services to virtual currencies, digital currencies or your cryptocurrencies. We know that if it is two entities that are dealing, say, crypto, they'll find a way to net off the banking system. And so if you have accounts for such entities, you probably see the net amount. If one entity transacts 30 million, say, for another entity, and the other entity owed 10 million, they'll net off as part of the external blockchain dealings. And then what you'll see coming into the banks, or what will terminate into the banks as actual currency or bank balances, maybe 20 million. So there's a blind spot there. I don't want to put James on the spot here, because I know they're doing a lot of work in terms of virtual assets as service providers regulation, and we are partnering with them and waiting eagerly to get the framework in place so that we can fully implement it. But I think it's the awareness of the risk is where you begin, for you to then be able to put in place controls to mitigate the risk. So I'll pause there just so that I have enough time.
Thank you, Anne. I think one of the very key issues, especially within the fintech sector, is by its very nature, it can very easily be susceptible to so much risk. As James has put it, it's as easy as going on your phone, opening an application and doing 1, 2, 3 things. In other instances, it might maybe go as far, but it might not be as easy to mitigate those risks, perhaps, as it is maybe with usual normal commercial banks. And again, looking towards the kind of nature of fintechs, that technological nature, there's a lot of innovation, there's a lot of mindfulness that goes within this space. And sometimes the question becomes, legally, can the law follow that kind of innovation? Every single time we keep seeing people are coming up with ideas, new startups, and looking at it from a policy perspective, can the law or can policy really follow this kind of innovation? And I want to take advantage of Sheila's experience as a policy analyst and just ask, in your view, do you feel the law will follow innovation within this space, or will the law always be 1, 2 steps behind?
You know, Lewis, I'm tempted to actually put that question to the audience. How many people actually think that the law can outpace technology? That the law can outpace technology, will always be ahead of the innovations that are coming to market? Exactly. Okay, but just because I'm a panelist and I have to answer that question, the truth is that it's very difficult. It's very difficult for the law to keep up with technology, and it's not necessarily a bad thing, because don't forget, it's not necessarily the intention of the regulators to restrain innovation from the get-go, from the outset. So there is need to have, to give them that space to actually develop the innovations. And I think this is informed by what you'd call a public policy or unspoken policy by financial service regulators. One, to encourage financial products or financial systems that actually meet the needs of consumers in the market. This is well demonstrated by the example of Safaricom and when they came up with the M-Pesa product. So when it first came to the market, for a long time, you know, the Central Bank of Kenya was just observing what it is that they were doing, and later on, they came in and brought in the act and the regulations that regulate mobile money. And that is healthy. So I think the concern here from the regulator point of view is that whatever it is that this fintech is doing does not destabilize the market, okay? So it's a balance. It's a balance of giving them carte blanche and watching them, and when necessarily coming in and putting in the regulations. But having said that, looking at what is happening maybe in Kenya and across the continent, different regulators are taking different approaches to regulating fintechs. One I would call the evolutionary approach, and this is the approach where the regulator sort of does a comparison of the product that is in the market and what is being offered by legacy players like banks. So where they see the similarities with your service or your product that may be similar to that of banks, then the chances that they would ask you to comply with the laws and regulations that national banks adhere to. A good example is that of the digital credit lenders, as we saw in Kenya. Another approach could be that of the revolutionary approach. So I see this approach maybe being used by CMA, the Capital Markets Authority of Kenya, And what it does is that it has created sandboxes, which is basically a sort of a hub that is supervised by the regulator, by CMA, and under its watchful eye, fintechs are allowed to carry on with their innovations, and once they satisfy certain requirements, they are let loose into the market. I don't know why that doesn't happen with the central bank. In fact, I always give an example of a client of mine who was was at the forefront actually of developing peer-to-peer lending, and at the time we were trying to get approvals from the central bank and literally hitting the wall. But when we went to CMA, we succeeded in getting approvals in a span of 6 months. And then with the CMA approval, we were able to go to the central bank and then get approvals. So that's the revolutionary approach. The other one, quote unquote, you can call it the lead from the front, or if you can't beat them, join them approach, which I have seen recently in Kenya. And this stemmed from the proliferation, I think Anna's mentioned it, of crypto transactions, of virtual assets. In 2015, the central bank issued a circular to the banks, basically cautioning against virtual assets and things like Bitcoin and what have you. That was in 2015. But just last year, we saw a discussion paper that was issued by the central bank, and they were proposing developing a central bank digital currency. So that was put out as a discussion paper, but then after public participation, it was found that it was not a priority and it was premature for the central bank currently to develop a digital currency. Now, there could be arguments for and against why that was the case. Maybe people don't have an appetite to actually engage with digital currencies that, are coming from the central bank, but are quite happy to use Bitcoin or other stable coins that are out there in the market. Now, having said that, I think the conclusion is basically that the regulator will always be a step or half a step behind. But that doesn't have to mean that, it's really a bad thing, yeah? Because at the end of the day, we are a market economy, and that's what makes a market economy successful. Thank you.
Great. Thanks so much. I don't know, James, you have something to add?
Yeah, interesting discussion. Traditionally, law will always follow innovation. But when you look at it, the way let me talk on the anti-money laundering space, because that's what I'm familiar with. There's flexibility. If you look at the FATF recommendation, recommendation 15, which talks about new technologies, it envisages that there'll always be new products, new technologies, which will be coming into the market. The aim is not to stifle advancement in technology. The aim is not to stifle use of these products. The aim is to ensure safe usage of these products. So the people coming up with these products, these technologies, have to then ensure that they're safe and they're sound. So the way that recommendation is crafted then, it allows new technology, it allows new products, but the onus of ensuring that that technology is safe and sound then is on the person coming the technology or the person using the technology. So if the fintechs are coming with the new technology, yes, and we want them, they're good, they help advance, but how then do we ensure that these technologies are safe for use? What do I mean by safe? I say safe for use in the financial system, because when the technology is good, what's good for the goose is good for the gander. So what's good for the ordinary public will be good for the criminal. So if that technology will help the criminal move money quickly, if that technology will help keep the proceeds out of law, the authorities, then the criminals will embrace it and embrace it quickly. So how then do we ensure that as we bring out and use these technologies, that then they are not abused? Abused by now the people who have evil intentions, so that they can then hide their illicit gotten wealth and then use them for financial terrorism and other things. So that's why then there's responsibility for those introducing these technologies to assess the risks posed by use of those technologies. We're not stopping them. Assess the risks. Once you satisfy yourself that it is safe to use, then by all means deploy it, and we will then join in.
I think, yeah, and you can give your comments.
Yeah, I just wanted to maybe just add a comment that what James is saying is that you have the freedom of choice, but know that as an institution, there'll still be consequences. So if you come up with a product, open it up for use by criminals. The fact that there is no regulation in place or law in place, it still doesn't absolve you of the responsibility of the actions of the criminals that have used your product. So I think it's up to us as industry players to just know that fact that the fact that the regulator hasn't put in place a regulation, it's not a free pass to misuse that space, that development space. Thanks.
Great. Thank you so much, all of you. I think if this really brings up a really interesting discussion on fraud investigation and how whether the very nature of technologies is making sure that fraud investigation is a bit more difficult. But if we get into that conversation, I don't know if Nikhil is still here. Nikhil might want to jump on the panel and have a few comments. So I think from the panel side, we'll close it at that, but I will open the floor for questions to the panel. So yeah, we can just start here, yeah.
Thank you. Mine is to FRC. There's fears that we are slipping into the grey list. What are we doing as regulators to ensure we don't fall into that category? And again, with all the conversations of increasing the minimum cash threshold, how are you doing to handle that? Thank you.
Great. Sorry, maybe you can just have your name.
Mary.
Mary. Okay, great. Thank you. I think we can take few more questions as panelists note that down. Yes, Shine, just yeah.
Good afternoon. My name is Faith Cheriot. I'm a practicing advocate, but also I was a former banker. So the topic today is of great interest to me. So my question to the panel this afternoon is, personally, I would say I support the whole idea of innovation and technology because really this is where we are headed in the centuries and the years to come. But who is really thinking about the consumer of these products? We've had a lot of talk about fintechs and the products they have to offer. But who has taken time to think about the consumer? We've heard of cases where some of these fintech providers have engaged some really predatory kind of practices while handling consumers. They are so quick to want to make an extra coin or make a killing out of their investment, their fintech investment, but really hurt the consumer. They make the loan so easily available, but some of them I've heard they give excessively very high interest rates. The way they even collect some of the monies, these are now digital lenders that I'm talking about. Some of the manners that they engage in to collect their money is questionable, and many other acts. I don't know if anyone has ever even taken time to think, what extra regulations can we put in place to cover the consumer? Protect the consumer.
Okay, great. So I think we'll start with James's question, and I think both Anne and Sheila can just give their views on the second. James?
There's a lot of talk about this listing, red lists, white lists. As indicated, there's the mutual evaluation process, which is basically to assess a country's regime for combating money laundering and terrorism financing. Then the results of that assessment will then indicate what will happen in the follow-up process. With Kenya's case, I think after assessment, as she indicated, we didn't do too well. In the 40 recommendations, each recommendation is assessed, and then there are also 11 immediate outcomes, which look at how effective the system is. The report is available, it's out there on the FRC website, the ISAMLAG website, the FATF website, so I don't need to reiterate. So, as a result of our report, we found ourselves where we are under what we call enhanced follow-up. There's the normal follow-up process and an enhanced follow-up process. Enhanced basically means because of the not so good ratings, then you have to be closely monitored by our regional body, which is ISAMLAG, or by extension, if you find yourself in the FATF list like we did, because the FATF monitors jurisdictions which may cause probably some concern to the international financial system, and the FATF wants to ensure that the international financial system is cleaned. So we are both under the ISAMLAG enhanced follow-up process and the FATF's monitoring process, which is called the International Cooperation Review Group. Under the ICRG process, we have a 1-year observation period that was from September last year, and it lapses in October. So during this time, you're supposed to try and, a jurisdiction is supposed to try and fix what it can, so that now after that, FATF will take stock and see what has been done and then what is the next way forward. In this, in the assessment, as I said, there are 2 parts which are looked at. There's the technical compliance in terms of how does the legal regime respond to combat money laundering and terrorism financing. That's looking at the laws, looking at the regulations, looking at the policies. And then the second bit is how effective are those laws and policies. So, as government, we have then taken measures to try and address this within the 1-year observation period. Our first response was to look at and deal with the technical compliance deficiencies, because that is critical. Without dealing with the technical compliance, the deficiencies, then you cannot deal with the effectiveness of the system. So, have we been sleeping? No. We have been doing a lot of work behind the scenes. We have currently before Parliament, the Anti-Money Laundering and Combating Financial Terrorism Amendment Bill 2023. That bill is aimed at addressing a good number of the deficiencies which were highlighted in the report. For the terrorism financing deficiencies, we need not worry too much, because already we have the Prevention of Terrorism Implementation of United Nations Security Council Resolution regulations which were issued in July last year. So those are already in place to deal with some of the deficiencies within to do with terrorism financing. There's still some areas to be improved, which will then be dealt with by the Act. Now, after dealing with the technical plans, then there's the effectiveness recommended actions, which are more long-term. Some can be fixed within the 1-year observation period, that the majority cannot be fixed within that time because of their very nature. You have to have the laws in place and then do that. But already the various ministries, departments and agencies are already working towards that. So long and short, the government, I can comfortably say this, is working very hard to ensure that we will try to avoid the grey list. If we can't avoid it, then if we get there, then we will be in and out at the shortest possible time. But this, of course, is also subject to also other dynamics which probably may be out of our control, but we are working towards that. Then on the second question about increasing the minimum cash threshold, I mean, if you look again, we are guided, what we put in place are guided by the FATF recommendations. All countries are supposed to comply with that. The increase is within the FATF threshold. It's not beyond the threshold. The proposed increase is within the FATF threshold. Looking at also our realities in this region, we're a cash-based economy. Kenya is a cash-based economy. Most of the jurisdictions these are cash-based economies. There have been tremendous efforts in terms of increasing use of other channels. In fact, in Kenya, we are the leading country, not only in the region, but also beyond in terms of using of mobile money platforms, mobile payment systems. So these are also aimed at just increasing use of transactions. But even with the use of mobile money, we are still essentially a cash-based economy. So a lot of transactions still take place in cash, and this is just aimed just to ensuring that even there's a space within which transactions can take place, but still it is within the FATF standards and threshold.
Thanks, James. I think I'll have Anne answer the final question, just because of time, and then we can end it at that.
Oh, thanks, Lewis. I think I will respond to this, taking into consideration that in this room we have lawyers who would be having clients that they need to safeguard, with financial institutions that need to treat customers fairly, fintechs that need to adopt the same policies and the same guidelines that are used by other financial service providers. It is unfortunate that we've had incidents in our country where digital lenders are known to go overboard. And we did see the regulator coming into action, central bank, and actually license some of them and state that some of them are not licensed. There are regulations to protect consumers under the Consumer Protection Act. As to whether these entities have implemented these regulations, I think that is where the gap is. It is, and like Manyonge said, innovation is good, but as you innovate, it's up to the entity to take a responsibility to ensure that they're not abusing that innovation space prior to the regulator coming in to clamp on them. And that is what happened. Kenya is we have interesting consumer patterns. I'm trying to avoid the word queer behaviors. We will have a pyramid scheme in place, and there has been very many pyramid schemes before, but when the newest one comes on board, we will run there to make the quick buck. I think the consumers in that space cannot be helped. They are curious, they are ambitious, they want to take the risk. At a personal level as well, and not just institution, it's up to you to see, well, this is what is being offered. Am I happy to take a chance? Or am I happy to consume this product? So for that specific risk, I don't think the regulator or the lawyers or the legal framework can actually address that. But that said, there is space for awareness for those who may not have are not lucky to have information access as we may have, for them to do their own due diligence and do their background checks. So maybe in that space, when it comes to consumer protection, there's more to be done in that space in terms of awareness. But I do believe that we're on the right path, noting what the regulators did when some of these digital lenders went rogue. I don't know if Sheila has a chance to comment.
She will insist. Because we are a bit just really short.
Just to add to what Anna said, she's talked about the consumer protection laws of the country and the fact that the central bank issued digital credit lenders regulations. In addition to that is the Data Protection Act. So, the lenders are also prohibited from sharing information necessarily with CRBs, and you as a person who's borrowed from them can actually report them to the DPP. Thank you.
Oh, great. Thank you. So thank you so much. If there are any other questions, perhaps you can engage the panel separately. I'm sure there will be an opportunity to discuss and do so. But thank you so much to Mrs. Sheila Cadogan, Mr. James Manyonge, and Ms. Anne Matu. And thank you so much for taking the time. And we'll close it at that.
Thank you very much. I think that topic is very interesting. And I think for the next sessions, we might have a whole day just to discuss that. Because we've seen a lot of innovations. Again, banks, we are trying to remain in our own traditional ways. We have to comply with our regulators. So where do we really meet with the fintechs? When fintechs come to us, they think we are being too slow. We are not ready to support them. And the same speed they operate is the same speed they make noise at. And they can really make noise. Then you go to the other side and you find Anne, who is our correspondent bank. So it's not only the regulator. So when I process the money for, say, Advancedly, I have to give enough reasons whether I understand that particular transaction. So I think this is a topic that we need to have more conversations on. I'm taking the evening shift. That's what I've been advised. My name is Mary Mulili. I'm the Vice Chair of the Banking Commission for Kenya. And I am a banker. I'm the Executive Director with UBA, United Bank for Africa. And welcome once again. I hope you're still keeping up the energy. At the back, can I see? Okay. We are going into another very interesting topic. Again, for some of us who've been in banking for many decades, I think that is the word people have been using. I think I've done 2, going to 3 decades. We've seen a lot of changes from the time we walked into the doors of banking, those many years. There's disruptions in terms of innovation. Fintechs have come on board. Laws are changing, regulations are changing. And now we have to also work within the frameworks of ESG. And the final panel for today will be walking us through this very interesting topic. From Kenya bankers, I know we've had that framework where we are pushing banks to adopt, and even central bank. This is one of the things that we have to report on. What milestones are we making in this space? And also corporates that we work with. They're also calling for entities to also be compliant. And we all have to educate ourselves to understand what does this stand for. So to introduce the moderator for this particular phase of panel, I would like to introduce Frederick Nyasaka, and I think I'll read. I don't have my glasses. Do you have your notes? Okay, so Fred has over 19 years experience in banking, compliance, internal audit, and finance. He's the money man. So by the time you're walking out, you can get some money for yourself. He's currently the CFO with Spire Bank, has worked with other banks, KCB, Equity, Bank of Africa. He's a member of the ICC Banking Commission. And is a graduate in finance, certified internal auditor, as well as CPA. And he'll be leading this conversation with this team. And he's also a Rotarian and a president-elect of Ngong Road Rotary Club. So welcome, Fred, to introduce your team this evening. Thank you.
Thank you very much. Thank you very much. I'm going to introduce my panel, and the first person I'm going to introduce is Julius Opio. Okay, put it up, please. it's cut, isn't it? Yeah. Okay, Julius, you can join you can come in. So Julius is currently our chairman at ICC, Environment and Energy Commission. And I don't know why I cannot read from the beginning. He's the current chairperson for the Environment and Energy Commission at ICC Kenya, which acts as a voice for business representing the interests of ICC members in dialogues related to sustainability issues. The commission also examines major environmental and energy-related policy issues of interest to business via task forces and thematic groups. He's the immediate former chairman of the Kenya National Chamber of Commerce and Industry, Nairobi chapter. He's also the chairman of Legends Associates Limited, a company providing infrastructure, investment, and innovative solutions in Kenya, including commercial and industrial renewable energy projects. Join me in welcoming Julius to the stage. My second panelist is Patrick. Is he here with us? No? Is he joining? No? Okay, we go to the next panelist. The next panelist is Judith. She's also not there. Even virtually? Okay, that's fine. Then the next person is Sami Ndolo. Is Sami here? Okay, Sami. So Sami Ndolo is Cliff Decker of Mayors Kenya managing partner and partner in our finance and banking practice areas. He has expertise in corporate law and finance, green bonds, ESG diligence and advisory. His experience extends numerous sectors and involves local and cross-border transactions. Sami is highly regarded in the market for his rigorous approach and detailed knowledge, having been involved in complex and high-profile transactions. He is recommended as a top lawyer by international legal directories such as Legal 500 and Chambers Global, where he is ranked in the corporate, commercial, and banking and finance categories. IFLR 1022 ranked Sami as a notable practitioner. Please join me in welcoming Sami to the stage. I'll probably just start by giving a preamble. I know right now it's 4 o'clock. We'll try and execute this panel as efficient as possible. Let me just give a preamble before we start. It is widely recognized that continued emission of greenhouse gases will cause further warming of the Earth, and that warming above 2% Celsius relative to the pre-industrial period could lead to catastrophic economic and social consequences. Based on the evidence of the growing recognition of risks posed by climate change, in December 2015, nearly 200 governments agreed to strengthen the global response to the threat of climate change by holding the increase in the global average temperatures to below 2 degrees centigrade above pre-industrial levels, and to pursue efforts to limit the temperature increases to 1.5% above the pre-industrial levels. If the world fails to step up climate action, continuing on the current climatic change trajectory could force 100 million people into extreme poverty by 2030. Africa is the most exposed region to the adverse effects of climate change, despite contributing the least to global warming. Yeah? Yes. Okay. Climate change is therefore one of the major risks threatening the well-being of mankind. It has increased the frequency and magnitude of extreme weather events, causing loss of lives, diminished livelihoods, reduced crop and livestock production, and damaged infrastructure, among other adverse impacts. Consequently, it is an increasingly recognized as a source of financial risks for financial institutions and corporates. Now to our topic, the green financing and ESG, the role of the banking and finance sector in accelerating the continent towards net zero. So to my panelists, I think the first thing is to unbundle this issue called ESG. Is it just a buzzword? Is it a real issue? Is the world really experiencing climatic change? And are these effects real? Let me start with Julius.
Thank you very much, Frederick. What I would like to say is ESG is not a buzzword, it's a reality. And it's more of a transition. If you look at the history of where businesses are coming from in the last 100 years, it has come up they've had various value systems. And just recently we used to talk about CSR initiatives, but of late, the current area of focus is on environment, social, and governance. And some of these requirements have come from catastrophic events that have happened in the past. Like if you remember the Bhopal plant that blew up in India. There was the Chernobyl disaster, I think, in Russia. And all these were businesses, and then also the oil spills in some parts of North America. So this has led to a situation whereby organizations, businesses, corporates, both large and small, are being compelled to become more environmental, social, friendly, and sensitive to the planet. This is coupled by the current situation when it comes to climate and global warming. So there's a link and scientific facts that have proven that what we do in terms of business and how we run our businesses has an impact on the environment, and one of the key impact that has happened is emissions. So as a result of that, various regulatory frameworks around the world have come up with standards that they would like to use to see how you can measure and monitor ESG. In the past, the immediate past, if you look at what corporates have been doing, was most to do with CSR. CSR reporting, there was no measurement. It was more like an aid-driven kind of initiative where you go to a school, donate books, you go and plant trees. There's no monitoring, assessment, and that kind of thing. So regulatory frameworks have come up in different parts of the world. So you have North America, you have in Europe, in Africa, and trying to see how can we come up with the standards, reporting standards in regards to ESG initiatives. And as a result of that, now companies are being compelled to go into the various ways you can do the reporting in terms of scope 1, scope 2, and scope 3. So depending on the size of your corporate or business and where you want to operate, you'll meet different requirements. An example in Kenya, for example, is if your company is listed in the Nairobi Securities Exchange, you will find that they have a regulatory framework when it comes to scope 1 and scope 2 reporting. If your organization is listed in the more developed countries like the London Stock Exchange, you'll have to report all the way to the level of scope 3 reporting. In North America, I think they have similar standards and requirements like Europe. So, in a nutshell, what I would say is ESG is a reality. Now, when you come to Africa, currently it is more voluntary, but you're going to see a situation whereby in the future it might become mandatory, reporting on ESG, especially at the level of scope 1 and scope 2. And I think the benefits that come with it, which maybe we can discuss as we move further. Thank you.
Thank you very much. Sami, same question. What's your take?
Yeah, I think, the issue of ESG, in my view, is underpinned by the Sustainable Development Goals that were developed many years ago. And I think the move now is to ensure that corporates are also playing their part as we transition towards having low emissions and greening our economies. So we can even see right now in Greece and other countries that are affected quite significantly by the effects of climate. Perhaps where there's a difference in opinion is how you address those challenges. I think we all agree that the earth is warming and we need to take action. But I suppose that where you find differences in views is what is the right action. Now, we have global standards, but I think as the African continent, perhaps there's need to be more proactive and have leadership in setting some of these standards. Because as you mentioned, we are very low in emissions as a continent, but we're expected to play quite a significant role in reducing the global effects of the emissions that have occurred from the West and the developed countries.
Thank you very much. I think, Patrick, just to pick on your point where you mentioned that indeed it has been a journey. Initially, we began at CSR. Now we are talking about issues to do with ESG. I'm informed that KCB has already joined the call. I don't know whether you can put Judith online. Judith, good evening.
Good evening, everyone. I hope you can hear me well.
Yeah, we are well. Thank you very much. Maybe you can just introduce yourself and probably just briefly take us through KCB's journey as we on these issues to do with the CSR up to ESG level where we are currently are. I reckon that you began this journey quite early, around 2013. Maybe you can just briefly take us through KCB's journey and up to now when you are where you are. Thank you.
Thank you, Fred, and thank you, my fellow panelists. So for KCB, we started this journey sometimes in 2008, and we have continued to progress on this journey. Before, of course, we know that sustainability was considered more of as a CSR, but now we have been able to entrench it, embrace and internalize it so that it is part of our business. So we did start, of course, with sustainability, started with the minimum kind of reporting, and of course, ensuring that we put the systems and processes in place so that then we can be able to have a better strategy on how we can drive sustainability agenda forward as a bank. So for KCB, basically, we look at sustainability and we have identified 4 pillars that we work with. And that is our financial pillar. We have our economic pillar. We have also a social pillar, and of course our environmental pillar. So those are our 4 basic pillars that we use in terms of doing our sustainability. And through these 4 pillars, we have been able then to progress and transition into action points. So we used to have what we'd call 10-point action point for 5-year plan for sustainability, which we did. And of course, as we have seen, the subject matter has also been very progressive. And so we have now adopted sustainability to ensure that we work with the following pillars. The Sustainable Development Goals, we have climate change, and then we have net zero ambitions, and then we have also incorporated now the green lending. So that, in a nutshell, that is how for KCB we have embraced sustainability. So we no longer we no longer see sustainability as CSR. Now it is part of how we run our day-to-day business. So under financials, this is how we do our business on a day-to-day. When you look at the economic, it's the impact that we have to the greater economy of the country and the markets in which we operate. So we see this in terms of taxes that we pay. We see this in terms of generation of jobs. We see that also in terms of how we support our SMEs and all the other aspects that are done to support the general bigger economy. Of course, when we come to environmental, we look at scope 1, scope 2. We have not done scope 3 yet. It is something that now we are putting into place so that you can be able to do it in alignment with the Task Force for Climate-related disclosures. And then, of course, we also look at our environmental and social due diligence for the loans that we do, just ensuring that all our loans that we give to customers, we take them through the environmental and social due diligence assessments. Then also we look at, on the social side, we look at how do we take care of our employees internally, how do we take care of our customers, and how do we take generally, how well do we take care of our bigger stakeholders, who are wider stakeholders apart from our customers and our employees. So basically that's how we look at sustainability as a KCB group. We've made sure now that it's part of our purpose, the way we exist as an organization, and the purpose is for people for better. So we make sure that everything that we do embraces sustainability and at the same time ensures that also we support our people and we make them better than how we found them. Thank you.
Thank you so much, Judith, for that overview of the journey that KCB has taken. Probably just before Judith logs off, I'd like just to do a follow-up question, Judith. In terms of your reporting for scope 1 and 2, I'm sure you have, is this an automated process? Is it a manual process? Are you facing any challenges that you can share with the audience? Yeah.
So yes, so for scope 1, because this looks basically at how we run our internal processes. So we look at our water consumption, our paper. We also look at our electricity and also our fuel consumption. So yes, we have initially we used to do it manually, of course, which was quite tedious. But of late we have automated the process. And so from our branch network, what they'll do is they're able to input the data and then we're able to receive it at head office where we are. And then where we find that there are anomalies, then we can always do a callback to confirm probably why is there a discrepancy in terms of the figures. But basically what happens is every branch is able to feed in their consumption rates per month. And then after that, then we are able to review. So for purposes also making sure that all employees are accountable, is that this is also in the balance scorecard for our employees. So like for this year, we are supposed to reduce by negative 5%. So looking at each of that minus 5%. So we evaluate that and that then becomes the score for each of our employees. So we make sure that as much as possible, everybody takes participation to make sure that then we have better conservation of managing the resources that we have. And this also has enabled us to be able also to install things like intelligence lighting, better way usage of solar systems in our branch, some of our branches, especially where they have better sunshine than what we're enjoying, than what we have in Nairobi. So those are some of the things that we have implemented also to try and see how we can conserve. In terms of water, how do you automate it so that it doesn't run, it only runs for a few seconds. So all those things now have been put in place in order to conserve as much as possible. Also, we have recycling of the water, especially for some of our facilities. So all these things, again, putting them into place in order to see how do we conserve even as we ask our employees also to use whatever facilities that we have in a much better way. For scope 2, of course, this comes from taxi usage as well as our generators and also the air flights that we use and other transportations like buses, which we have third-party service providers. So that one, again, we also continue to monitor that. And out of that usage, if it is very high, then we give ourselves targets on what can we do to be able to bring that down. So that basically that's how we do a scope 1 and scope 2. Scope 3, of course, this means going now out to our customers, evaluating their different sectors to see what kind of emissions they have, which sectors have higher emissions. So we have not reached that stage yet, but it's something that already we are considering doing. So that then we can have a better holistic decarbonization strategy. But for scope 1 and scope 2, yes, initially it was very difficult, but with automation now it has become easier. People can log in, they can send in that feedback, and then we receive it, and then we are able to evaluate. So that's what I can say. The other challenges which I can quickly think of is especially when it comes to billing, especially of water. We know that sometimes it doesn't, in some areas it doesn't come monthly. So they might get a bill of maybe after 3 months, which is normally aggregated. So those are some of the things that we find bring about discrepancies. But once we get confirmations of that, then we are able to align and to be able to have now a better way of measurement.
Thank you very much, Judith. Julius, you note that there's an element of gathering data or information that KCB had to contend with, but they have been able at least to sort it internally. But when you look at ESG matters, then it's more from a value chain perspective, because for you to report at entity level, then you must gather information from the various stakeholders within your value chain. From your commission or as you relate with the other members, is this a real issue, and how can organizations be able to overcome this challenge from an ESG reporting perspective?
Actually, for most of our members that we've engaged, it has been a big challenge in terms of data accuracy and frequency. So we have situations whereby some organizations or companies do a sustainable report annually, and that's it. But now with the regulatory bodies coming in and putting up requirements, and it's sometimes now, like CBK is saying now it has to be done quarterly reporting for the banks. The NSC has requested for all listed companies to have sustainable reports on an annual basis. So the challenges that most organizations are faced with is data accuracy, and then how do you automate? As Judith had earlier mentioned, many companies have gone through the challenges of scope 1 and scope 2, but now there's a drive towards scope 3, and many organizations are finding it quite tedious and laborious to collect all that information. But we also think that this is also an opportunity whereby we can use technology like AI to automate the data collection and make it real time. So we think that there are solutions that can be tapped into to address the challenges of scope 3 reporting.
Thank you, Sami. Probably I'll ask you this question, then probably I'll ask Judith to do a rejoinder. When it comes to green financing, it is a requirement that the clients that you are going to lend that money to have to meet certain green financing or green lending requirements. Are there any legal challenges around this? Are there any legal frameworks, and how can clients be able to overcome this?
Yeah, it's a huge challenge we find, because from the get-go, a lot of the borrowers may not be aware of these standards, and they are operating on the basis of what is profitable for them. And when you introduce those lending conditions that they need to comply with certain standards, ESG standards, or for them to qualify as green, so that their financing is going towards green projects, you find that they have to really change perhaps how they operate or how they collect information. And from what I've seen so far, a lot of borrowing clients therefore find that it can be too cumbersome. They don't have the know-how or the patience, and they just want money to be able to sustain the business, to run it until the next time that they need additional financing. So I think sometimes ESG is a good, it's a good initiative to have, but we've had occasions where borrowers feel that perhaps it's a standard that is not, that does not anticipate their more immediate needs, their more immediate capital needs. they need to be able to, make it to the next year. And here you are introducing new requirements for compliance, for reporting, for governance. So I think there's that disconnect sometimes between where the world is going towards ESG or green financing. But the reality is that, the data is servant to the lender. And so I think eventually we'll get there, but it's been a painful process for certain of the borrowers, particularly SMEs or MSMEs who don't have that know-how or where it's not a priority for them.
Thank you very much. So back to you, Julius. Then what Sam is saying is that, and also knowing human nature sometimes, then the element of greenwashing, as we know it, comes in. Probably you can define what greenwashing is and what really will motivate somebody to go towards greenwashing, and what are the risks around it. Yeah.
Okay, greenwashing is a situation whereby an organization will come up with a report, an ESG report, and purport to have done some initiatives just to meet their targets or objectives, whether it's annual or 3 years or 5 years objectives. And as a result of that, they get access to various opportunities which could be financing, green financing, or any other opportunities in terms of meeting the targets when it comes to global emissions. So now, what ESG now does is to try and address the issue of greenwashing. And a good example would be like in the carbon markets. If you're going into, for companies that want to get carbon credits and monetize their credits, using ESG, you are able to address and minimize the incidences of greenwashing because your data has to be accurate. You have to register your project, get it verified, measure, and report on it. And have auditing firms that can actually, external auditors that can come and actually verify that, yes, I've planted 1 million trees in the last 10 years, or I've planted 1 million trees in the last 1 year, and these are the trees that we've actually planted. There's a proper mechanism to verify all that. Now, and so that is the advantage of having ESG. And going back to the point that you've just raised for the micro and small enterprises, I think we also need to simplify it to them so that they understand that there's always a starting point. And it's a simple starting point, just like for a micro enterprise, all you need to have is first have an ESG policy. Start from there. Identify one aspect. Maybe it's just the environment. Or you might want to have to address the social aspect. But doing all the three, governance, social, environmental, all linked together, for a micro enterprise, when it comes to reporting, might be challenging. But that should be deeply embedded in their values of the organization at hand. So for me, what I would say, yes, greenwashing has been a problem, not only in the developed markets, but you're also seeing it in developing markets. But because we have more accountability and transparency that is being brought by the regulatory frameworks at a global level and also regional level, like the Nairobi Securities Exchange, we have the central bank regulations, we have ISSB when it comes to the international frameworks. Many companies are being compelled to conform, and then once you conform, then you're now able to access financing. You're able to go to a bank, a financial institution, and get access to funding. Access to funding could either be green or not green, but we're here today to discuss more about green financing. Thanks.
Thank you, Sami. What's your take on greenwashing?
I think for you to be able to identify greenwashing, you need to be able to measure. And I have my reservations about the ability of local auditors and their capacity to be able to audit particularly large projects. And so you find that the possibility of local entities being being found to have greenwashed, I think is quite difficult in my estimation. Yeah. Because the people that have that capacity to measure and to check are few and far between. And secondly, there is also a tendency sometimes where the ESG measurement is a checkbox exercise, right? Is the policy there? Tick. But we're not going to the substance of what does the policy say and how is it implemented. And if you provide then, and say you planted some trees, it's tick. You have independent directors on your board, but are they really independent? What's the standard you've applied? So I think the fact that there are these standards in place on the one hand versus our inability to measure really limits that, the way that you can tell that there's some greenwashing that is happening.
Thank you very much. I think we'll just have some final thoughts and then we can go to a Q&A. So I'll go to Judith, who is online. Judith, if you look at your current loan portfolio, to what extent have you been able to lend from a green finance perspective to your clients, SMEs, corporates, and do you have any targets? And if so, what initiatives are you taking to ensure that your clients qualify for these green finances?
Thank you, Fred. So what I would say is that, as my other panelists had said, that we do have challenges, especially when we are engaging our customers. So one of the things we have done as a bank is to give awareness and training to our customers, especially on the ESG process and why do we do sustainability as a bank and why is it important for us to walk this journey together. So what we have done is to take the initiative to work with both our corporate, our retail, as well as our MSMEs, so that they can understand why it's important for us to be able to make sure that even we run our businesses in a way that takes consideration of our environment in the basic ways and also the social aspect. And one of the things that we also tell our customers is that it's very beneficial for them because they must see the benefits for them to be able to support environmental and social governance. So they must see the benefit of it. So one of the things that we tell them is that, of course, sustainability enables you to be cost effective, cost efficient, so you manage your costs well. And also one of the things that also sustainability enables you to do is also you can become very innovative in the way you run your business. Probably there's been a lot of wastage. So you can take that advantage then to see how you can even recycle, reuse within your premises, and even do recycling, use solar panels to manage your electricity costs. So all these things they're able to put into consideration because it makes sense for their business. So we've walked this journey with our customers just to make them understand the importance of ensuring that even as they run their day-to-day business, they must make sure that they take care of the environment as well as their community in which they operate. Because one of the things also for them to also understand is that if those two are not taken care of, it means tomorrow they might not have a license to operate, they can easily be shut down or closed, and it means also they will not be able to pay back our facility as a bank. So we look at all the risks and also tell them now these are the opportunities for you to take advantage of so that then you can have also a sustainable business. So far it has worked well and what we've done also is not to force our customers to take everything at a go. So what we have done is to ensure that also we give them like a tiered kind of implementation. So that also has helped. So they're able to say from here to here, I'll be doing it for year 1, year 2. In my immediate term, in my short term, this is what I will do. In my long term, this is what I'll do. So that has also enabled them to be able to plan even their own finances on how they'll be able to do that. So that has also worked well in terms of just getting a buy-in also for our customers. So the question that you asked about, what did you ask, Fred?
What is the level of your...
ESG.
Yes.
And green lending.
Yes.
Yeah. So for KCB, we started the green lending process in 2021. So we used the CAFI tool. So CAFI in full is looking at it's a financial instrument for measuring your lending book to see which part of it is green. So we did a base rate. And when we looked at the book initially, we found that it had only 8% of the green. So with that target that we only had a baseline of 8, then we gave ourselves a target of 25% to be able to look at our lending book to be able to have 25% of it being green by the year 2025. So basically that meant that every year we had to increase by 5%. So far, so by last year, of course, our book was at 12.3%. So this year the target is 17. So basically, you can see how we've been able then to be able to increase the rate. So basically, what we've done is just to make sure that we have identified which sectors give us quick wins, so that we can be able to work on them. So the sector we identified which could give us quick wins was infrastructure and real estate, and then agriculture, and then transport and manufacturing. So those were the 4 sectors which would give us quick wins. So those are the sectors that also we have been focusing on, just to make sure that we can be able to quickly increase the lending in green. So still there's quite a lot of work to be done because we'd like the whole book to be green, but it will not be possible because we know some sectors also require regulatory push so that then you can be able to realize big gains. So we are also conscious of that, especially when you look in the transport sector and in the other sectors. We know that there needs to be some kind of regulatory in place so that then you can be able to push that number. But we've started with that 25% because it has also given an opportunity to our staff. They're able to learn, to see which are the areas that need improvements, which areas they can be able to focus on, where they are able to measure, to also report on it. And that has worked well, especially with the MSME, because we are seeing a lot in terms of solar, in terms of renewable energy, agriculture. So we've seen a lot there. And what we are hoping is that even as we move forward, when we achieve the 25%, the other sectors will have also opened up and now we'll be able even to, by 2030, to have the whole book being green.
Wow. Thank you very much, Judith. Julius, final thoughts. What is then, in an effort towards compliance, ESG compliance, what is the position of innovation and technology, and how can we as a commission support this movement? Thank you.
Thank you, Fred. What I can say, under the Environment and Energy Commission, we've identified a number of initiatives that we are working with. And that's why we're also driving the financial institutions to come up with green financing solutions to support some of these initiatives. One is e-mobility. We've been very much behind the drive and move towards electric vehicle and sustainable transportation in urban areas and rural areas. And we've successfully engaged government. And in the last finance bill, most of the proposals that we put forward were adopted by the government and by the National Assembly. So going forward, we see a situation where Kenya is going to take the lead in e-mobility. And so that's an area that the banking and finance sector should consider financing and coming up with better solutions, finance solutions in that regard. Another area we're looking at is renewable energy. There's a lot of work going into renewable energy. We started off with solar. We're going to see hydro projects coming up, not only in Kenya, but also from an Africa perspective. There's a lot of discussions on geothermal expansion. Kenya takes the lead in geothermal in Africa, but we still need more energy, clean energy in that regard. And also, even green hydrogen is being looked at as an opportunity for us to manufacture in the country. So those are the second ones, so that's renewable. Then there's initiatives on clean cooking, whereby we are working with a number of organizations and members to see how we can enhance clean cooking, both in urban and in rural areas. So they've invested in technology, trying to improve their stoves such that they're more energy saving. and even have electric cooking devices that you can also use it in urban areas if you have access to electricity. Then we also have the carbon markets that we'd like to tap into and see how companies that have invested in going green are able to register their initiatives using ESG and then eventually get carbon credits and then they monetize. This is still work in progress and we're still working with the public sector to see how this can be enhanced and brought into businesses, tapped into businesses such that they get better green finance solutions, which now they use the carbon credits to, they can use the benefit of carbon credits to get or to pay off some of the financial loans that they would like to access. Then another area that we're looking at, which is also difficult, but people talk about it, is afforestation or tree planting. A number of companies are involved in tree planting, but also it goes back, there's a link between tree planting and carbon credits. They want the assurance that if we plant our trees, 1 million trees, 5 years from now or 10 years from now, we're able to access carbon credits and the benefit. And then the discussion today is about green finance. We are also involving multilateral lenders to see how they can onward lend to the commercial banks. They come up with green finance funds and use those funds now to be given to SMEs. So for SMEs and micro enterprises that comply, they should be able to access also these green finances. Through the Nairobi Securities Exchange, there's a lot of discussions in regards to how we could possibly tap into green bonds. They've done I think a green bond was done about 2 years ago, 3 years ago. But those are some channels we're looking at to see if businesses invest in, let's say, renewable energy projects, huge projects, and they need funding. Is there a way we can structure green bond frameworks whereby we can go to the Nairobi Securities Exchange, cross-list to the London Stock Exchange, and get funding into Kenya or into Africa? So these are the opportunities at hand, and this is the challenge I would throw back to the Banking and Finance Commission and sector, is we need to come up with what I would call more compelling financial solutions that are green, that can be onward lended to the SMEs and the corporates. Because currently today, if you go to a bank, very few banks have what we call a green fund or green solutions. This is something that is coming up now, but the opportunity is quite immense. Thank you.
Thank you very much. Sami, your final thoughts, but more or less looking at the legislation. We know that there's a bill, what Patrick has alluded to, on carbon credits and carbon trading. Probably just briefly touch on that as you give your final thoughts around this topic.
Yeah, there are in fact 3 bills. That's how hot this issue of carbon credits is.
Yeah, 3. Yeah.
3 competing bills, but I suspect by the time they reach the first reading, they'll be consolidated. I think what has elicited a lot of reaction from most of our clients, and they tend to be investors in in projects where they want to extract carbon credits, is the revenue sharing that is being proposed. There are proposals of having up to 40% going to local communities. There are proposals to have the county governments getting a portion of that. And so for many investors, they feel that those ratios really will cause their projects not to be feasible, and they'll be impossible really to effect. And so I think the legislators need to think very carefully before just proposing any type of benefit sharing, because it then has an impact. Some of them, when we talk to them, they've decided to put their projects on hold until there's clarity on what the law is. But at the same time, I think it's admirable that as Kenyans, we are taking the initiative to actually determine our destiny. And so I think it cuts 2 ways. I think it's a good thing that we're having legislation and there's a lot of interest in the area, but it needs to be moderated such that it doesn't stifle investment, but rather enhances it. Because most investors are willing to share with the communities, but for those projects to be viable and to be projects that actually can generate credits, it requires a lot of innovation and thought and financing. And that financing is not readily available locally in many cases. Our priorities are more for basic priorities. So a lot of that funding towards greening, saving mangroves, or how you use the soil, soil conservation, a lot of that tends to be externally funded.
Thank you very much. I think we can go to the Q&A, probably another 5 minutes on the floor. It's an area of interest. I can see so many hands up. Maybe you can assist. Yeah, okay.
Thank you, Fred. Thanks to the panelists. I want to ask a very simple question. Has anybody in Africa earned carbon credits? Even a shilling, 2 shillings, 10 shillings? And if no, why? Thank you.
Thank you very much. We can have a batch and take 3 questions and we'll answer them.
Good afternoon, good evening, a mix of both, I think. I would like to challenge the panel in terms of thinking green finance is not just my portfolio is ESG compliant, but there is green lending happening in those disruptive new green technologies that were also just highlighted, like let's say green hydrogen or carbon capture. And we as bankers, we don't like new because new is always associated with risk. So how do we overcome that challenge to ensure that sufficient cash actually flows into this transformation of the economy?
Thank you very much. Yeah, the 3rd question.
Good afternoon. My name is John Singo. I'm from EV Charger. It's an electric vehicle charging infrastructure company.
Okay.
My question is to Lillian. KCB has taken great steps in employing renewable energy in their day-to-day operations. I encourage other banks to do the same. But Lillian, have you shared the actual savings that these technologies are having on your operational costs? I think this would probably be one of the best ways that you could drive adoption. Thank you.
So we'll have those 3 answered. I don't know whether we have any questions on Mentimeter or online. Maybe you can put that up. But on the first question, Julius, Mr. Obioro is asking a very simple question. And that's why we started with the issue of asking, is ESG just a buzzword? Or these are real issues that we are dealing with? So the question is asking is, has anybody, not in Kenya, in Africa, and a carbon credit?
Yes, I can say what is happening in the carbon credits market is that it's voluntary. We are currently operating through the voluntary carbon markets, whereby you can actually sell and buy at an agreed price because it's not regulated. The most recent transaction was $15 million, whereby carbon, there was a carbon transaction between Saudi's companies. They came here, and the transaction was done here in Nairobi for $15 million. That is just a starting point. Now, going back to the bill, the climate amendment bill that is talking about carbon monetization, there are still gaps that need to be addressed, and that is what the government is trying to come up with to see how we can have a regulatory kind of framework whereby even you can do, we can go beyond the voluntary market, carbon markets, and have a properly structured way of valuing the credits in a way that it's beneficial to Africa. So what I can say is there's an opportunity, big opportunity for Africa. It is actually happening a lot. And we have the number of initiatives like happening in Zimbabwe. In Kenya, we have some companies that are trying to get carbon credits from clean cooking, okay, and then in that process of monetizing their carbon credits.
Yeah, I get the impression that his concern seems to be that the trading is happening out there, in some voluntary market out there. And so does the local Kenyan actually receive a shilling? I tend to think that that is where he's going, because we have all these projects, but in reality, are we just receiving clean air in return? I think that's where he was going. But ultimately, what... yeah, but I think some of them are quite beneficial. I think if we just look at the money element, we might lose the big picture, which is to have a sustainable environment, sustainable economies. I know some companies that do cooking stoves, and they use the credits to reduce the prices on the cooking stoves, the GCOs. So the community might not get cash, but the discounted prices, perhaps, or the rebates, might reflect some of that credit that is being sold out there.
Jero, does that give you some comfort? Yeah. Somehow. But remember, it's also an emerging area, right? This is when we are actually even setting the frameworks. So, yeah. I think the second question was, the panel was being challenged that we shouldn't be legacy in our thinking, isn't it? Yeah, and we need to think more innovatively. What's your take on that, panel?
I totally agree with that comment. And okay, from the banking and finance sector, you're right. You take a conservative view, and because you don't want to be risk averse. But there are new technologies coming, like in the renewable energy space, we have green hydrogen. There's a lot of discussion. Yes, it can be manufactured in Kenya, it can be and probably in Africa, but it's not as simple as it looks. So if you're going to fund a green hydrogen project, there are many other things that you need to consider to make the project compliant. So you cannot, if you're going to transport green hydrogen from Kenya to Europe, it has to be transported in using clean transport. So if it's a train, it has to be a clean transport train. If it's going to be a ship, it has to be retrofitted to use clean energy. So by the time it gets to the destination, what will be the price of the green hydrogen? So those are some of the challenges that we are faced with. So the opportunity at hand for something like green hydrogen is if it can be consumed within Africa or within Kenya, then it becomes a very strong case to go that route. For Kenya, the one advantage we have is geothermal, which is what a number of institutions, both in the public and private sector, are pushing for, to see how we can increase uptake of clean energy. I'd mentioned earlier about e-mobility. That's a new area, not only for the private transport, but it's something that is being worked on for public transport system. So we're seeing a situation whereby maybe in the next 5 years, there'll be a railway, a BRT railway line that is running on an electric, using electric energy as opposed to diesel.
Thank you very much. I think the third question was to Judith. Judith, I think the question was, it seems KCB is doing a lot. Have you shared your value creation story in numbers, isn't it? Yeah, Judith. And as Judith prepares to answer that question, yes. Yeah, okay, go on, Judith.
Okay, yes, we do. I'm sure we've been reading the annual KCB sustainability report. Those numbers are normally there just to show the value creation that we are making. One of the things that why staff even support sustainability today is because now they understand it has a bearing on the bottom line. And so they are very keen to make sure that they support it to the full, so that then we can be able to realize even the benefits that we need on our bottom line. So yes, we do have it, and yes, we do it in terms of reporting on it when we are doing our annual sustainability reporting.
Thank you. If you go to KCB's website, you'll realize that KCB has been issuing the sustainability reports since almost 2013. And KCB, I think, was the first bank to issue an integrated report in the year 2014, basically telling their value creation story, which now leads me to the question that is on the screen, is what is the difference between ESG and shared value? Sami, do you want to try that?
No, I'm not sure I am able to answer that. Because ultimately, well, in my understanding, when the purpose of ESG is really for us to have sustainability. And if we achieve sustainability, we get to share that benefit, all of us.
Yeah.
So perhaps if someone is asking whether shared value or ESG is too limited, an approach, and maybe there is more, perhaps around morality or some other standard that is missing from the ESG. But for us to achieve a shared value and a common good, I think ESG is a critical path to that.
Okay. I think what I will also probably just add, yes, ESG, those are like three pillars that are there. You have your environmental, you have your social, and then you have your governance. Then probably the quantification aspect, and are probably the four capitals. Yeah. How are you able to now bring all these issues that you're talking about under ESG in number terms? So that really is the shared value that you're talking about, your value creation story at the end of the day. I think that's how I'll take. Anyone in the audience who wants to add? No? Mary? Thank you very much. Thank you. Yeah. We are done. You want us to continue?
Thank you very much, panelists. I think this topic is also a very interesting one. And KCB has taken a leadership on this. But it doesn't mean that other people in the industry that we should not take this up quickly. I know there are steps that we've taken at different levels. Okay? I know I'm very short. I'm not like this gentleman, so let me take the podium. I hope you've had a good day. Have we learned something? Do you want to do this again? How often do you want to do it? Okay. So my job is very easy. I've sat and listened and taken notes. So mine is just to wrap up for everyone in the room and also for the community online. And Shane, you've not shown the people who are online. I know we've had about 40, 50 people today from the course of morning, and we appreciate them. Actually, I saw one person take a photo and send it on screenshot on WhatsApp, showing that even the community out there is quite engaged in terms of the conversations that we've had. And I believe our panelists have delivered. I think this is the second time we've had this conference, and I think the richness of the conversations that we've had in this room were quite great, and you did your homework and you didn't let us down. So looking from where we started, and we began with our chairman, both at the board level and the chairman of the Banking Commission. And what we did is, or what the two gentlemen did is, they painted the picture of ICC and basically telling our story. What do we do? And our role is to make businesses work for everyone, everywhere, and every day. So in all the committees that they mentioned, 12 of them, we've only done 4 chapters in Kenya. We have another 8 to roll out, and we are calling on new industry experts because we have a lot of wealth of experiences. From where you sit, raise your hand. Please come and serve in making ICC Kenya a success and achieving its mission in serving everyone, everywhere and every day. There's a way you can serve and share that knowledge. Don't go with or sit with the wealth of information that you have. For our first panel on convergence of banking and fintech. And I even like that we're even talking about that word, convergence. I remember when M-Pesa started in this country, banks were fighting. Banks were fighting. They were really fighting. They won't say it, but really banks were fighting M-Pesa. But we realized, and I think I was sharing some of my colleagues over lunch, if we were to come up with all these innovations and make them work, we will probably have developers filling our spaces. And they might not even be able to deliver the kind of products that we've seen come from the fintech space. And it's for us in financial institutions, and I think the word has been spoken today, collaborations. We need to collaborate. Where I sit, and in Kenya, we are privileged at the bank to have been mentioned or made Kenya as one of the innovation hubs. And one of the key roles or our strategy is to work with the young people in the hubs, tech hubs. And you'll be amazed with what products these young people can actually bring. Even with your 20, 30 years experience in banking, you might never come up with something like that. And I like what the panelists said. Necessity in Africa has driven us to innovating. I don't know how many of you have gone to Somalia. Anyone been to Somalia? Okay. Somalia is one of those countries that uses dollars as its own. They don't have a local currency. If you look at money transfer entities like WorldRemit, Dashbill, they've come from Somalia. But what has driven that? Again, everybody cut them out and they needed to survive. So they came up with some of the innovations that we've seen even being adopted by the world. Again, the need to reach to people and have our products reach some of these people in those markets. We need to innovate. You can't keep on putting a branch everywhere. Branches are costly. And we've seen now, even with the generation that we have now, people don't want to go to the banks. People want to access banking at a button. So partnership, collaboration, very critical. And we were challenged by one of the panelists. Anna's left city. Why do we have to make a payment? If you're making a payment from Uganda to Kenya, it has to go to New York, then it comes back to Kenya. It's costly, number one. It's inefficient in terms of the time it takes for that payment to reach the final person. And we also heard from the panel that we've seen emergence of platforms, eKYC. The gentleman in FRC who said, in a click of the button, even for them, the systems, they're able to run through transactions, many transactions, what he was talking about monitoring, run through and see the patterns and be able to pick out any inconsistencies with that. RegTech, regulation technology, we've seen with banks, virtual accounts coming up, which is very critical for us. So the challenge for us on that was we need to collaborate to serve Africa. And again, our customer, we need to look at how can we come up with embedded products, not going to different financial institutions for the financial services. On debt restructuring, again, for us as bankers, some of us are in sales, let me put it that way, of marketing. At the end of the day, you have a number and you heard what Judy was talking about, and she was talking, the last panelist. You have a target of what you should deliver. But even as we do that, we also need to be mindful of what is happening to our customers and ensure that we can tell when things are changing in our business to avoid issues of bad loans. We took a presentation from ICC Academy, and again, it's a call to all of you. The discount is there of 33% for you to take up those courses. The digital trade one was presented. On arbitration, again, a new way of engaging customers or trying to resolve disputes within the bank. And I just want to give some of the numbers that were shared. And I think one of the participants talked about the conference that was done some time back by KBA, judiciary, and law firms, essentially, and banks. And the number that was given, and I just want us to take note of this number. We have about 39 billion stuck in matters that if were handled through arbitration, this is money that can be released back to the economy. So again, we need to see how we can adopt arbitration in resolving this. One of the panelists talked about 4,000 cases that have been identified in Nairobi, Mombasa, Nakuru, and Kisumu, that again, they are going through this process. And it would be nice to see how we can quickly resolve this. Looking at AML, the panelists were very clear. The speed we are moving with innovation, it's like building a pipe. And that pipe, if it has dirt or fire, it will move very fast also in there. So we have to ensure the pipe we build in terms of these integrations we are doing with fintechs is very, very sound. And we make sure that products that we are giving our customers are very safe. And at the end of the day, the obligation rests with us. In fact, if you look at the regulations, as an MLRO or compliance officer, you are held personally, or even as an individual who handles these transactions. So you have to know the weight of it, and you have to understand the law. Because if it's proved that you handle such kind of transactions, you are personally responsible. If you look at that case that they gave of Dusit, the officials themselves, not the bank, the officials themselves that dealt with these transactions were held personally reliable. So again, as practitioners in the financial sector, it's something that we really, really have to watch. Looking at the final panel, and I don't know how many of you saw Kenya was downgraded in May this year, 2023 by Moody's, from B2 to B3. That is from high risk, high credit risk to very high credit risk. And it was because of two reasons. And apart from liquidity, the other reason why we were downgraded was on ESG. The issues of drought, poverty levels, played a major role in having Kenya getting downgraded. So it only goes to emphasize the need for us to take this matter very seriously. Again, you've heard that the regulators are very keen, and we've been called upon to ensure that we report on this critical aspect of that. And with that, I want to really, really appreciate all our panelists, our board, our sponsors, and you've stayed with us the whole day. We really, really appreciate you. To you participants, both online and in the room, I think the conversations have been interesting. I can see we are still all seated, which goes to show that we've done. To the Secretariat, Shane, Pascalina, I know it's not been easy. You've spent a few nights without sleep, but you can sleep today. Yeah. We appreciate you. To the committee, we really, you did a good job. And with that, Fred, I don't know if I'm allowed to bring the session to a close officially. And see you next year. And let's get feedback on what more you want us to discuss. Thank you very much.
National anthem. Okay.
I'm told you have to play the national anthem. And I'm told after the national anthem, we'll need all of you at the front. We want to do a group photo. Thank you. We can't see or play. You can play the national anthem? Oh, you can see. Thank you. So I'll ask everybody to come to the podium.
Hi guys. Let's come to the front.